All right, welcome everybody to the this annual conference of research conference of Bank of Finland and CEPR. It's a pleasure that after a while we see so many people in person here after the pandemic times when we were only online in these events. Equally welcome to all of you also who are participating online. It's great that overall we have so many participants. Before we start, so particularly for our online participants, when you make questions, so please write them in the chat, and then we will read them here. That's going to be the way to make questions and participate in the discussion. So without further ado, let's kick off with the first session, which I will also be chairing, session on monetary policy, labor, and banks. All the speakers in the sessions will have 30 minutes, so 20 minutes for the speech, and then 10 minutes for the Q&A. And the first speaker is Yannick from Federal Reserve Board. Please, the floor is yours.
Thank you very much for accepting the paper on the program. This is a paper called Monetary Policy Under Labor Market Power. It's joined with Anastasia Burya, who's a PhD student at Columbia. She's on the market this year. She's doing very exciting work on market power, monetary policy, and macros. So have a look at her if you're hiring. Also with Mano and Anke who are both at the IMF. I'm at the Fed board, so I should say that the views are ours and not those of the institutions that we're affiliated with. So we know since the global financial crisis before the COVID pandemic, monetary policy has been quite accommodative, and it seems to have been pretty successful in lowering the unemployment rate and spurring employment growth, but at the same time, wage growth has been lagging. Ultimately, the Fed even decided to change its mandate, saying they will worry less about a low or too low unemployment rate in essentially increasing wages and increasing inflation too much. So, in other words, there has been essentially this flattening of the wage Phillips curve going on, and at the same time, we know from other work that labor market power, that firms in the US have a substantial degree of labor market power. And what does it mean? Essentially, it means that firms can pay wages that are lower than the marginal product of labor. And so when firms have a certain degree of labor market power, is it possible that this is one potential explanation for why monetary policy hasn't been successful in increasing wage growth, but at the same time has been successful in spurring employment growth? And this is essentially the question that we are asking in this paper. And let me summarize very quickly. We find that labor market power essentially strengthens the labor demand effects of monetary policy. So firms that do have a substantial degree of labor market power and kind of pay lower wages, when monetary policy loosens, essentially, these firms, they are hiring more, they are posting more vacancies, and they're hiring more than the firms that have no or less labor market power. At the same time, these firms that have labor market power are hiring are more, do not have to pay higher wages. So although they can hire more, they do not necessarily have to pay higher wages by hiring more. So essentially, this kind of firm level wage Phillips curve is essentially flatter for these, or flat for these types of firms. This effect is essentially stronger for non-skilled workers, so workers that have like no tech skills or have no or less education than for others. So overall, taking these results together, they suggest that labor market power at least offers a partial explanation for this kind of wageless recovery that we have seen after the global financial crisis and also in other expansions in the past. So what is the intuition essentially that we have in mind here? The results are consistent with a very typical kind of search and matching model where firms can hire through two margins. Of course, they can hire higher wages, and that's the way how they can attract more workers. But what they can also do is essentially they can post multiple vacancies. And when they post multiple vacancies, that also attracts more workers, because the workers essentially, it's easier for them to find jobs, and workers, they appreciate that. So if we think of kind of labor market power as firms are being firms being more visible, so essentially have a kind of more efficient matching process, or they have a lower cost of posting vacancies, then essentially we can rationalize these findings, and we can see that firms with labor market power, instead of hiring through increasing wages, they essentially adjust their vacancies. So let me be a little bit more specific and formal here and sketch the very, very simple model that we're still working on here for you. So again, firms, they hire, posting either wages or multiple vacancies through this hiring function H. And then what we find is that the first order condition of the firm is that the marginal benefit of hiring through vacancies divided by the marginal cost of posting vacancies has to be the same as the marginal benefit of hiring through wages divided by the marginal cost of raising wages. And what you can see is, so if we again think of labor market power as firms having lower cost of posting vacancies, so this C here is lower, this whole thing of course goes up, or they have higher visibility, so this H prime essentially is higher. That means that essentially they hire more through posting vacancies rather than through increasing their wage. So when there's like a positive demand or monetary policy easing shock, what it means is that labor market power amplifies the response of vacancy postings and hiring without a disproportionate increase in wages. So how do we test that essentially? So we use burning glass technology data, which gives us the almost universe of vacancy postings, around 250 million vacancy postings from almost 50,000 websites over the last 10 years. They represent around 70% of all US online vacancies, and the great advantage of the data set is essentially that you have a firm and a regional component there, and you have the job requirements of the vacancy posting. So then what we can do is essentially we can track for each firm, each location, at each period of time, essentially how much vacancies they are posting. And then we're combining that with kind of the typical monetary policy shocks here. We're using in the baseline the Jaruzelski and Karadi shock, which are the high frequency shocks, which are then aggregated to the quarterly level. So how do we define labor market power? If you think of kind of the Berger, Herkenhoff, Monge, Cornot competition model, what they have as a definition of labor market power is the share of total payroll of each firm, which is kind of in the same spirit as in the Atkinson-Burstein for sales, essentially. And so then we follow essentially this tradition, and we use the vacancy share as a way to define labor market power of a firm in a commuting zone in the US. So essentially, we accumulate over time the number of vacancies that the firm posts in a commuting zone, and we divide that by the total number of vacancies that has been posted until this period of time in the commuting zone. So what you can see is when firms essentially have higher vacancy shares, here on the x-axis, you can see that in the beginning, when they have a tiny bit of a higher vacancy share, that doesn't really change the wage that they are posting on the vacancy. However, at a certain point, so once they have a substantial degree of labor market power or market share, essentially then they start actually posting much lower wages for both college and for non-college workers. And so, of course, this could be driven by a lot of compositional effects. So here I'm already splitting between non-college and college workers, but when we run a formal regression and essentially regress the wage posted in this vacancy on the market share, controlling for firm times time fixed effects, for commuting zone times time fixed effects, but also for a bunch of other vacancy characteristics, whether, not only whether this is college, non-college, but also software, what kind of occupation, we always find this result to be very, very strong. Essentially, once you have a large degree of labor market power, you pay lower wages than if you have a very low market share, essentially consistent with the idea that if you have a low market share, you have like kind of less visibility. You have to essentially hire through higher wages than when you have a high market share, which allows you essentially to hire for lower wages. So now going to the main specification that we have in mind here to test the idea to what extent monetary policy affects the vacancy posting as a function of how much labor market power you have. So here, labor market power is defined again as the firm commuting zone level vacancies share, and we are interested in how firms with a differential degree of labor market power react to monetary policy easing here, and how they adjust their vacancy postings. So importantly here, we control for firm times time fixed effects. So as the labor market power is a firm commuting zone measure, this allows us essentially to have firm times time fixed effects with control for a lot of other different channels that could be going on that are typically established in kind of the monetary policy literature. So for example, if you think of financial factors, they are usually driven by, usually on the firm times time level. And so essentially here we control for them through this firm times time fixed effects. At the same time, you may think that there are some commuting zone factors, some regional variation that drives the total number of vacancies that are posted. Through commuting zone times time fixed, we can also control for that, and essentially we are only exploiting here the variation across firms in a commuting zone, or similarly within a commuting zone across firms. So let me tell you what we find. So first, when we look at the monetary policy easing shock here, you can see that there's a positive relationship between monetary policy easing and log vacancies. Here, in this specification, we do not have the time fixed effects included, so that allows us to identify this coefficient. And then the coefficient on the interaction between monetary policy easing and labor market power is always positive and statistically significant, meaning that when there's monetary policy easing, the average firm or a firm with very little labor market power is increasing their vacancy postings, but a firm that has a large degree of labor market power is posting even more vacancies in response to this labor market, in response to this monetary policy shock. So when you then look at kind of how this effect is distributed across the firms with differential degree of labor market power, consistent with what I was showing you before on the wages, you can see that essentially if you have low or median labor market power, it doesn't really matter. So it's really kind of it's really driven by the firms that have a very, very high amount of labor market power. So these are really the ones that are responding in terms of their vacancy postings much more than the ones that have very little labor market power. So if you're just the average, or if you're just the median firm, that doesn't really buy you a lot. But if you are, if you have a very large degree of labor market power, then essentially your vacancy postings they increase much more. If you look at it dynamically, you can see here, looking at the high labor market power firm versus the median labor market power firm. Again, for both of them, this is of course without time fixed effects, you can see that vacancy postings are responding quite strongly in the beginning, and then it's even increasing over time. But the ones that have high labor market power, they respond much more, and they are hiring more, or they're posting more vacancies than the ones that have less labor market power or no labor market power, essentially. So now, if you think about the model of the kind of search and matching model, you would think that this is kind of more prevalent for certain types of workers because they have more or less outside options. So if you think of kind of a college-educated worker, it's much easier for them to move around, to search for vacancies somewhere else, and so essentially their search costs are to some extent much lower than for workers that have a high college degree and that are kind of like more tech savvy. So the vacancy postings allow us to look at what kind of vacancies, what kind of requirements there are for this particular vacancy, and we look here at two of them, essentially kind of tech skills, so whether you need like some software skills for this vacancy, and whether you need a college degree. And then we are testing whether there is a differential effect for these workers, for these vacancies that require tech skills, and that require college skills. And the way we do it, we have the interaction between the monetary policy easing shock and the labor market power, and then we have the triple interaction between the monetary policy easing shock, the labor market power, and then whether this is a vacancy that requires a college or kind of a tech skill, college degree or tech skill. And so this triple interaction then tells us essentially whether these kind of vacancies are responding more. And what you can see is here in the triple interaction that they're both negative, which means that that essentially the workers that the vacancies that have kind of higher requirements for technology and for education, they are responding less. So it's really kind of driven, if you kind of split it up, this effect is driven for the vacancies that do not require college or do not college degree, nor do they require some kind of software skills. When you look at the effect for the vacancies with a college degree, the effect is much smaller. And again, this is kind of consistent with the idea that the ones with a college degree or with tech skills, it's easier for them kind of to search around for vacancies, and essentially they can move around faster, so you cannot hire as many without raising your wage. One question, of course, is that whether these more vacancies then also translate into higher employment. The advantage of the vacancy level data is that it's on the commuting zone time level and kind of just reflect essentially kind of the labor demand to some extent and not the general equilibrium or the equilibrium outcome of demand and supply. But what we can do is we can actually merge our data with Compustat and then look at the effect on employment itself, and we see that also when we then aggregate on the firm level the degree of labor market power a firm has, that the firms that have more labor market power in response to monetary policy easing shock, they also hire more. So employment growth is also going up. Now let's look at wages. So not all of the vacancies that are posted in our data set or that we have in our data set do have wages reported. But quite a lot of them actually do, and from other work we know that really this is the wage that these employers are indeed paying. So we're looking at the wage. Essentially, we're running the same regression as before, but instead of having the vacancies on the left-hand side, we're replacing it with the wage. And again, what you can see, at least in column 2 and 4, is that when there's monetary policy easing, wages are increasing. But then the interaction between monetary policy easing and the labor market power is actually most of the time insignificant, it's moving around a little bit. But then I think it's even more striking when you look at the graph. So again, when monetary policy eases, both firms with high and low labor market power are increasing their wage, but essentially it's almost the same. And remember that the firms with labor market power, they're hiring more, but they pay the same wage. So if you think about it from the firm perspective, it's the case that they have kind of a flatter wage Phillips curve than the others. So where are these firms with labor market power? Who are they, and where are they located? So if you kind of plot the share that is controlled by these kind of firms, or use other types of measure, you can always see essentially that these firms are not kind of the firms that are, or they are not located in the regions like California or something like that. They're really kind of in the middle of the country, the Great Plains. So this is really kind of where these firms are located. They're more rural areas. They're usually areas with lower income and so on. So that really means that in these regions, monetary policy is going to be much more effective in stimulating employment, but it is unable kind of to increase wages substantially, which is exactly what we kind of have seen in the recovery after the global financial crisis. When you then split kind of these regions into the ones that where firms are located that have labor market power and where in regions where they don't, of course there are many other characteristics there, but if you just kind of do it and then you look at the wage inflation and the unemployment rate, you see that this wage Phillips curve is really there, is alive for the low labor market power regions. So you see that in these regions where labor market power is low, that when the unemployment rate is going down, you see wage inflation really going up. but in the regions where labor market power is strong, there's almost no relationship between the unemployment rate and inflation. So let me conclude. We find in this paper that labor market power strengthens the employment effects of monetary policy, and this is especially the case for low-skilled workers, which suggests to us that the capacity of monetary policy to stimulate employment growth is pretty strong, but monetary policy may have limited impact on influencing wages. And this is especially the case for regions, essentially, where labor market power firms are present and where labor market power firms, where labor market power is prevalent. Our results are also consistent with the fact that essentially we have seen this modest increase in wages after the global financial crisis recovery, while unemployment has declined significantly. So to some extent, we think that labor market power could have something to do with this like wageless recovery. Now, looking at the current context and thinking about the tightening of US monetary policy, our results suggest that they could have also pretty important implications for income inequality, especially across different types of groups. So if you think about this picture here, it's really when monetary policy is going to have stronger effects in terms of labor demand in these types of regions, and especially for the low skills. So their unemployment rate is probably going to go up more because of labor market power than in the other regions, and essentially wages are not going to be very responsive. So really the unemployment rate has to be brought up quite significantly in order to bring wage inflation and then inflation in general down. Let me stop here. Thank you.
Thank you very much, Yannick. Who would like to start with questions? Please. And please wait for the mic, it's coming.
Super interesting. I just had a question about I had two questions actually. One about just the theoretical mechanism that you had in mind. It seemed to me your story was that the firms can somehow substitute between, like these high labor market power firms can substitute between posting vacancies and increasing the wages. So then I would have expected that, when they respond to monetary policy, they would do the same, so that the high labor market power firms would increase wages less than the low labor market power firms. But you don't seem to find that empirically. So I was just trying to think how to square it sort of in my head. And then the other question was just sort of a data question about the wages. So I guess these are posted wages, as you said, and you did say, that those are then actually the wages they actually pay, which we know from other papers. But there's still the wages of sort of new hires, right? And so there's then also the wages of the existing employees. So I guess the question is how to think about that and whether you can say something.
So we don't have the wages of the existing employees. So I mean, I guess you would expect this to react much less. But I mean, I'm not sure which data source we could use to test that. But yeah, I think it would be very good to see. I think some other papers have looked at that, and we kind of rely on them kind of to look at these kind of questions. But
it's really sort of the wage Phillips curve for new hires. And so if you wanted to think about the aggregate wage Phillips curve, you think
so actually so I mean, of course here we can do it, right? So this is so here we look at the aggregate commuting zone. So that here these are the posted wages actually, but actually we can replicate that with this. On the firm level, it's going to be more difficult. At least I don't know exactly which. I think in CompuStat the wages are not filled. On the first question, exactly. So we do not find that they respond less, but you would think like when they hire more, they would also have to increase their wages by more. Right? If they post more, then every marginal additional worker, you would think that they have to raise their wages, and that you don't see essentially. This kind of, I mean, if you think about it from the Phillips curve perspective, right? So essentially here you see this the flat curve essentially would also tell you something similar, right? So you you hire more, but you don't increase your wage. So it's not that, I mean, you even see like a tiny bit of a positive slope. So that essentially you were asking, why is there no positive slope to some extent, I think, on the aggregate level.
And do the slopes in my head.
Okay.
Yeah, so, yeah, okay.
I see a couple of more hands. So maybe we combine Gaetano first and then you. So let's see then if we have time left.
Hi, thanks. So I'm very sympathetic with the mechanism. I just want to understand a little bit more if you have in mind that so posting vacancies should be costly in this environment, and if this is the case, what is the cost of posting one job rather than two jobs? Because I think once you do the advertisement, and in particular, I'm thinking when in econ job market, sometimes we post open positions, right?
Yeah.
So how to measure the share of vacancies when you have this kind of posting? Thanks.
Let's take the other question also. Juha, please.
Okay, thanks. This was very interesting. You showed the condition for the firm on sort of the marginal condition between the wage and the employment or unemployment choice. But what kind of mechanism do you have in the matching model for wage determination? So is it some type of Nash bargain like usual? And what is like the worker's side of the sort of acceptance condition, if you want in a way that does the worker properties, I guess they influence, like you told, that if you're a high-skilled worker, you probably have more bargaining power towards the firm. So do you have a Nash bargain or some completely different mechanism in the model?
Yeah.
Okay, so please now we
Yeah,
can
so
answer both.
This is just very standard search and matching model. So we don't really so this mechanism that I was talking about with the tech and that they have, that is easier for them to bargain, we don't have in the model. So we are still extending the model. It's very, very preliminary so far. So we hope to take that into account, but so far we don't have that. So right now it's very, very standard, but the only difference is that essentially the firms can post multiple vacancies and not only one vacancy. On the cost of posting vacancies, so there's a recent paper, I forgot by who it was by, but they're essentially showing that for like every posting of a vacancy, it's equivalent of I think like the yearly wage of one HR worker or something like that. So they're actually pretty, and of course that doesn't only mean like kind of to click, right? To click and upload it, but it's also going through the whole interview process and all of these kind of things, invite them over, maybe, have the whole assessment center and all of these kind of things. So these costs seem to be quite substantial. Maybe they have gone down recently when we can do these things all online and so on. But at least this paper has shown that they're actually quite high.
Thanks.
Thanks for these questions.
Matti, if you have a quick one, we can take it, please.
Any possibilities of making comparison to the old inflation from 60s and 70s, for instance, in terms of the geographics?
So our data doesn't go back very far, so we cannot really look at the time series dimension, and there has been a bit of a debate whether labor market power has actually increased over the time or not. So essentially right now, so I think it has increased since the 60s, but like over the last kind of 20 years, it's not super clear. So I'm not exactly, we cannot directly speak kind of to that episode though.
Great, thanks a lot. We are right on time. Thank you very much,
Thank you.
Yannick. And I'm too close to the mic, but if you want to clap, please feel free. The next speaker is Andrew MacKinlay from Virginia Tech. Please, the floor is yours.
Okay, I'd like to, again, thank the program committee for including our paper. I'm looking forward to learning a lot in the next couple of days. This paper is called Monetary Policy in the Age of Universal Banking. It's joint work with Michael Gelman and Itay Goldstein. And let me jump right in here. So as the title alludes to, in this paper, we're thinking about this increase in universal banking, and I'll be focusing on the US context. And just to make sure we're on the same page, this is this sort of new regulatory regime where commercial banks are now able to do investment banking activities, trading activities, insurance, things that for a very long time they were prohibited from doing. And in our context, we'll be focusing on two of the main non-lending activities, expansion into trading and investment banking. So kind of big picture, what changes amongst these banks when they become more universal? Well, kind of the obvious thing is that they're expanding into new activities, taking on new asset types and so on. But also with those expansions is going to be an increase in the variety of income sources that they're receiving. Now, I think that's, again, a fairly straightforward statement to say, as I have new assets, I have new types of income. But interestingly, and maybe less obvious, is we actually observe in the data that within these types of assets, the variety of the income sources are also changing as they expand. So just as an example here, in the case of trading, what we happen to see is as banks engage in more and more in trading, so we're measuring that as trading assets to total assets, so as you see more trading assets in their banking structure, they empirically tend to be moving away from generating this income from trading debt securities, so treasuries, corporate bonds, things like that. And you see them getting more and more of their share from other sorts of trading income, such as foreign exchange, equity, commodity, and so on. So it seems like in this transformation among banks, there's certainly some changes in the activities that they do. And what this paper is trying to get at is, okay, how does this factor into sort of the more traditional role of banks as lenders in this transmission of monetary policy? So what do we see the contribution of this work? We argue that this expansion process of banks, so them becoming more universal, if you will, changes their income profile, and this tends to not only have consequences for the individual banks and how they make their lending decisions, the kind of traditional stuff, but it also has effects on the overall efficacy of this monetary policy transmission. Now, obviously, since that's what we're getting at, this is kind of the clear policy implications that as the banking structure changes, how the Fed executes the monetary policy and how effective it is going to change a little bit as well. But also, I think, quite interestingly, this has some implications for how banks think about regulating these non-traditional activities. You know, in the U.S. and other countries, I'm sure, the Federal Reserve has this kind of dual job where they're both overseeing the monetary policy work, but also a lot of the financial stability and regulatory regimes of banks. So there's a potential for tensions as they're allowing certain activities on the regulatory side that may actually feed back into their other goals of, you know, monetary policy actions. So perhaps in contrast to Yannick's paper, we're going to be focusing more on kind of this tightening regime as opposed to monetary policy easing. But what we basically argue is this points to what we think is a new channel where universal banks, given their new structure, are going to maintain higher levels of credit supply following monetary policy tightening. And we argue this is distinct from kind of existing channels or theories of transmission. Now, the mechanism we have in mind, which I'll certainly return to and get in more detail, is as follows. You know, first, banks are becoming more universal, and it turns out this means that they engage in more activities with income that happens to be more positively affected by tightening in monetary policy. It's not obvious that that's what had to happen, but that empirically seems to be the case. Now, what does that mean? It means, okay, as the Fed funds rate increases, these particular banks, their non-commercial banking revenues are going up as well, and that's providing them more resources, and it appears they're choosing to maintain more credit supply with those resources, and this is basically counteracting the monetary policy pass-through. Now, I'll get to it a bit, but if you try to aggregate this up, and I'll be doing a lot of kind of county-level analysis, but if you look at counties that have more of these active universal banks, we'll see higher credit supply relative to comparison counties when the Fed funds rate increases. And we'll actually see some evidence that this seems to transmit to lower unemployment rates, so kind of moderating the credit cycle. And towards the end of the talk, I'll sort of circle back to this idea that indeed the effect seems to be concentrated much more in the periods of tightening than easing, and we can get into reasons for that. And at the end, a little bit of, you can think about these changes in monetary policy a little bit differently, and you'll still get similar results. Okay, so I don't really want to spend too much time on this. Clearly this is tying into literature about transmission, universal banking, and diversification. And it actually also in spirit has some similarities in the mechanism to a more recent literature about shadow banks and how they affect monetary policy transmission. So let me jump into the setup and the analysis. So what are we doing here? So we're looking at the universe of US banks, or really bank holding companies, I should say, from 1997 to 2018. And why start relatively late in 1997 is we're going to be focusing on small business lending, and that's really when it first becomes widely available to actually observe the small business lending activities. So in our analysis, we're going to be looking at the small business lending of a given bank in a given county in a given year, and this is new originations. And this is going to allow us to be quite granular and think about controlling for, confounding demand factors or what have you. Now, our main kind of variable of interest is going to be what I have in bold here. This non-lending activity measures interacted with changes in the Fed funds rate. And the two measures, as you could probably guess, that I'm going to be focusing on are exposure to trading activity. So that's going to be trading assets scaled by total assets, and then also investment banking activity. Now this one's a little harder to just measure cleanly because there's not really a assets of investment banking in kind of the traditional banking sense. So what we do is we kind of utilize something from a past paper with these two co-authors, and we look at the number of broker-dealer subsidiaries in the bank structure. So that's one way to measure how deeply involved in investment banking activity you are, is what kind of subsidiaries are engaging in these activities. Now, in addition to this, and I'll be suppressing it so we can actually read the coefficients, but we'll have various bank controls and bank county controls that you'd imagine would also influence your lending decisions. So the size of your bank, deposit ratios, equity ratios, your net interest margin, and so on. And maybe county level deposit share we include. And lastly, we'll have some bank county and county by year fixed effects, which are just trying to focus in on the supply decisions separate from variation in demand across counties. All right, so let me jump into the kind of the main results, and then I'll turn back to the mechanism. So what we find here is that both for trading assets and our investment banking proxies, we find that for a given change in the Fed funds rate, these banks that have higher exposure to trading assets or broker-dealer subsidiaries are maintaining more small business lending than their peer banks. And to give you a sense of the magnitudes here, if you just do marginal effects, so one standard deviation increases of the Fed funds rate and these measures, we see that banks with a higher exposure to trading maintain about 8.1% higher small business lending levels. And for one standard deviation more investment banking subsidiaries, they maintain about 5.9% higher SBL levels as well. Now, throughout, we're focusing on small business lending because I think that also ties very neatly into the kind of employment implications of this, but we've also looked at this sort of regression thinking about mortgage origination activity, and you see similar patterns there as well. So it's not just specific to SBL, but it seems kind of a broader lending effect. Okay, so having that in mind, that with these exposure measures, this is what we see. I want to spend a few slides on the mechanism and kind of walk through the steps of how we're thinking about how this is occurring. So this is kind of broken over a few slides, but hopefully it'll help clarify things. So, the reminder is what we have in mind is if the Fed fund rate increases, this universal banking activity for some reason is providing more revenue, and then that's allowing more resources to maintain credit supply, and we have this pass-through. So as kind of the first step, we want to focus in on that first stage. So when rates go up, why in fact do in fact these guys have more revenue? So how we go about doing this is we bank by bank estimate the sensitivity of their trading income or investment banking income. So that's the left-hand side variable, so trading or investment banking income to assets, as a function of past changes in the Fed funds rates over the past year, kind of quarter by quarter. And so we'll estimate this bank by bank, and you can sum up those 4 betas to get basically the overall overall income sensitivity estimate for that particular bank. And we'll do it in a rolling fashion, so we're not looking ahead, and you can actually allow the bank to maybe change over time what it's doing and kind of capture that phenomenon. So, the basic idea is this higher income sensitivity measure is capturing that, okay, this bank, when the Fed funds rate is going up, they're having higher trading or investment banking income. Okay, so we go through the sample and we estimate these sensitivities, so we have a distribution of them. And then, the question we ask is like, okay, what explains these measures of income sensitivity? So, maybe perhaps unsurprisingly, we find one of the most important, or the most important factor is basically how engaged are they with these measures of universal banking that I showed you in the main results. So how you can see here, what these figures are plotting are basically saying, okay, bank by bank, as I have more trading assets activity, what is my associated estimated income sensitivity? And similarly for measures of investment banking activity, same kind of idea. So what you see here is that there's a pretty strong positive relationship that as banks have more and more of these activities, their income sensitivity to Fed funds changes go up, and importantly, these are positive estimates. So we're saying that for these banks, when Fed funds rates go up, they actually are reporting higher trading income or investment banking income. And actually, even though it's outside of our data, if you look at more recent reports about the last few quarters for banks, they often have these discussions about how in the current regime of Fed funds rates being increased, they're reporting record levels of trading income and so on. So it sort of comports with this idea. It didn't have to be the case that you're having higher sensitivities, that you could just be generating more trading income, but they do seem to have this pattern. And so this expansion process seems to be shaping these income sensitivities. So I've briefly touched on how we estimate them and how they relate into the data, but there's still this question of, okay, why do these investment banking sensitivities increase as they become more universal? So to explain this, I'm actually going to circle back to what I showed you on the first slide, which is it seems that the banks themselves are not just scaling up and doing the same types of activities across the board, but they're actually changing the composition of activities that they do within these universal banking classes. So what you can see here again is that they tend to move away from the largest share of their income being related to trading, treasury bonds and corporate debt and whatnot, and then they move more and more of their trading income into foreign exchange, commodity, and so on. Okay, so why does this matter? Well, it turns out if you look at how these particular revenues relate to Fed funds changes, the activities on the right tend to have much more of a positive relationship. So the equities trading, the commodities trading, and so on, they tend to see the largest increases when Fed funds rates go up. Trading in debt securities doesn't have that same sensitivity. So basically, we believe that this pattern of moving from debt trading into these other activities is really what's driving this change in how sensitive the income is. And it's a little harder to see as granularly, but if you look at investment banking and you think of that as like some brokerage activities and other investment banking advisory activities, there actually seems to be similar patterns. Okay, so almost through the mechanism here, we want to just say, all right, can we verify it? So we've estimated these income sensitivities. We've looked at what is their kind of compositional effects. So as the last step here, we're going ahead and we're putting in place of our original exposure measures, these sensitivity measures in their place, and otherwise running a very similar specification to what I showed you earlier. And what we see is, again, if you look at kind of standard deviation changes in these variables, we're getting similar magnitude effects. So, about a 9% higher SBL if I have more trading sensitivity, and about 3% for investment banking. So, generally the pattern seems to be that the trading effects are a bit larger than investment banking, but they both are going directionally a similar way. Okay, so hopefully I've covered the core effect and this our attempt to kind of get at the mechanism behind it. So now I want to move on to a few, thank you, kind of the remaining pieces. So, the story I've laid out so far about this mechanism, about the income sensitivity, it's really agnostic, and the estimation is agnostic to, increases or decreases, right? We're just saying, okay, changes could be positive or negative. So ex ante, there might be some sort of symmetric response. But it turns out, if you actually split the effects into, changes, positive changes in the Fed funds rates or negative, you see that basically the effects that we're documenting are very much concentrated in the rate increases. So this is much more of a factor in the tightening environment. Now, why is this? Well, one factor we find is, in the sensitivity discussion I gave you, so if I just click back here, if we basically repeat this exercise, but instead of just doing all changes, we split the sensitivities into rate increases and rate decreases, we basically find for banks that their these sources of income are much more sensitive to increases. So basically, if you look at trading income or investment banking income, it's moving much more with rate increases than rate decreases. So, and the magnitude is about 6 times for trading, and it's something similar for investment banking. So basically, I think what we're finding is that this income sensitivity is really asymmetric, and because we think that's underpinning all this analysis, that's why the kind of effects you see carry through are likewise asymmetric. All right, now turning to kind of more of an aggregate analysis, everything I've been discussing is at a bank county year level. We look at both bank level and county level analysis. So if you just simply aggregate up in the bank all of the places it's lending, what we find is we basically find similar effects of these subsidiary and trading asset measures. So for marginal effects, we're seeing about 1.5% higher small business lending, bank-wide. And again, I'm just focusing on small business lending here, but you could look at total mortgage lending, or you can actually look at changes in total lending in the bank's balance sheet, even though that's a little bit tougher because it has both retirements or debt maturing versus new debt, so it's not just purely originations, but we seem to see similar patterns. So I wouldn't say, again, this is a channel that's only hitting small business lending, but it's also in other places as well. All right, now getting to the county level, the idea here is, okay, what are these real effects? How is this transmitting to the broader economy? So the 2 variables we look at are aggregate measures of how much small business lending origination is occurring at a county, and then what is going on with that county's unemployment. And then on the, as far as the X variables are concerned, now that we've moved to a county level, we're basically looking at, okay, if I average all the banks in a county by their lending share, or past lending share, I get kind of a representative bank. And of that representative bank, we can say, okay, how universal is it? So how much trading assets, how much investment banking activity do they have? And again, we basically see that in counties that have more of an exposure to these types of banks, they have higher lending levels in the face of changes in the Fed funds rate, and also lower unemployment. So, to summarize, basically these counties with more universal banks, they seem to have less of a cyclical credit cycle pattern, and then this more stable set credit supply lowers the unemployment rate. So at the beginning of the talk, when we talked about the transmission of monetary policy from the Fed's perspective, if they're trying to cool the economy and slow down credit demand, kind of like we are now, the fact that these universal banks are a bit insulated from that, from their other activities, seem to have these effects. Okay, I'm starting to run short on time, so just very briefly, there's many channels, all well established, of how the Fed and banks interact and things change. So in this table, basically what we're doing is we're just putting in other variables interacted with the Fed funds rates, to some extent to try to capture these different, these other channels. So maybe it's something about the lending channel or deposits channel. And, while all those work themselves, basically the thing I want to emphasize is that our main effect of the trading assets on the Fed funds rate doesn't seem to go away. So our effect appears to be orthogonal largely to these other kind of channels of transmission. And you get similar results for investment banking. I've just suppressed it in the interest of not making this slide too crazy. Okay, so the last couple seconds, maybe you think, okay, maybe I'm just using simple rate changes. Maybe they're anticipated, and it's not so much the response to the rate, but something in the expectations across banks that's driving this. So we've also tried our exercise with these monetary policy shocks. And the basic idea of these is that using futures prices around FMOC changes, they basically capture to what extent rate changes are actually a surprise versus what has been telegraphed that everyone expects. We get consistent patterns if you use these changes as opposed to like the pure rate changes. All right, so let me bring it to a close. So we argue in this paper that looking at a channel of monetary policy that we don't think has been specified quite as clearly, which is this idea of universal banks providing different sources of income, and then that actually ends up affecting their credit supply response to monetary policy tightening. Again, the mechanism is all tied into the revenues, and that they actually will increase when in a tightening environment. The effect is asymmetric and also seems to carry on to county level, and we see it a bit in the unemployment rates. And we'd argue that has implications for just thinking about monetary policy of the Fed in conjunction with how banks are evolving and becoming more universal. So I'll leave it there.
Thanks a lot, Juha. And who would like to start with questions? Okay, let's go with Yannick first.
Very nice, thanks. I mean, I'm still kind of struggling a little bit to understand exactly what the mechanism is when interest rates go up. Why that provides somehow a hedge? Is it because somehow volatility goes up and so they can, I don't know, bid-ask spreads are going up, and that somehow provides a hedge? So I was wondering whether, like, what happens if you, for example, do the interaction with the VIX? Do you get the same result or not? Or is it just the case that essentially because you have more trading assets, that means that you have like kind of less traditional loans, and so when interest rates go up, demand goes down, and so it's more of a demand channel. So I mean, I know you have the county fixed effects, but I was wondering whether if you use why you don't use syndicated loans where you could potentially better include kind of the demand controls.
No, good question. So to your first question, that's sort of, I think, largely what we had in mind, that probably for like equities and commodities trading, a lot of it is like the volatility environment helping to increase it, although we're quite agnostic because we just estimate it on changes in Fed funds rates over this 20-year period or whatever. So it's not always the case that the volatility and the rate changes are coming. But that's sort of my suspicion, and we've looked a little bit at the VIX. I think it also loads, is my recollection, but it doesn't take away the entire effect. So it seems to be other factors, and we're kind of early on in this paper, so that's more and more of the work we're doing is trying to understand, okay, why, especially like trading. I think it's a bit more obvious. Investment banking, it's maybe less clear why you'd see these patterns, although empirically in the data, this is the patterns we're seeing, this sensitivity. Now, as far as types of lending, we focused on small business lending initially because we really had in mind this getting to the real effects of the unemployment. Now, I'm certainly happy to potentially expand it to deal scan, syndicated lending, and I've used that material before to sort of see, like, okay, within a firm, do you see one borrower giving them more than one less? I think we've moved that way a little bit with like the bank level total lending, but I think we can do more of that because, I didn't really stress it, but in the background, we are trying to control for, there's the county year fixed effects. We also try to control for like the bank's net interest margin, where we sort of see the mechanism as kind of controlling for the lending side and, kind of fixing that this marginal additional income coming from the non-lending activities is allowing them to boost it even more. So it's less of kind of like an equilibrium, reallocation. It's more like fixed where you are. This is the effect, I think. But good questions.
Thanks. And then back there, please.
Hi, thanks. Very nice presentation. I had a question about this first graph. So just probably it's a stupid question, but sort of if the banks are doing less trading activities with debt, does this mean there's a counterpart out there who's doing more? I mean, doesn't this have to balance out in the aggregate? And also to the right, So who's doing less of these other trading income activities? Or is it just that overall they're doing more trading activities in this right-hand panel, and therefore the share in the left-hand panel goes down? I thought, because if there's someone else is doing less, then probably these monetary policy effects should also work for these other parties, but with perhaps the opposite sign. And the second question is just if this applies to monetary policy shocks, it seems like it should matter for other types of impulses, like oil shocks or something that affects income in different types of firms, which is in the right-hand graph, as far as I understood your mechanism. So that seems like a natural test of the mechanism to sort of look at other types of shocks and see if it's similar there.
Yeah. Okay. No. So two good questions. Yeah, I'd say maybe to the shocks. Yeah, I think the mechanism as we currently see it, it isn't specifically tailored to only Fed fund rate increases. I agree that if there's something that in the banking sector basically boosts universal banking income in a way that does not boost it for the less universal banks, I think we should see those allocation effects. So that's a good suggestion of maybe ways to kind of validate it further by trying to find like a few other things like oil shocks or what have you that you mentioned. And then as far as the income share, so yeah, I have to think a bit more about the aggregation to your question. So these particular pictures are saying like, you know, of the trading income that this bank reports, like how does it split into these parts, right? So it could be that, you know, total trading income is changing, like going higher or lower, but it just seems like the composition of that income is what we're capturing here. So I'd have to think about like, you know, kind of combining those two things, the composition, but also like the levels of income. How is that working out? Like one kind of, and this maybe relates quickly to your other point, is that while on average these sensitivities are positive, if you look at the distribution, there are actually some banks that have negative sensitivities. So especially the banks that tend to be over here with less activities. So we do actually see banks that in the face of these shocks, their income levels drop, and then actually they would have a bit of a like enhancing effect of transmission. So they would actually cut lending more, and we have found that. Although, you know, the basic idea is as they become more universal by our measure, you tend to move away from, you know, zero or negative sensitivities up to these positive ones. So, you know, to your, I think that was kind of in your questions is you could actually have for a subset of banks, this income shock move you the other way that you actually cut lending more than your peers. Yeah.
Thank you. Aino, please.
Yes, thanks. Very interesting. So just a question about, I'm thinking about the kind of aggregate importance of this. So you say this might have some implications for the transmission channel, but what share of small business lending on average is provided by these universal banks versus the other ones? I mean, how important is this lending done by these banks?
Sure. So two ways to maybe answer this. So the sort of how this sample relates is it does turn out that small business lending, at least when you think about it at a county by county level, tends to be actually dominated by the bigger banks, and although we control for size, they also tend to be more universal. So it's actually in the county bank level data, it's like these more universal banks actually have more share than you might think if you just looked at a simple bank level, quarter level, just because they're the bigger banks that are doing more and more activities. So that's the kind of the one question of that. And then, you know, more generally, I didn't really have the economics of our aggregation because we have to think about how well are we controlling for things, but I can kind of tell you that the lending increases are about like maybe 1% like marginal effect. So there's maybe about, you know, 1% more lending in these counties, and then unemployment is maybe dropping by like a couple of basis points. So, you know, we're going to spend more time thinking about, okay, is that too big, too small? I don't think it's too big, but like, you know, how is this factoring in kind of the overall transmission? Yeah.
Thank you very much. We are right on time. Thank you very much, Andrew.
Okay.
And before moving to the last presentation, so let me again remind also our online participants that please use the chat to make questions. I'll do my best to follow the chat too. So the final presentation in the session is by Jane Ryngaert, and she's appearing online.
Hello?
Hello, yes, I can hear your voice.
And
Great.
can you see my slides?
The first slide, yes. The title
Okay.
slide, yes, yes.
Perfect. Thank you. Thank you so much for having me. I'm presenting this paper, Job Search, Wages and Inflation, which is joint work with Laura Pilossoph. So just to motivate kind of what we're thinking about in the context in which we're thinking about it, I have these two quotes by Fed governors talking about wage price spirals and how wage price dynamics are something that we are definitely concerned with right now. So the way that we're thinking about wage price spirals, right? What a wage price spiral is this idea that as prices go up, employees demand higher wages, and then this in turn leads to higher prices. So what we want to think about is, this is kind of already taking that wages are set in nominal terms, which means that a higher price means that I need a higher wage or my real wage declines. So we want to look at the idea that getting a raise is going to take some effort on the part of the employee. So I might need to ask for the raise. I might need to demonstrate to my boss that I have deserved the raise, or I might need to do something like get a new job or get an outside offer that then prompts a raise from my employer. So given that it can take some time to get a raise or take the actions that it takes to get a raise, it makes sense for the worker to think both about what inflation they're experiencing and also what they expect to happen. So we're going to look at the link between inflation expectations and on-the-job search. So we're looking at that because this on-the-job search is also really associated with kind of wage growth and inflation. And we also know that on-the-job search is relatively efficient compared to the search of unemployed workers, that it kind of yields more offers and better offers. So we're looking at kind of the pass-through from the inflation expectation to wages, potentially through on-the-job search. So if I expect inflation, this means I expect a lower real wage in the future as long as my nominal wage is fixed. So I could engage in search to generate offers and counteroffers, and this could take some time, right? I might need time to find an offer or find a suitable match. So the question here is, do higher inflation expectations lead to on-the-job search? And what we're going to show is that employed workers with higher inflation expectations are indeed more likely to search for new work. And we don't see any relationship between the expected inflation and search of non-employed workers. And we might think, okay, so these workers are searching. Does that really matter? We also show that these higher inflation expectations are correlated with subsequent job-to-job transitions. So just very quickly to mention some related literature, we're thinking in this world of employed search, job-to-job transitions and inflations, and then we also kind of relate to this literature linking inflation expectations to the actions that consumers will take. Much of this literature is focused on spending rather than the labor market. So we're going to use data from the Survey of Consumer Expectations, which is a monthly survey run by the Federal Reserve Bank of New York. This is going to have a core survey that contains questions about macroeconomic expectations, as well as a supplement. This labor market supplement is conducted in March, July, and November of each year since 2014. And this supplement contains some questions about labor search. So this is nationally representative. There's about 1,300 observations per month. And importantly, households are going to be able to stay in the survey for up to a year. And they'll be sampled potentially every month. So we're going to look at the sample from February 2014 to November of 2019. The data for the labor search survey in particular is available into 2020, but we're going to drop the early COVID period because there were a lot of factors that might have been making it difficult for people to search. All right, so just looking at labor search and kind of what portion of the sample is looking. So employed workers are split into kind of two, like search is split into two categories, searching for new work or searching for work that will supplement my my current job. So about 15% of employed workers are looking for work and about 13% of non-employed workers. So because unemployment is categorized by have you actually searched for a job in the last 4 weeks, we're going to group unemployed and out of the labor force people together into a not employed category. Okay, and the reason again that these employed fractions don't sum to 100 is that we're excluding for the moment people that are looking for additional work. We're mostly interested in people looking to replace their current job. So the survey asked for inflation expectations in 2 formats. It asked for a kind of rate of inflation given as a point estimate. This is just given as a number. And then there's another question that asks people to think a little bit more probabilistically. What are the different things that could happen with inflation? And it gives them a range of bins ranging from 12% or higher or negative 12% or lower. And respondents assign probability to these bins. So we're going to use both of these forecast formats to form a kind of expectation of inflation for these people. We're going to fit a subjective distribution to that histogram forecast. And we're going to slightly modify the method that the New York Fed uses to pin the mode of the distribution to the point forecast. We'll then use the mean of this distribution as the kind of respondent's measure of expected inflation. There's still quite a range of inflation expectations, even kind of taking the mean of the implied mean of the subjective distribution. So we're going to Winsorize, and we're also going to exclude observations where the point and the density forecast just don't really make sense, like where the respondent gives a point estimate that's outside of the range of the density forecast. So this is what expected inflation looks like over the course of the survey. So in the early days of the survey, the average expected inflation was quite high, and it came down kind of into 2015. If we were to extend this graph to include today, I've only included the sample period here, but if we were to extend to today, this would of course be higher again. So just to kind of clarify what we're thinking about with search and which inflation expectations are mattering for search, I just want to kind of show you the timing. So the labor market survey we're going to call T+1. This is when people report having searched. And they're asked this question kind of retroactively, or about their past behavior. So have you searched in the last 4 weeks? Because this is a monthly survey, we're going to then call the period approximately from their last month's survey to this month's survey the search period. So this expected inflation in the month before they report search is the inflation expectation that we're kind of thinking about as potentially mattering for search. This is their expectation at the outset of the search period. So when we kind of split our employed workers into those searching and those not searching, we see that all employed workers, searchers or non-searchers, have lower inflation expectations than people who are not employed. But among searchers, inflation expectations are significantly high. The average inflation expectation is significantly higher than it is for those who are not searching. And we want to dig into this a little bit more. So here we're going to estimate a probit where we have search as our dependent variable. This expected inflation is going to be the variable of interest. So we're really interested in kind of the marginal effect of expected inflation. We're going to control for a number of things, demographic characteristics that could have to do with search, your age, income, kind of if you're married, do you have children, and then some detailed bits about your labor force status, like part-time, full-time. And we're also going to include a time fixed effect so that we're looking at just cross-sectional variation. So additionally, we're going to look at some macroeconomic controls. They're also asked in the survey, what is the probability that unemployment will go up, the probability that interest rates will go up, the probability that stock prices will go up. And then the labor market survey includes some questions about like the probability of receiving an offer, the probability of receiving a counteroffer, all things that might factor into whether or not somebody decides to search for a job. Okay, so this is the results of that that estimation. Here, kind of focusing on expected inflation, we see that the coefficient and the marginal effect are really strongly significant. And the way to interpret this marginal effect is that for a 1 percentage point increase in expected inflation, a worker is 0.56 percentage points more likely to search. And I'm including here these kind of labor market expectations just to show you that they all kind of have sensible signs that I'm more likely to search if I think that there's a high probability that I'll get an offer, that kind of the number of offers is correlated with search, and that, I'm also more likely to search if I think there's a good chance I will lose my job. Now we run that same kind of estimation for the non-employed, and we find that there is no significant effect of inflation expectations on the search of kind of unemployed respondents or not employed respondents. And we're going to kind of think about this as, a robustness check to our finding that we're kind of hypothesizing that the reason that employed people would want to search is because they're experiencing some real wage decline. So if you think about an unemployed worker who's going from not having a job to having a job, this is kind of, you either want a job or you don't, right? Whereas these workers are experiencing this kind of salient decline in their real wage. So we may be concerned here with reverse causality. We don't have exogenous variation in inflation expectations. There's not much that we can do about that within the context of the survey. So we might be worried that, is it higher inflation expectations causing search, or is it the fact that people are searching causing them to have higher inflation expectations? So, somebody who's searching might be sampling wage offers and seeing wage offers that are higher than their own. These offers could be higher due to kind of increased productivity, but they might attribute this to inflation. So like I said, we can't do that much about not having exogenous variation, but we can think about the timing of this. So, I showed you the timing of the search period that the search variable is collected after the inflation expectation that we're going to use. So we're going to kind of reach back in time for the inflation expectation of that person rather than look at things that were reported concurrently. But we're also going to do some kind of distributed lag lead specifications where we can kind of clarify what is the timing of the expectations that matter for search by allowing kind of other time periods expectations to possibly influence the search decision. So we're going to run that kind of same probit regression, but including multiple dates of inflation expectations. So here I have the search period. I'm going to include that same date of expected inflation, but I'm also going to use expected inflation at the end of the search period and expected inflation a period before the kind of outset of the search period. And we'll see here that it's that expected inflation at the outset of the search period that is mattering for predicting search for these employed workers. We could do the same thing, right? We have with two lags, we have the expected inflation at the outset of the search period and expected inflation in the 2 periods before. And what you find is, again, it's this expected inflation right at the beginning of the search period that has the kind of positive and significant marginal effect on this. Okay. And then here I'm doing 2 leads. So you would really think that if it's search that's causing higher expected inflation, that people might have kind of higher beliefs in T+1 or T+2 kind of right as this search period ends, or even a month after this search period. But here again, you find that it's the expectation at the beginning of the search period that has this positive and significant marginal effect. All right, so we've talked about search, but does this actually mean people do anything about it, or does it yield kind of a change that might be inflationary? So here we're going to look at actual job-to-job transitions. So if you have two subsequent labor market surveys here, we can take the tenure that they report and actually calculate, is this person on a new job? So we're going to call a job-to-job transition as a dummy variable equal to 1 if you're at a new employer since your last labor market survey. So again, just to show you how the timing of that works, we're still looking at this expected inflation in T right at the beginning of this search period. And then we're going to look at transitions made in here, kind of allowing the search period to take some time. And this is also kind of, we're constrained by how often this data is collected, right? But you're going to have basically reported this transition about 5 months later from relative to this expected inflation that we're positing as mattering for search. So here we're going to do that same kind of estimation, but here with the transition as the dependent variable, same set of controls. And we find that a positive and significant effect of inflation expectations on these transitions, even all this time later. So we're going to lose a lot of power here because people attrit as time goes on. People kind of fall out of the survey because they hit their maximum tenure or they decide to leave. But the way to interpret this is that a 1 percentage point increase in expected inflation leads to a 0.25 percentage point increase in the likelihood of making a job-to-job transition. And this we think is pretty significant because only about 3% of the survey does make a job-to-job transition. Okay, so then when we control for search, this kind of proposed mechanism of how we think inflation expectations are influencing the job-to-job transition, we find that this kind of significance of the expected inflation goes away. And that's because we think that expected inflation is operating through search on this variable. So if you control for that variable, you wouldn't expect to see that effect. So this is kind of work in progress, but the way that we're going to explain this is thinking about a model with on-the-job search where wages are bargained in nominal terms. So employees are going to match to some outside offers, and you'll have these nominal wages with two-sided limited commitment, such that like they can only be rebargained only with a credible threat. So your wage is going to depend on your the productivity of your firm match, the current price level, and then aggregate productivity. And our workers are going to have some negotiation benchmark reflecting the last time that they had a credible offer. It's going to be the firm productivity of that last offer, the aggregate price level of that last offer, and then the aggregate productivity at the time of that last offer. So just to think through a kind of quick example here, let's say I start a job with some productivity Y and Z is this aggregate productivity.
Jane,
this is going to yield.
Sorry, you have 3 minutes. You have 3 minutes, please.
Okay, thank you. Can you turn the microphone off so I can't hear myself? So the joint surplus here is a kind of function of that firm productivity and then the aggregate productivity. And the worker is going to start coming out of unemployment receiving 0 initial surplus share. So if the price level rises, right, there's going to be some kind of nominal wage that enacts that surplus share. When the price level goes up, the share of surplus is going to go down. So what could happen here is that this worker receives an offer from a less productive firm such that the overall surplus of that match is lower than the surplus of her current match, but is higher than the share of the surplus she's currently getting. And the model involves Bertrand competition where the worker is basically going to get the second best offer here. So rather than the value of unemployment, she's going to get this value of the kind of less productive match. And we'll see here that her current surplus and her wage will change to W tilde such that her current share of surplus is kind of greater than her initial share of surplus. So because we have this kind of declining surplus, like that the price level will lower the worker's surplus from her initial surplus, she's going to internalize that she's more likely to extract a raise with an outside offer. And what we're working on now is we're endogenizing search, such that this kind of lower effective share driven by the price level is going to raise the incentive to search. So you'll see here that kind of people search more as the price level goes up. I think that's my time. Just to quickly, okay, sorry.
Okay. Are you done? Can we go
yes,
to the?
Yes.
Okay. Thank you very much.
Yeah, sorry.
Sorry. Yeah. Okay. So we can take questions. The audience will have a microphone here, so you should be hearing also the questions. So who would like to start? Matti, please.
Have you looked at the forecast accuracy in the way that, okay, do you employed persons, forecast in a better way, more accurately? Do you, those who search, have better forecast, or is search based on some sort of forecast errors? This kind of questions might be put forward. Thank you.
That's a good question. We did kind of check, for people with very kind of accurate forecasts, did you find this? And you don't find the same thing. So it is kind of large variations in, there's probably some element of accuracy that's going into this. And we try to control for parts of that might also be linked to kind of search as much as we can. We control for numeracy, kind of education, income, things like that.
Okay, thanks. There's another question, please.
Yeah, very nice talk. I was curious, do you know anything about who are the people who are searching more when inflation goes up? So I guess the ultimate question is if allocations improve. Normally we think that search activity is creating value because it improves allocation. So do matches get better from this? Is there any sign that, so what type of firms, do you know anything about, so is it that people with a bad match who are moving, or is the paper, or, yeah, so
So we, let me show you this. We have done some kind of separating out of various groups. So there's some questions in the survey about, people who are kind of highly satisfied with their opportunities for advancement at their current job. This doesn't seem to operate on at all. Whereas people who are less satisfied have this kind of stronger effect of inflation expectations on search. So this is something that we're very interested in, kind of who is it exactly that this is operating on, because we don't think that all workers are equally susceptible to this mechanism. And certainly this result seems to suggest that people who are very happy in their match are not going to be pushed out by expectations of inflation.
Thanks. There's Gaetano and then Michael.
Hi. I have a fuzzy memory from my previous life in central banking that we were looking at the cost of labor in Germany as a predictor of general level inflation. And I think your story requires the other way around, right? That the wage inflation is lagging consumers' price inflation. Can you say anything about this? Thanks.
I think that, so we are going to be really we're really looking at just the partial equilibrium effect here. So I think this is good to bring up, right? But the idea of the kind of spiral, right, would be that both could be happening. So I think, yes, this would imply that wage inflation would be kind of lagging price inflation, but there's also this expectations effect, which means if people expect inflation, wage inflation could follow first. So if my expectation is kind of strong enough and I do actually make a job-to-job transition and get, a higher wage, you could think of that labor cost as driving up inflation.
Okay, thanks. Michael has a question then.
Very nice talk. Thanks, Jane. Quick questions like, do you know whether those that are not employed, whether they are on benefits that have an automatic cost of living adjustment, which might explain why you don't see this effect of inflation expectations on search for them? And maybe just a suggestion, given that in the SCE, a big chunk of the variation is also due to panel conditioning, which I would expect is actually unrelated to search behavior. Maybe you actually might want to add fixed effect on the number of rounds people participated.
Yes, so we do
SCE.
actually include a 10-year fixed effect to kind of control for that panel conditioning. So your question about the kind of indexing of this unemployment or non-employment benefit to inflation, this is something that we're really interested to know. We're kind of digging through the SCE to see if we can find anything for people who might have kind of some indication that their benefits or their wages are currently indexed to inflation. So in our model, we treat the benefit as indexed to inflation. But I think this is a really kind of relevant thing to think about, that, if the benefit is also eroding with inflation, this would incentivize non-employed people to search as well.
Thanks, and we have. Okay, same question. No questions from the chat at the moment. Anybody, please? I might ask myself, so in the empirical part, you use the kind of wage increase coming as a result of going to a new job, but then in the model you also talk about the possibility that it's like the search is a threat to get a raise in the current job, and I guess you wouldn't have data on that, but would you have any idea how important empirically that part would be?
Yes, so this is something that we're trying to see if there's a lot of supplements in the SCE, if there's anything we can kind of exploit to see if these people are getting a raise at their current job, so having some sort of increase in wage without moving. But this is kind of what we hope to do with the model, is there are these kind of two ways that you can affect a raise here. You can move to a new employer, and in the model, moving to a new employer always involves an increase in productivity, or you can extract a wage from your current employer, and that could potentially be a purely kind of inflationary raise where your wage goes up only in response to the price level. So what we want to do with the model ultimately is kind of characterize how important are those two things, which one seems to be happening kind of more, kind of what do the different channels of the wage increase look like? Okay, thanks a lot. Thank you. I think we are right on time, so thank you very much, Jane, for joining us, and very interesting paper indeed. Thanks. And we come to the conclusion of this first session. Thanks again for all the speakers and active participation from the audience. So we have a 15-minute break now, and then we reconvene for Governor Rehn's policy keynote at 11 o'clock. Thank you.
Good late morning to all of you from my behalf. I have a pleasure to chair this next session and the policy keynote, which will be given by Olli Rehn, the governor of the Bank of Finland. Olli Rehn is a member of the ECB's governing council, as you very well know, and one of the key persons on deciding on monetary policy in the euro area. During last more than a decade, and especially in the aftermath of pandemic, we economists at the central banks, and certainly also in the academia, have struggled to understand the inflation dynamics and devise policies that will take inflation back to our targets at, say, reasonable cost to the real economy. Olli will, in the next presentation and keynote, give his perspectives to current monetary policy making and inflation dynamics. Let me remind you that Olli will take some questions after his talk, and those of you that are online, you can put your questions on chat. Now, Olli, the floor is yours.
Thank you, Juha. Ladies and gentlemen, dear friends, good morning, everybody. Both of you who are participating here in the museum and those of you who are taking part in this conference online. On behalf of the Bank of Finland, let me welcome you to this conference on monetary policy in the post-pandemic era. It is jointly organized by the Bank of Finland and the Center for Economic Policy Research. Our collaboration with the CEPR in organizing annual conferences has a long and successful history, and we very much appreciate this cooperation, and naturally we hope and expect that this cooperation will continue for many years to come. We have already heard some excellent talks this morning, and we can look forward to more presentations by leading experts in the field later on, including Benjamin Moll, Sidney Ludvigsson, and Martin Schneider. It is probably a serious understatement to say that the environment for monetary policy has become much more challenging over the past year. Indeed, the need for high-quality research that can support monetary policy decisions can scarcely be overstated at this time. Only a little more than a year ago, inflation rates were still low across the globe, and the world was re-emerging from the pandemic. The main concern for monetary policy then was, as it had been for more than a decade, how to appropriately stimulate the economy in order to return to a balanced, sustainable growth path and raise inflation to its target. Before the Governing Council meeting in December 2020, both the interest rate expectation curve and average government bond yield curve were negative for up to 10 years. As this year, 2022, began, both the ECB Governing Council and the markets still had good reasons to assume that oil prices and supply side bottlenecks would gradually fade away. In November last year, 2021, euro area inflation had reached 5%, or exactly 4.9%, with a forecast of 3.2% for this year. So that's less than a year ago. The forecast was 3.2% this year. Towards the end of last year, the central bank's assumption of temporarily elevated inflation was already increasingly being challenged, especially in the United States. This was due to inflation creeping steadily higher and the repeated underestimation of inflation by all central banks. Inflation forecasts at the time used the futures prices of oil, gas, and other energy sources and raw materials, but these did not keep up with the widening consequences of Russia's war in Ukraine and the subsequent sanctions. Also, the models used for forecasting purposes typically assume that past shocks that impact the economy will gradually fade and the economy will return to a steady state where inflation does not deviate from the target. This goes for, I would say, all or at least most of the central banks and I believe other forecasters as well. Today we are in a very different situation. Russia's unjustified brutal war in Ukraine that started on the 24th of February has been a watershed for Europe, but it took a while until its full consequences for the economic and inflation outlook were realized. Against the backdrop of first a post-pandemic rebound in demand and then Russia's war in Ukraine and the rising energy prices, inflation made a comeback, a more rapid and forceful comeback than was anticipated. Inflation is high also because of soaring food prices, the emergence of demand pressures in some sectors as economies are reopening, and the perpetuation of supply-side bottlenecks. According to Eurostat's flash estimates, the annual inflation rate in August was above 9% in the euro area, 9.1%, and 7.6% in Finland. The ECB staff's new September forecast also reflects a substantial upward revision from the June forecast, with euro area inflation now expected to average 8.1% this year, 5.5% next year, and 2.3% in 2024. Of course, there is pervasive uncertainty in these forecasts in these days, and risks to the inflation outlook are primarily to the upside. At the same time, despite a strong first half of the year this year, output growth in the euro area has started to slow down, with the economy expected to stagnate later in the year. The euro area economy is now forecast to grow by 3% this year, 1% next year, and then rebound to 2% in 2024. Again, plenty of uncertainty, of course. In the global economy, risks to growth are in the first place to the downside, especially in the near term. Exceptionally high energy prices are now reducing purchasing power, and supply-side bottlenecks are still constraining economic activity. What's more, the adverse geopolitical situation is weighing on the confidence of both businesses and consumers. What does standard economic reasoning advise in this context? It generally calls for monetary policy to pay little heed to supply-side forces, but the inflationary effect of current supply-side disruptions is more persistent than originally thought. Price pressures now are spreading across more and more sectors, in part owing to the impact of higher energy costs across the whole economy. Even after removing energy and food from the headline measure, the forecasts for underlying or core inflation in the euro area are at elevated levels, around 4% this year, above 3% next year, and above 2 still in 2024, 2.3%. Because inflation is already far too high and likely to stay above a target for an extended period, the ECB Governing Council began a tightening cycle in July by raising our 3 key interest rates, policy rates, by 50 basis points. Last week in Frankfurt, the Governing Council decided to raise these policy rates by an additional 75 basis points, and we assume further rises going forward in the course of the rest of this year. However, the impact of the current energy crisis on inflation should gradually subside after energy prices have reached their peak levels. The bigger question, therefore, is whether there are signs that demand-side forces are also starting to create further upside pressures on prices. In my view, there are at least 3 such forces to consider, and I take these in turn. We can then discuss this also in the Q&A session. The first of these demand-side forces is related to second-round effects in the labor market. Real incomes have weakened in most advanced economies following the pandemic. Deglobalization as well as the war in Ukraine are putting further pressure on real incomes, and thus wage price dynamics could become a serious concern. Yet we have not seen strong signals of such dynamics until now, so far. It should be noted, however, that we are somewhat in the dusk when it comes to wage-related data. For instance, the latest figures on wages are from the second quarter of this year. To get more timely and granular information on wage developments, the ECB is currently developing a wage tracker. The idea of this ECB Weights Tracker is to collect granular member state-based data on negotiated wage growth, which would provide forward-looking information on future wages and facilitate better informed decisions by the Governing Council. Why is it that the current picture does not suggest strong upward pressure on wages? Can we rely on this situation to last going forward? As you certainly know, there is a major difference between the euro area on one hand and the US labor market on the other hand. The US labor market is red hot for the moment. In euro area, we have shortages of labor in most of the countries, most of the member states, but still, for instance, vacancy to unemployed ratio is in the US for the moment it's 2 to 1, while in Europe is on average 1 to 2. So there is a very significant difference in the labor markets between the two jurisdictions for the moment. So why is this in Europe? So a benign interpretation could be that the absence of wage inflation reflects strong anchoring of longer-term inflation expectations. Another possibility is that there might be significant non-linearities in the Phillips curve. Perhaps strong wage price dynamics are absent when uncertainty is high. That's one option. Or perhaps wage earners have learned over the past decade not to pay too much attention to inflation when forming their expectations, though they may now increasingly be doing so. The growing risk of recession in the euro area and the steadily increasing labor participation rate might also be factors that have kept wages in check. Whatever the correct explanation for the slow reaction in wages so far, improving our understanding of wage setting is, in the current environment should be very high on the research agenda. The second force that can affect price stability is public indebtedness. The level of public debt in many jurisdictions has increased rapidly because of the pandemic, and factors such as population aging will increasingly put further pressure on our public finances in the Eurozone. Clearly, it is of paramount importance that sufficient fiscal restraint and debt sustainability should be key priorities going forward. This is also a necessary condition for the long-term viability of our monetary policy strategy. In this sense, fiscal policy and monetary policy are certainly interacting and, if not working hand in hand. In periods when the natural rate of interest is low and policy rates are at the effective lower bound, the importance and effectiveness of fiscal policy in stimulating the economy is heightened. But once the economy is well on its way to recovery, fiscal policy should take a backseat and governments should regain fiscal policy space by consolidating public finances. This means reducing budget deficits and boosting potential growth, for instance, through structural reforms. Currently, as inflation has become a serious threat to the economy and monetary policy is being tightened, fiscal policy should focus on debt sustainability. And thus, also the envisaged and justified support measures of households due to the energy crisis should be targeted, tailored, and temporary. Heterogeneity among the euro area countries regarding their fiscal positions poses an additional challenge as it increases the risk of financial fragmentation. To ensure that the monetary policy stance is transmitted appropriately across jurisdictions, the ECB Governing Council decided in July on a new monetary policy tool, the Transmission Protection Instrument. If deemed necessary, it would allow the Eurosystem to purchase securities on the secondary market in jurisdictions that experience an unwarranted deterioration in financial conditions according to certain specified criteria. And this brings me to the third and final force, namely the formation of expectations, for long a central research topic in macroeconomics. Ultimately, the risks to longer-term price stability, whether resulting from wage price dynamics or perhaps from fiscal concerns, is linked to the risk that inflation expectations could become de-anchored. The risk of de-anchoring in turn rests critically on the way expectations are formed. For instance, fiscal dominance might become an issue if economic agents begin to emphasize the connection between fiscal sustainability and inflation and form expectations about inflation based on perceived fiscally irresponsible government behavior. Needless to say, independent central banks like the European Central Bank will not give any space for fiscal dominance. Similarly, adverse wage price dynamics would become a serious concern if wage earners assume that current high inflation will indeed persist. Obviously, the central bank's task is to dampen high inflation expectations if such a scenario were to seem probable. So, what do we know of how agents form their expectations? A recent review of the literature on expectation formation by Francesco de Assunto, Ulrike Malmendier and Michael Weber in their recent research highlighted systematic deviations from the full information rational expectations paradigm. Inflation expectations are biased, forecast errors are predictable, and dispersion of expectations across individuals is substantial. Nevertheless, inflation and other expectations still matter for agents' actions. My reading of these findings is that agents react more gradually to new information and place greater weight on current outcomes than is suggested by our baseline frameworks. If this reading is correct, and I'm sure Michael will tell me as he's here today, we should factor in prolonged periods of learning and adjustment before behaviors do change. What then are the monetary policy implications of the three demand-side forces that I have highlighted? Elements of expectations formation that rely not on forward but backward-looking information can make it harder to return to target if inflation becomes entrenched. This obviously means that there is no room for complacency in monetary policy making. And indeed, in our meeting last week, we decided to raise policy rates significantly in order to front-load the transition from the highly accommodative rates towards levels that will ensure the return of inflation to our symmetric 2% target over the medium term. On the other hand, fears over adverse wage price dynamics and fiscal dominance should not be exaggerated at the current juncture. Anyway, together with the many other uncertainties and unknowns, these factors call for a consistent and steady tightening cycle. In essence, we've been exiting a period of forward guidance and are entering a period of making decisions meeting by meeting on the basis of incoming data guided by our current monetary policy strategy, recently adopted monetary policy strategy. Regarding the monetary policy strategy, some have wondered if the old asymmetric target might not have served us better in light of the rapid return of inflation. It seems to me very unlikely that the move to a symmetric 2% inflation target over the medium term is in any way a significant force behind current inflation. If anything, having an inflation target that is clear, easy and unequivocal to understand helps temper inflation expectations. To conclude, I have underlined some of the challenges facing policymakers in the current, let's say, post-pandemic and energy crisis environment. If we keep an open mind and continue learning the lessons of this new geopolitical, geoeconomic, energy-related environment, I'm confident that we will be able to get our policy right or if not always 100% right, then at least as little wrong as possible in the tough times going forward. And research, of course, will have an essential role to play in and contribute to this constantly evolving policy process. So with these words, let me wish you a very productive and fruitful conference, and thank you very much for your kind attention.
Thank you, Olli, for this very useful and interesting insights to inflation dynamics and also to current policy decision making. We have now a few minutes time to take questions from the floor or from the online participants. Who wants to start? And Michael.
You mentioned something about real wage growth and inflation expectations. So wouldn't you expect, I mean, isn't it very surprising that it's just now looking back, inflation is at 10%, so people's real wages have fallen a lot. So even irrespective of what you expect in the future, you would anticipate workers to require some compensation for that their losses already. So I understand that it's good to anchor expectations, but even if they expect 2% inflation in the future, I would expect the workers to require 10% wage increases to compensate for the losses over the past year. And it also seems very, why do this, it's the same at Norges Bank, but I used to work there. We always used to bring our inflation projections back to target at the end of the forecast horizons. So it sounds like it's the same thing going on at the ECB. So what Norges Bank at the end, after 15 years over always doing this, always getting it wrong, and at the end it was more like a laugh, then no one took it seriously because it's already brought it back to target by construction, not because anyone believed in it. So they just expanded then the forecast horizons that they published to make it all more credible in a sense. So then we typically see that then certainly it was okay to have inflation forecasts that didn't come back until say 5-6 years. So maybe that's, I don't know, is that something they're considering to do at the ECB as well?
Thank you very much for your comment and question. We are indeed discussing the say, if the word is right, accuracy or say the viability and or rather the framework of assumptions of our forecasts. And it is quite clear that, as you rightly pointed out, that over the recent past, both in the low inflation environment, which lasted for around a decade, and now in the more recent high inflation environment, we've seen that the economic forecasts tend to surprisingly converge to 2% over the medium term. I think we just have to take that with a plenty of pinch of salt, not only with a little, but plenty of pinch of salt. And it is in a way built into the models, and that's something that I think also the research community could contribute in order to improve our models in this regard. This was, by the way, the case both when, as I said, when we had lower inflation than our target, they somehow from below they converged to the 2% target in the medium term, and now we see a convergence from upwards. Having said that, our analysis in last week's meeting, for instance, was clearly such that the medium-term forecast plus inflation expectations now are worrying, and that was one element in our decision making when we decided that we will continue a consistent and steady course in the tightening cycle with a significant rate hike last week.
Michael's question.
Thank you so much for a very interesting and insightful talk. So, like, I definitely think that the ECB has done the right steps and is highly welcomed by Germans for sure. But to which extent are you concerned that there might be negative effects of now a rapid rate increase for more debt load in countries like Italy, or for example also let's say, given that we have now supply chain bottlenecks also still contributing to higher inflation, that higher interest rates might actually partially kind of mute the necessary investments in LNG terminals and green energy supplies, so and to which extent do you think actually maybe even fiscal support might be required? So one could think about tax hikes to offset aggregate demand and reduce demand rather than through interest rate increases. What are the discussions in the council on these type of aspects?
Thank you. There is indeed a certain dilemma in monetary policy making today, and there is kind of cross-cutting, even contradictory arguments or challenges for the moment. But clearly we see that in the context where inflation is 8% in the euro area, or 9% for the moment, and our forecast still for next year is above 5%. There is a case of front-loading the tightening cycle in this context. As regards the bottlenecks and other elements in the supply side, which you touched upon in your question, it is currently so that we are seeing also some contradictory tendencies there as regards the persistence of inflation, so that on the basis of discussions both in the ECB Governing Council, and we also had our global economy meeting over the BIS Monday this week, which gathers globally central banks around the same table. And I would summarize the situation concerning the supply side so that there is a visible, although not perfect, easing of supply side bottlenecks for the moment in general as regards global value chains. But at the same time, especially in Europe, the pressures of the energy crisis are keeping inflation up, and for the moment these countervailing forces are in such balance that it seems that the energy crisis is dominating over the gradual easing of the supply side bottlenecks. And as you mentioned, the green transition, the energy economy green transition, it is true that it's quite likely that because the investment needs are so vast that we are going to see quite significant bottlenecks in that area because simply because of shortage of competent experts and the need for education and training in this field. So it's going to be a major challenge to speed up and advance the energy economy green transition, which is necessary, but as I said, challenging both from the point of view of finding the resources for investment and also having competent people to the sufficient in the sufficient numbers in that field. So that's currently the situation as regards the, let's say, the supply side pressures. And as said, we have concluded that in the current juncture, when we have both challenges as regards the risk of a recession increasing and the challenge of galloping inflation, so our task as the central bank is now to do our job and focus on price stability, and we do that in a way that we front load decisions in our tightening cycle. I know that one of the issues you have in mind is the question of are we in a kind of a deep-rooted stagflation that goes to the bones, to the depth. And I think that's a very valid question. And there's one issue which I've been wondering and trying to think through and clarify in my mind recently, and that is the role of the energy economy in inflation and possibly stagflation or stagflationary tendencies. I wrote a blog half a year ago in spring-winter. That's a concept, very Finnish concept. That's something between January till June, but that was around March or April. And in that blog, I argued that the situation is quite different today from the 1970s, post-oil crisis, post-Yom Kippur stagflation, which lasted for many years in the 1970s, largely because our economies are, in relative terms, less dependent on fossil fuels today than in the 1970s. I don't recall the exact figures, but there is a significant, although not dramatic, drop in our dependency on fossil fuels. Well, that sounds fine, but on the other hand, our economy has grown in the past 50 years quite substantially, and absolute numbers, absolute figures also do matter. So we've seen that in the past half year since the start of the war, especially that we are regrettably and unpleasantly very dependent, or have been very dependent in Europe from Russian fossil fuels. And in a way, my argument half a year ago doesn't fully stand today, in my view. One has to learn one's lessons in this regard. And of course, that's largely because of some member states have decided to, or decided 10 years ago or previously to lean on Russian gas, and now we are paying the price for those decisions. I only hope that, and that's maybe last thing I will say. I know that we have to go further in the program, but today really crucial for inflation, for monetary policy, and for our economy in general is whether and how the European Union can resolve the energy crisis, or at least mitigate the effects. And one of the key issues is how do you delink the European electricity market, like the Nord Pool in the Nordic countries, the Nordic electricity market, where we are seeing astronomical prices, consumer prices today, because of gas dependence in some member states in Europe. And gas is now the benchmark for the electricity market. So it is absolutely necessary that we delink the electricity market one way or another. You have different ways of doing it, one way or another, from gas prices as the dominant factor. I have to add still to the 1970s comparison that there is another major difference. Our economies are stronger, employment is in good health, and the banking sector is, banking and financial sector is much stronger than for instance, before the financial crisis. So we can withstand headwinds better thanks to these better fundamentals we have now in the European economy. Thank you very much.
Thank you, Olli. It would be very interesting continue this exciting discussion, but I'm afraid we have to conclude. So please join me to thank again Olli for coming and giving the keynote.
Thank you.
We have now left about 5 minutes for a very quick coffee, and then we will continue at 45. Okay, so welcome back from very short coffee break. Now we will continue with the Professor Benjamin Moll from the London School of Economics. Benjamin will talk about asset price redistribution, and he's particularly interested in what are the welfare consequences of asset price changes. Who wins and loses from a rise in asset valuations that we have seen in the past. I must admit that when I went through Benjamin's paper, I felt sort of jealous because his work is very well executed and the data that he's using is simply amazing. In the paper, he makes a statement that we start documenting the heterogeneity in welfare gains in full Norwegian population, if I understood it right. So no sample, but just the full population. Often here in Finland, we say that we have a very good maker data, and certainly we have, but this knocks us all off the board for the time being, at least. So, dear Benjamin, the floor is yours.
Thanks very much. Thanks for having me. Really great to be here. Thanks for actually looking at my paper. This is joint work with a lot of people, including Gisle, who is sitting there in the back, who actually has another paper on the program later on, so 2 papers, and then 4 other co-authors, including many of them from Norway, where our really good data is from. So I'll motivate this with some sort of secular facts, but as I'll say in a second, there are also some implications for monetary policies, given we're at the central bank, I guess, which I'll talk about in a few slides. So the motivation here is that what we've seen in a lot of countries, in a lot of asset classes, is sort of rising asset prices, in particular relative to the income streams generated by these assets. So rising asset valuations, so if you want rising price-dividend ratios or price-to-rent ratios for housing and so on. Okay? Here's one graph to show you this. This is for the US. This is sort of non-financial corporate businesses, and this is sort of the value of the stock market there, and then relative to the net profits generated by these firms. But you can get a similar graph for lots of other asset classes, basically. Okay. And these valuations, they've had large effects on aggregate wealth accumulation and the distribution of wealth. Okay, in particular, there's some references there. So, for example, rising aggregate wealth to income ratios have been linked to rising asset prices and also rising wealth inequality to a certain extent. Okay. Now let me link to monetary policy briefly. So if you want to think about these valuation effects, I think actually one good thing to have in the back of your mind is basically that these could be due to falling interest rates. Okay, so one prime driver of rising valuations could also be expansionary monetary policy, or I guess if you have a contractionary monetary policy like interest rate hikes, like we're starting to see now, that would have the opposite effect, right? So empirically, you know, there's I think a fair amount of evidence that when interest rates fall, asset prices tend to rise. So in particular, stock prices very quickly, house prices maybe with a lag, and this is sort of primarily due to sort of the effect on discount rates. Not so much the cash flow, so valuation effect. There's a lot of empirical literature on this. And then, you know, as a result of this, the expansionary monetary policy is often associated with sort of rising wealth inequality, say. And that's not our prime, you know, application, but you can use our way of thinking, our framework, to think, you know, how should we think about that? You know, is that a good thing or a bad thing, and so on. Okay. So here's the main question we want to ask, which is basically, what are the welfare consequences of such asset price changes, you know, these valuation-driven asset price changes, and in particular, who are the winners and losers? And I want to sort of say the answer is not obvious, and there's sort of 2 polar views regarding these effects on asset prices and the resulting effects on wealth inequality and aggregate wealth accumulation. Okay, there's sort of one view of the world, which is when these valuations increase, this is a large shift of resources towards the wealthy. Okay, And then often as a next step in the argument being made is then, okay, therefore we should tax these guys, okay? So either a wealth tax or a tax on unrealized capital gains. Maybe you can call it sort of the Piketty view of the world, if you want, okay? There's a sort of a polar opposite view, which is, no, these are just like welfare irrelevant paper gains, okay? John Cochrane, for example, has written a blog post where he essentially makes this argument, and Krugman has made this as well, right? So particularly if you think about asset price increases driven by falling interest rates, the argument there is, well, nothing happens to the income streams generated by these assets, so like say dividends or rents, so this is just paper gains. The typical example will then be if someone never buys nor sells an asset, okay, and nothing happens to the income stream, then nothing's happened. It's like if my right arm increases in value, I mean, I'm never going to sell my right arm, so I can't, that's not going to help me. That's the argument there. Okay? So we're going to want to use simple theory to basically think about it, sort of which, if any, of these two views is right, or what's the right way to thinking about these welfare effects of asset price changes. Okay? And what we're going to do is we're going to develop sort of a simple formula for the sort of money metric welfare gains and losses that come from asset price changes. It's going to be a formula that holds in a sort of a class of models, and you can take to the data pretty simply. So I guess some people call this a sufficient statistics formula. I'm not sure whether I like that word so much, but I'm going to use it anyway because people, I think, know what it means. Okay? Here's what this formula basically looks like. It's going to say that basically, so it's going to be a formula for the money metric welfare gain of an individual I, okay? And it's basically going to feature sort of a forward-looking sum across time. Then there's going to be some discounting. Then what's going to matter, there's the net sales of an asset, and then there's going to be some price deviation, so these valuation effects, okay? And then there's potentially some other terms as well in more general versions of the formula that I'll come back to in a second, okay? And so if you look at this formula here, what you'll see is essentially, so what matters is basically not the asset position, but whether you buy or sell. So net sales here, right, are positive if you sell, they're negative if you buy, times the price deviation. So the first thing you can see there in this formula is that basically if someone never buys or sells an asset, okay, so net sales here are positive, for all these time periods going forward, then indeed the welfare effect of an asset price change here is zero. So that's the sort of a Cochrane logic, okay? But then on the other hand, it's going to say actually, essentially, who's going to benefit from asset price increases are going to be people who are prospective sellers of the asset, and people who are going to, be hurt by asset price increases are going to be prospective buyers of an asset. So let me give you some examples of what I have in mind here. The easiest thing to think about is house price increases, I think. So think about, so I live in London, I guess, where house prices have gone through the roof. So think about someone who bought a house in London in a nice area sort of 30 years ago, and the house prices have increased a lot. That person is now close to retirement, and maybe they sell the house and downsize to a smaller house or flat somewhere else, okay? And they cash in on these like large house price increases. That would be exactly a person where these net sales here are largely positive. The price deviation is very large, and so that would be a seller who's benefiting a lot from the asset price changes. So an old person maybe who's close to retirement and has held this house for a long time. Okay. On the flip side, think about some old lady, I guess, who just kind of has a house that she's never going to sell and just going to live in until the end of her life. For that old lady, the welfare gains would be sort of zero. Okay. Or think about maybe a young person who still hasn't bought the house yet. Okay. There, through the lens of our formula, going to say they're actually going to lose from the rising asset prices. Why? Because they still have to buy the house. Okay, so they would be prospective buyers of an asset, and then when the prices go up, that's going to hurt them. Okay. I should have said 2 more things. So where's this formula going to come from? This is basically going to be an application of the envelope theorem. Okay, and this is going to isolate basically first-order effects of asset price changes. There's also some second-order terms that would be here, sort of in the plus ... a term. We can talk about those later. Okay, that's kind of important. And the second thing is this baseline formula leaves out some effects. In particular, it leaves out effects of such things as collateral constraints, whereby if you have an asset price that increases, maybe you can borrow more, and that alleviates borrowing constraints, and that increases your welfare because of that. Okay, we'll talk about this later. Then you get an extra term here, basically. Okay. Okay. So when we take this to the data in practice, I'll talk about this in detail. We're going to basically have an empirical challenge, which is how to isolate these sort of valuation effects. And the way we're going to do that is we're going to just, where it says here price deviation, we're going to put percentage changes in price dividend ratios or price to rent ratios in the case of housing. Okay. So the idea is here, this formula here basically holds for price deviations holding cash flows constant. So we want to kind of isolate these valuation effects, and we're going to do that by taking how much asset prices have increased relative to the cash flows generated by these assets. Okay? So when you look at this formula, there's sort of 2 main lessons that come out of this. I've already kind of said some of this. The first is rising asset prices benefit sellers of an asset, not the holders. Okay, so what matters is your net sales, okay, your transactions, not your asset position. Okay, and the other thing that's going to come out of this formula, and that we think is kind of interesting, and why also our title is asset price redistribution, is that asset prices here are, at least in this benchmark formula, purely redistributive in terms of welfare, in the sense that this money metric, welfare gains and losses, if you sum this up across all peoples or across all I, they're going to average to 0. What's the logic there? So meaning basically for every winner there's a loser. What's the logic here? It's simply that at least in a closed economy, for every seller there's a buyer. Okay, and so then it's always the sellers who win and the buyers who lose, and so those asset price changes tend to offset each other. Okay. If you link this back to these polar positions I had on the previous slide, what we're basically going to say, and it's going to become clear when I show you the empirical results, is basically we're going to say both of these polar positions, so both the sort of Piketty position and the Cochrane position, if you want, are wrong. Okay, why? The Piketty position, that sort of rising asset price increases are a large redistribution towards the wealthy people, or holders of these assets. That's wrong because it's not the asset position that matters; it's the transactions that matter. Okay, if you never sell, then you don't benefit to first order from the asset price increase. Okay, and I'll show you later. Empirically, this makes potentially a big difference. And then the second thing is the Cochrane position, that these are purely paper gains. That's also wrong. Why is that also wrong? It's because that's only correct if people never buy nor sell, so there's no trades. But empirically in the data, people trade a lot. Okay, so there's financial markets, people buy and sell a lot, and so that has, therefore, asset price changes have large redistributive effects. Okay. So when we take this to the data, we basically take this to this Norwegian administrative microdata. So we have a sort of a 20-year panel, as was said, sort of essentially on the entire population of Norwegians. I mean, okay, obviously you do have to, it's not like, perfect data, you have to drop some observations and clean the data a bit, but essentially all Norwegian households over 20 years. For the purpose of our exercise, what's important here is there's large valuation changes in Norway. In particular, interest rates have declined a lot over this period, and say things like price to rent ratios of housing have increased a lot. Okay? Then what we do is we take this kind of a sufficient statistics formula to the data. So the nice thing here is that everything in this formula basically is something we can observe in the data. Okay? The other thing I should have said, so on the previous slide, I had a version with just one asset. Okay, what you can do is you can generalize this to multiple assets. So here K denotes different assets, right? So one, K equals 1 would be, I don't know, housing. K equals 2 would be stocks, and so on. And so that's the formula we're going to then take, and we're going to take that to the data. And then the nice thing is that we have this really nice data on financial transactions. So, we see all housing transactions and so on, say, at the individual level over this 20-year period. And then we see the valuations, and we just plug these things in, and then we get the welfare gains for each individual out there. Okay? And then we're going to just, A, look at the heterogeneity in these welfare gains and losses, and then B, we're going to, see who are these guys who win and who are these guys who lose. Okay? So just as a preview of the results, the first thing is rising asset prices. I've already kind of anticipated this a bit, do have very large redistributive effects in terms of welfare. So generate large welfare gains and losses. Here's a histogram to show you this. This is the welfare gains and losses generated by asset or valuation changes over this 20-year period for which we have data. And what you can see there, this is even sort of chopped off at the tails. This is a histogram. You can see there's a large spike close to 0, okay, in these welfare gains and losses. So there's some people for whom asset prices through the lens of our sufficient statistics formula don't make a difference. Why is that? That's the people who never buy nor sell. Okay, so asset transactions are 0, so that's the spike here at 0. But then at the same time, there's also there's a large right tail and a large left tail. Okay, some people here lose the equivalent of 150,000. This is sort of in US dollars, essentially, of 150,000 US dollars. If you really look out in the tail, there's even much larger numbers out there, like -1 million or something like this. And similarly, some people win a lot of this. Again, these are people who sell when the asset prices are high, and these are people who, or buy when the asset prices are low. These are people who buy when the asset prices are high or sell when the asset prices are low. Okay. And then the other thing we do is we sort of project these welfare gains and losses on some observables and see, what matters. Who are these people? Again, the most obvious one that comes to mind is basically age. Okay, right. So I had this example before of an old person who has a house that's appreciated a lot in value and then can downsize and retire. That's who's going to win, and a young person who hasn't yet bought the house and is going to lose from the rising asset prices. Those type of patterns you see exactly in the data, right? So this is a graph I'm going to show you later, which has essentially age or sort of cohort on an x-axis, welfare gains here, and this is a 0 line, and you see this sort of very strong life cycle effect. So basically the rising asset prices redistribute from the young guys towards the old guys. The young guys lose, the old guys win. Okay. If you look at where this comes from, I'll talk about this. Most of this is due to housing, essentially, with an offsetting effect due to mortgages, basically. I'll come back to that. Okay, so let me try to explain to you a little bit, where the sufficient statistics formula comes from, and then I'll talk about the data and how we implement it. I'll build up the intuition first in a very, very simple 2-period model. Okay. In particular, what I want to get out of this model is I want to convince you that the thing that matters is not the asset positions, instead it's the transactions, okay? And the other thing I want to show you is sometimes people have this intuition, okay, you have some assets, those assets have a price, so that's your wealth. Your wealth goes up. How can that possibly be bad for you, right? Okay, I'm going to show you in a very simple 2-period model. Yeah, if the price goes up, that can actually be bad for you, even if you hold some assets, okay? Okay, so here's the model, okay? Again, there's just 2 time periods, 0 and 1. There's some exogenous incomes, Y0 and Y1. This is just a problem of a single individual, so it's complete partial equilibrium, just like, just one single guy. that individual can trade or buy and sell some assets. So for concreteness, let's say stocks, so they can buy some shares at time 0. That those shares pay some dividend D at time equals 1. And here's the problem of that individual. Okay, so it's really sort of textbook undergraduate stuff. So the person maximizes present discounted utility from consumption, subject to this budget constraint here. So this budget constraint just says consumption plus saving equals income. Right? These are the net asset purchases in the first period, and then in the second period, if you carried over some assets into the second period, you're going to get some dividends here, and you're going to get some additional income. Okay. Now, now let's think about the following question, right? Let's think about the question: what happens if P0 goes up? Okay. If P0 goes up, what happens to that person's welfare? And again, like the intuition that some of you may have is, oh, well, your initial wealth is N0 times P0, well, N-1 times P0. So if that goes up, that must be good for welfare. I'm going to show you that's sort of not true. Okay. Now, how can you get the effect of the asset price change on welfare? Well, it's very easy. You just use the envelope theorem, right? You differentiate V with respect to P0. Okay. And so that's what we're doing here. And you get this very simple formula. You can sort of almost do it in your head, right? You can see P0 is the only place where P0 shows up is sort of here. Okay, you differentiate this. You get that the change in welfare is basically marginal utility. And then what you can see is you pick up this term here, asset sales times the price deviation. Okay. What you can see here, so let me say one more thing. Importantly, what we're doing here, right, is we're holding constant when we're changing the asset price, the cash flow of the asset, D1, okay? And that's going to be important, okay? But so when you do that, so an asset price change without corresponding cash flow change, and you're going to get this formula. And what you can see here is that, again, what matters is the asset sales, okay, not your asset position. So again, intuitively, rising asset price benefits prospective sellers of an asset and hurts prospective buyers of an asset, okay? Now, obviously, this is an envelope theorem, so this is first order effect. There's second order effects as well. We can talk about these later. And then B, if instead you had that the cash flows of the asset changed at the same time, you get an additional term, okay, which would always be positive. So obviously, if you have an asset and the cash flow of the asset goes up, that's always going to be good for you, okay? But the key point here is, if the cash flows don't change, like for example with monetary policy, then when the price goes up, it really depends on whether you're a buyer or a seller. Okay. I've already said a lot of these things. So again, the rising asset price benefits sellers, not holders. Here, this is something I want to sort of emphasize. So again, some people will have this intuition. So how can it be that initial holders don't benefit from an increase in the price, okay? And essentially the logic here is there's sort of two counteracting effects, okay? The first one is the one that everyone has in mind, okay, which is the return of the asset goes up from period 0 to period 1, okay? Right, because the price goes up. And so that's a positive effect on welfare. On the other hand, though, there's an offsetting effect, which is and that's the one that most people forget about or often forget about, which is when the price goes up, that means the return of holding the asset going forward actually goes down, okay? And now it turns out that for sellers, the first effect, the high initial returns dominate. For buyers, the low future returns dominate. And if you have someone who neither buys nor sells, so N0 equals to N-1, then the welfare effect is positive, is 0 exactly, right? I'm going to skip this. You can also do this graphically and look at the paper. This is literally your undergraduate intertemporal choice diagram, and you can see it like very intuitively how this happens. Okay. Okay. Now, when we take the theory to the data, the data are obviously more complicated. There's multiple time periods, not just 2. There's multiple assets and so on. So we're going to have a bigger, more complicated model. So our baseline model, where we get the cleanest formulas, is going to be a deterministic infinite horizon model. Okay, I'll talk about extensions in a second. One of them will be stochastic environment, basically, because for asset prices, I guess that's important. We're going to have different assets. Okay, we're going to have some liquid bonds, basically with some price that's going to give us a notion of an interest rate. And then importantly, and that's going to be where most of the action is going to be, we also have these long-lived assets like stocks and housing. Okay, these long-lived assets, which we're going to denote here by N, they're going to have these prices P, and those prices P are going to move around and give you a lot of these welfare effects. Okay, we're going to make a technical assumption for simplicity, which is that trading these long-lived assets is subject to some convex adjustment costs. Why do we make this assumption? The reason is that we here have a deterministic environment. If you didn't have adjustment costs, then you'd always get these kind of effects where if the return on one asset changes a little bit, then you're going to go way short or way long on these assets and take extreme positions. This is sort of to smooth out the asset positions that people take. Also, why is it a convex adjustment cost? It's because we're going to later take the envelope theorem, so we want something like nice and smooth. This is something you can maybe change or generalize. Okay? The return of an asset here obviously is sort of the dividend plus the capital gains basically on the assets here. Okay. Okay. I'm not going to have time to talk about this due to time constraints, but in the paper we do a lot of like generalizations of this. I've already mentioned some of these. Here's a whole list of them. Wanted to briefly talk about this one because this is one that seems important and people often ask about. So we do in the paper extend the formula for borrowing and collateral constraints. As I've already said in the introduction, you will then get an additional welfare effect whereby when people are constrained and asset prices go up and that alleviates their borrowing constraints, that gives you an additional welfare kick. What we haven't done yet, so that we have the theory for that, what we haven't done that is implemented that in the data. We're currently working on that. I think the right way to do that, and what we're just doing is to think about actually the channel sort of when asset prices go up and your net worth goes up, you may be able to get a better interest rate from the bank, basically. So rather than there being a hard constraint, it's like what interest rate can you get? And rich people basically get better interest rates when they go borrow at the bank. Okay, so that's kind of the idea, and we want to put empirical discipline on this. We haven't done that yet. Okay. So here's the household problem. I'm not going to talk you through all the details of this equation here. It's essentially just the natural generalization of this two-period model I had before. Okay, and then what we're going to do is exactly the same thing that we did in the two-period model. Okay, we're just going to throw the envelope theorem at it. Okay, and we're in particular going to differentiate the welfare of these households with respect to asset price changes, and we're going to get this kind of a formula here. Okay. And as I said, we're interested in getting money metric welfare gains and losses. Okay, so how much, how many dollars did you win, or what's the equivalent amount of dollars you won or lost from the asset price changes? And so we're going to basically focus on this red term here. So we're going to say essentially divide by marginal utility there. Okay. Okay. So here's sort of the baseline formula for welfare gains and losses that we're going to have. And starting to look a lot like what we had in the introduction, basically, right? So you can see there's some discounting, there's some net asset sales here, and then this is the short-term bonds for which, because it's a one-period asset, so the sales are essentially the same as the position. Okay. So the intuition for everything here is basically exactly the same as in the two-period model. Okay, you still have that rising asset prices benefit net sellers, not the holders of the assets, but it's a little richer. In particular, what you get is that there's a portfolio choice matters, and the timing of purchases also matters. Okay, this I've already said, right? The welfare gain, because it's a money metric thing, sort of like an equivalent variation. If you remember your consumer theory from Mascolel, Winston, and Green, say, how much do you value the price deviation, basically? Okay, and I've already said all of this. This is envelope theorem, and it's the first order effects. Okay, so let me skip this. okay, and go straight to the next result. So one thing I've said before is essentially that one thing that's interesting about these welfare gains and losses is that they aggregate to zero, so they're purely redistributive. So let me show you this, okay? So there's an immediate corollary that you get from the formula, which is if you sum it up across all people, and suppose you have a closed system in the sense that for every buyer there's a seller, so market's clear basically, then you can see immediately that all the welfare gains and losses have to sum to zero, right? So I guess I'm just saying this, right? So if there's i's on all of these, if you sum these up across all i's, then all the transactions in all these asset positions here sum to zero, and then you immediately get this theory. So asset prices deviations are purely redistributive. Again, what's the logic? For every buyer there's a seller, therefore for every winner there's a loser. That's it, okay? In a multi-sector economy, when you have government, corporations, and foreigners, the right way to think about this is not that welfare gains average to zero across households, okay? Instead, it's that they average to zero once you think about all sectors in the economy, okay? The other thing I should say, these are the money metric welfare gains and losses, okay, that average to zero, okay? If you think about the utilities, so the actual welfare relevant welfare gains and losses, that's no longer true that they average to zero, okay? Why? Because you have a marginal utility there as well, okay? And so in particular, it's sort of, right, I mean, if you think about this formula, or like think about this histogram that I had before, which had like 150,000 loss, say, or $150,000 dollar gain, it kind of matters who these people are who lose the 150,000. Is this like a poor person who has a very high marginal utility, or is this a rich person who has a low marginal utility, okay? So, just to be clear about this. Okay. Other thing to mention here, this is a question we often get. So what if so this is obviously all total partial equilibrium so far. What if you think in a bit more general equilibrium way? So in particular, right, where do these asset price changes come from? Okay. I said before, one good example to have in mind would be maybe falling interest rates, but where do the interest rate falls come from? And also, don't the interest rate changes have other effects as well that may be welfare relevant? Okay, that's kind of what I want to talk about here. Okay, so then the way to think about that is just basically think about some shock epsilon that changes the asset prices. Okay, the easiest to think about is actually just a discount factor shock. Okay, say discount rates fall, so the beta increases basically. That would, in a general equilibrium world, increase asset prices. Okay. But then the important thing is that obviously also has additional direct effects on welfare, okay? So then the way to think about this is basically, there would be some direct effects of whatever the shock is, say an increase in discount factors or a change in monetary policy. This could include, say, monetary policy stimulating the economy, that's good for wages, and so on. But then there's still always going to be this sort of redistributive effect of the asset prices. And that's the point we're focusing on here. Okay. Okay. So let me briefly tell you how we take this formula to the data. By the way, how much time do I have left? Just so I know roughly.
Few minutes.
Sorry?
Few minutes.
Okay. So we take this data, this to the data. The main thing we do is, rather than having infinitesimal price deviations like in the theory, we now have non-infinitesimal ones. Okay, we're going to argue that, for the price changes we've seen, the approximation error isn't that large. And then the other main thing we need to do is like isolate these valuation effects. So what we're doing is we're essentially looking for the change in house prices or asset prices, say, relative to the change in cash flows, right? So this is, for example, house prices in Norway. You can see they've increased a lot. This is what happened to rents in Norway, okay? And so what we're basically going to always look at is sort of the increase in house prices relative to the increase in rent, and we're going to call that the valuation effect here. Okay. When we do that, this is the formula we end up with. Okay. So now let me tell you how we implement this and show you some results. Okay. So here's the data we have for Norway. What's nice is that we have, again, this admin data covering the universe of Norwegians. We're going to focus on sort of the main asset categories of assets that people hold. And the main thing that's cool is that we have this sort of transactions registry, and where we see, say, for housing, all the housing transactions. Here's basically how we, calculate these things in practice. Let me skip this. Let me show you some graphs on valuations. Okay, this is what happened to house prices in Norway here. So house price to rent ratios, for example, and this is what happened to stock prices. So in particular for housing, you have these very large valuation effects. Another way of looking at this is to basically look at the yields, so the inverse of the price-dividend ratio, so here. And you can see that all the yields of the different assets, so say interest rates on debt and deposits have a strong downward trend here over this time period, which is exactly this kind of valuations effects that we're talking about. Now, we have this data on transactions, so let me just briefly show you this. This is housing transactions, for example, by age, and you can see, young people tend to sell houses, old people tend to buy houses, old people tend to sell houses. Okay, and you can already see that's going to, what that's going to do to the formula that I've shown you before. Okay, that's something wrong. Okay, let me skip this and show you the results. I've already shown you this. Okay, this is just to say there's a lot of heterogeneity. So this histogram is quite spread out. You can also do this in relative term, relative to people's initial wealth, and also percentage-wise, you get quite large numbers. This is a result I like because it shows you two things. It shows you just sort of how fat the tails are, and it shows you what asset classes are important here. So this is sort of the different percentiles of the welfare gains distribution, okay? And then this is the numbers there. So this is sort of a quantile function, if you want. And you can see, some people have these, and this is even chopped off. Some people have these welfare gains of $1 million. Some people have like minus $1 million, basically. And then you can see a lot of this is due to housing, essentially. Okay. Here's again redistribution from young to old. This life cycle thing. Again, where does this come from? A lot of this comes from housing. Okay. Young people get hurt by rising house prices because they tend to be prospective buyers of houses, and old people tend to benefit. There's an interesting offsetting effect, which is this red line here, which is that whatever the time period is in which house prices rise, it's also typically the time period in which mortgage interest rates have fallen, okay, and that sort of makes it a little bit less bad. Okay. Let me skip this. There's some interesting results across the wealth distribution. Across the wealth distribution, let me just say it in words, we do actually see that the richest guys tend to benefit in welfare terms, okay? But that's not a mechanical effect that they're rich and their wealth goes up. It's because rich people tend to be net sellers of assets, okay? Rich people tend to sell when the market's doing well, and so that's why they, win here. Okay. Here's another interesting thing, and I'm gonna kind of, after this slide, go to the conclusion, and that's sort of picking up on what I just said. There's a very interesting and we think important difference between sort of what you could call sort of naive wealth gains versus what we think are the welfare relevant gains, okay? So these money metric welfare gains, okay? So what's the naive wealth gains? The naive wealth gains is you just look at, people's asset positions and then multiply them up with the price changes, okay? When you do that, because the asset prices have increased, you get this gray thing here. Instead, the welfare gains look like totally different, okay? First of all, the wealth gains are way further to the right than the welfare gains. Why is that? It's just because most people tend to have positive asset positions, okay? But most people don't tend to be, sellers, basically. So there's not a one-to-one correlation. And then the other thing you see for the welfare gains is this fact that it's centered around zero, so and that there's some large losers as well, which is this redistributive effect. Okay, let me with that conclude. So what have we done here? We've put on the table, I think, a simple framework to quantify welfare effects of historical asset price changes, and there's an application to Norway. I've already, I think, made most of these points. Let me just come back briefly to monetary policy, okay, to conclude. So through the lens of our framework, what we would say, yes, if interest rates fall and asset prices go up, we would expect that to have large redistributive effects, or conversely, if interest rates go up and asset prices fall, it's the same thing. But it's much subtler than, interest rates fall, asset prices increase, wealth inequality goes up, the rich guys get richer, that's a bad thing, okay? It's much more that what matters is who's a buyer and who's a seller. Okay, let me conclude with that. Thank you.
Thank you, Benjamin. Very interesting. I'm sure that there are many questions to Benjamin. We have some time, at least 5 minutes. Who wants to start? Matti?
How should we treat bequests? Does it
How do we treat bequests?
bequests?
Yeah.
Do they really mean that we have really no sellers? Because then it's some sort of selling case between the generations. Okay.
Right. Yeah. So we have. I don't know if you remember. There was this list of extensions, and this is like one of our main important extensions. So yeah, obviously, bequests are very important in the data. So the first thing, there's two separate questions. One is how do you treat bequests, or how do you think about them correctly from the point of view of theory? Okay, and then the second thing is how do you treat them in the data when you take the formula to the data? Okay, the first thing, how do you treat them from the point of view of theory? Is the answer is it kind of depends a lot on. Well, okay, so the first thing is when you say you inherit a house, okay, then obviously you don't have to buy a house, okay, and so therefore you're going to be basically insulated, say, so right here from an asset price, from a house price increase, right? We have this thing that the young guys they lose from house price increases because they haven't yet bought a house, okay. Now, if you're lucky and you get a nice big house from your parents, then obviously you don't have to buy that house, so you're insulated from that house price increase. Then the right way to think about that is it's not like that changes our formula. So our formula is still correct because these guys would show up as not having a transaction, so they're not buying. But the right way to think about this is just that these guys don't win in welfare terms from the house price increasing, but they win relative to the people who lose, so relative to people who haven't yet bought the house and need to buy one. Okay? The other thing that matters with bequests from a theoretical perspective is what do you think about how people value the welfare of their offspring? Okay, do you have a perfect sort of dynastic model a la Barrow? If so, then our infinite horizon model is exactly correct. However, you can have other ways of thinking about it, sort of partial altruism, say, towards your children, or you can have these sort of warm glow bequest type functions. If you have that, then it's actually kind of interesting. It matters whether what you value as a person is how much housing, say, you leave your children in terms of like square footage, or how much the value of the house is. Okay, so if you care just about the quantity of the asset you leave to your children, then all the formulas are unchanged. Okay. However, if you care about how much is the house worth that you leave to your children, then you get an extra term in the formula. So that would be then also in this like plus ... thing that I had there. So that's that's basically it. Or more generally, I guess, if people just care about how rich they are, so the sort of Donald Trump story, where like they just have literally their wealth in their utility function, and they get a kick out of being high on the Forbes list, then I guess you get an additional term in the welfare formula. Apart from that, it's really just a measurement thing. You got to be a bit careful, like with the bequests. You got to be a bit careful when you look at asset transactions. You got to be careful that you don't pick up someone getting an inheritance as someone purchasing a house. But apart from that, that's basically it. Yeah.
More questions?
Yeah, so thank you. There's a lot of really interesting points in here. I had a maybe somewhat related question, like from the empirical implementation, thinking about when people enter the economy and like the young to old, because when you had the figures by age, it seemed like a lot of the net negative effects were like sub 20-year-olds, so like 10 to 20. So I was even just trying to think empirically kind of what's happening there, and it must be a relatively small like numerical percent of the population, or what's going on with that?
No, but so you mean this
yeah,
graph,
the
right?
initial age, and maybe I was just misunderstanding.
So the first thing is no. So these welfare gains and losses, they definitely always sum to zero. I think so we have different versions of this graph. I think what we did in this graph, and maybe that's not the best one to show, is that this includes actually. So this is the initial age in like 1995 at the start of your sample period. Okay, and this includes actually then some people who are sort of not yet born, say, or some people who are like 0 years old, and then they're going to also be losers because they're going to have to buy a house in like 2015 or 2020. So really, this graph sort of so there's more people sort of off the axis of this graph, if you know what I mean.
Okay, that helps clarify. Because I was like, I can't imagine too many 10-year-olds are getting housing yet. So okay,
So maybe age is the wrong word here. It should be cohort in a sense.
Michael.
That's super cool stuff for sure. I was wondering actually whether you also thought about a potential correlation between like the effects of changes in asset prices and my human capital, and how you would how this would potentially affect your welfare calculation, and then just in general also a few data clarification. So like, would you think about like taking out home equity as a kind of an alleviation of borrowing constraints, or also a potential way of kind of partially selling my house? And can you comment a little bit on the role of like cap T in your calculations? And also then somewhat related to, I guess, bequest motives. Like my understanding in Norway is there's what people call maybe a housing ladder. So like I graduate college with a small flat in Oslo, then the house price goes up, and through that I have an alleviation in constraints by a bigger house and so on.
Right. Okay. Lots of questions. Lots of good questions. Thanks. Let me start with the sort of empirical questions. And let me actually address the one with the cap T first, because that's relatively straightforward. So yeah, if you remember our formulas, then these welfare gains formulas always had an infinity at the top, and then when we took it to the data, we put a cap T there. So why did we do that? Well, the reason why we did that is because we have a finite sample, right, from until 2015, and then our data ends. What does that mean, or how much of an issue is this? Right. So what you want to do ideally is you'd want to follow everyone over their entire life cycle, I guess, and see all their asset transactions. Okay. In particular, right, the worry would be that what I told you, the life cycle of housing transactions, where people tend to buy when they're young and they tend to sell when they're old. So the worry would be that we're sort of overestimating the welfare losses of these young guys, right? Because we see them only buying and losing, but it could be in principle that they're later gonna sell and benefit from that, which would be an offsetting effect. So what we do about that actually is we sort of, with some extra assumptions, we sort of extend people's transactions out beyond the time period where we have data. So we sort of extrapolate. Say if I only see you until 30 in 2015, we use the transactions of other people like you to think about what's the likely outcome of your future transactions. And then we would be able to take into account that you're going to sell your house at 55 or something, and then include that in the welfare formula. So now you have to remind me what the other two questions were about the empirics. Right, but what do you exactly have in mind there, I guess? Yeah.
I was thinking about the welfare effects. Like, imagine like I work in a sector where, because asset prices go up, my, labor income goes up, lifetime labor income, and so like, this would then potentially kind of even alleviate, kind of like strengthen your effect versus like, I might work in a sector where, I'm hurt by higher asset prices and I'm a seller. So like, I was, maybe I lose my job, that's when I sell my house, the price is gone up, and so like, there's a kind of an offsetting effect on my labor income side because of the change in house prices.
Okay, I'd have to think more about this, but I think this would fall under the under this category here. So there's some sort of another shock that then happens at the same time as the house price shock, and then I guess if you want to get the full welfare effect, you'd want to take this into account. Now you're saying they may interact, sort of there would be sort of a cross term. I'd have to think about that. This is interesting. Thanks. Sorry, and you had some other data question, or
whether home equity.
Yeah. So the first thing is what's important in the formula, right? Is there's not just this term with the transactions. There's also this term here. So when interest rates fall and people borrow more. When interest rates fall, that's a direct positive welfare effect because it alleviates their budget constraint. Now, there's an additional effect, which is, I think, maybe what you have in mind on top of that is if you can take out, say a second mortgage or a HELOC, and like you can essentially tap into the equity of your house without selling it. And I think the right way to ask there is, does it alleviate borrowing constraints or not? Okay. And then you'd get an additional effect. If it's just that you take out a loan, which may be collateralized by your house in the time when interest rates are low, that's this term. But then there's maybe an additional effect when it alleviates your borrowing constraints. But so yeah, you don't want to just look at the asset transactions. There's some additional terms as well, I guess, essentially.
Okay. Thank you, Benjamin. I think we have consumed all the time, so let's join me to thank Benjamin again for excellent presentation. We have now a lunch break, and we will continue at 1:30, so about 50 minutes time to eat.
Shall I start? Okay, so let's not prolong the next session, which is on monetary policy and households. We have 3 papers, 90 minutes, 20 minutes for the talk and 10 for Q&A. So we'll start with Luisa Barzoka from Imperial College London, and take it away.
All right, hello everyone. Thank you so much to the conference organizers for including our paper in the program. So today I'm going to present our work on cross-country differences in household financial decisions, a structural approach with survey-based expectations. And this is joint work with Olga Goldstein-Frank and Georgi Korcharkov, both from the Bundesbank. And myself is from Imperial College. So our motivation for this paper started with a very simple question. What role do expectations about future macroeconomic outcomes play in household decisions? Now, the answer to this question is key in order to determine the effectiveness of policy measures, such as, for example, forward guidance, as the answer to the question essentially defines the link between household expectations and the decisions that households take. And this question is especially important in times like the ones we live in, where we have high inflation. Now, the theory provides a pretty straightforward answer to this question, namely that financial decisions today depend on household expectations about future prices and income. However, when we look at the empirical work around this question, the evidence is mixed. First, we see that the channel is not clear. So on one hand, there is no widely agreed upon process by which expectations are formed for households, as well as how they translate to their decisions. On the other hand, we also see empirically that there is large heterogeneity between household expectation formation and within a household. So you can have the same household under different economic conditions appearing to follow a different model of expectation formations. And on top of all this, it's difficult to isolate expectations from liquidity constraints, household income risk, as well as preferences. So what we do in this paper is use a structural model of saving and consumption under subjective expectations. And what we do is that we use the survey-based expectations of households, and we calibrate preferences and income risks in order to study the empirical patterns of their savings. In order to do this, we use a novel data set with monthly measurement of expectations and decisions for households across Europe. We document empirical patterns for the expectations of households when it comes to macroeconomic outcomes, specifically real rates and savings accounts and growth in the economy, as well as along the income distribution and in different European countries. We use these patterns then to calibrate a model that match them. And after doing all this, what we're able to do is do a set of decompositions. So what I'm going to show you today is that we decompose the effect of subjective expectations on household saving differences between countries and along the income distribution. And we have some different applications that we've considered up to now in the paper as well. So with respect to literature, we relate to broadly 4 strands of literature. First, of course, we have papers that look into models of expectation formation. We also relate to papers that look into household financial decisions and how they relate to macroeconomic outcomes, as well as different work that looks at sources of differential effect of expectations. And finally, of course, we relate to papers that look into models of consumption and savings. Now, let me talk you through the data we use. So the main data set that we use is the ECB Consumer Expectation Survey. This was launched in January 2020. It covers 6 of the largest economies in the euro area, so namely Belgium, Germany, Spain, Italy, France, and the Netherlands. The data includes household expectations, consumption, income, housing and other investment, as well as borrowing choices and labor market conditions. Importantly, this is a panel data set where expectations and consumption is collected monthly and income quarterly. We enrich this data set using the ECB HFCS, the Household Finance and Consumption Survey, which is a survey that covers demographics, wealth, income, and consumption of European households. And the reason we do this is in order to add the wealth parameter to our households, so where they sit along the wealth distribution. We do this by performing a synthetic match, which is done on the variables that are shown on the slide. So we have age, gender, education level of the head of the household, household size, whether a household owns or rents their residence, whether they have a mortgage, as well as the annual net household income. So let's start by looking at some empirical patterns that we see in our data. So here we've plotted the time series by country of the different variables that are of interest to us. So we have the expectations of households about economic growth, expectations about real rates on savings, as well as the saving rate, so savings over income at the bottom there. And if we want to make just some high-level observation just looking at this time series data, you see that there is an upward pattern of expectations about economic growth aligned with a relatively downward pattern of savings rates, which could reveal something like an income effect. So these households feel richer in their permanent income, consume more today, save less. And on the other hand, about when it comes to expectations about real rates on savings, you see that these are decreasing. Then we look at the same parameters, but now along the income distribution. And a few things to note here is that you see that there is some variability between countries, as well as you can see, for example, that the saving rate increases with income, as we see generally in the literature as well. And another interesting fact is that when you look at expectations about economic growth, for example, Germany had a very different view of the world, German households, than the rest of the European countries. So let me jump into the model and take you through how we've determined it. So we're going to look at infinitely lived households. They decide their consumption and savings in each period T. Their income is subject to both idiosyncratic and aggregate, permanent and transitory shocks, and they hold CRA preferences over their consumption. They live in incomplete markets, which we solve in partial equilibrium, with an exogenously determined interest rate on savings and a wage rate, also exogenously determined. Now, importantly, the expectations are survey-based subjective expectations about macroeconomic variables. So we do not impose any structure on belief formation. We take this fact straight from the data. However, these households do hold rational expectations over their shocks to their income. Now, for the household's labor income, you can see it's defined by Y, which is the product of the constant wage rate times the household effective labor. And household effective labor, in turn, is a product of transitory, idiosyncratic, and aggregate stocks, as well as idiosyncratic and aggregate productivity levels. For the productivity levels, they're determined by the two equations at the bottom of the slide. So you can see that for aggregate productivity, importantly, it grows by a factor uppercase phi, which is the aggregate productivity growth. And each productivity level in idiosyncratic and aggregate is a product also of idiosyncratic and aggregate permanent productivity shocks, respectively. So you can see for the income process, it's a relatively simple tractable process, but we still decompose the transitory and permanent components. To solve the model, the household has the Bellman form as shown. Note that in the continuation value, you can see that the expectation is over the income shocks. And when it comes to the future aggregate productivity growth and return on savings, this is what we get from the data, the survey-based expectations. For our calibration, we calibrate income parameters outside the model. So specifically for idiosyncratic income, we have this calibrated using survey income data. And for the aggregate income, we use the corresponding aggregate income data in the country that the household lives in. And the preference parameters are country specific and calibrated by matching median wealth and income of these households. Now, in order to do this, we use the balanced panel of households in the period that we have up to now incorporated in the paper. We mean to expand this. So this is September 2020 to March 2022. And the simulated households inherit their initial wealth and income from the data and decide their consumption using the subjective expectations from the survey, as I mentioned earlier. So these are the calibrated parameters that we have in our current version, as you can see on the slide. The top row, the beta row, of course, is the discount rate, and the row is the relative risk aversion. This is a slide just to show you the model fit. So this is the moment we target, as we said, the quantile of wealth to income, and you can see by different country the fit that we get with the current calibration. And now let me take you through one of the applications that we've considered up to now, which basically aims to answer how do subjective expectations lead to differences in savings among households for the countries that we consider. So in order to do this, we proceed essentially in 3 steps. For the first step, we need to create some benchmark, which will consider the European average. By European average, I mean, of course, for the countries that we have in our data. So we simulate saving decisions for a sample of households across Europe, and we use average levels of the rest of the parameters, so preferences and income risk. And then, of course, we can calculate the weighted mean of savings over income by income decile. This is our European benchmark. For doing the second step, so in order to eventually decompose the subjective expectations, we do a simulation again, but this time country by country, taking a sample of households that hold, of course, their subjective expectations as defined in the data. But again, we use European averages for preferences and income risk. So the only thing that changes is the subjective expectations by country and income of household that we consider. So now we can calculate the weighted mean of savings over income by country and income decile. So by deducting the European average from our second step of the simulations, we can have the effect of subjective expectations on savings for each country by income level as driven solely by their subjective expectations compared to the rest of the countries. So these are the results. A few first observations that we can make here by looking at these graphs is that for Belgian households, they save more compared to the European average for their subjective expectations. Germans save less because of their subjective expectations. Again, let me reiterate, this doesn't mean, for example, in the German case that they overall save less, but they save less as driven by their subjective expectations. And interestingly, in Italy and Spain, it's not so much of a binary result. So you can see that for Italian and Spanish households, depending on where they sit on the income distribution, it determines essentially whether they save more or less compared to the European average due to their subjective expectations. And one thing more that we can note up to this point is that for French and Dutch households, with the exception maybe of low-income Dutch households, subjective expectations make them differ less than the European average, as the bars are smaller essentially. So let me conclude that we've documented that saving rates across European countries differ in the cross-section and across time. To understand these patterns, we utilize an incomplete markets model of household savings decisions. And we saw that our model can replicate savings heterogeneity between countries, as seen by the matching of the moments. And finally, in the results that I've shown you today, we've seen how subjective expectations drive saving differences between countries and by income level. And what we've seen is that Belgian households of any income level save more due to their subjective expectations compared to the European average. The opposite is true for German households, so they save less due to their subjective expectations. And finally, for households in Italy and Spain, whether they save less or more compared to the rest of Europe really depends on where they sit on the income distribution. Thank you very much for your attention.
Okay, thank you very much. So, well, we have definitely more time for questions. So, who wants to be the first? Let Gisle speak first.
Thanks, that was very efficient and very interesting. I kind of missed, did you say anything about the mechanisms on this last point there? So why is it that Belgian households save more due to expectations and so on? Is it like, I guess in the model there's a precise mechanism?
So that's what we want to do moving forward. So essentially, because we have this setup, the first thing that we can do is try to understand whether it's driven from their subjective expectations about economic growth or about the rate they have on their savings. This is the first step that we want to see. And after that, because we can have this breakdown of whether it's driven by subjective expectations, income risk, or preferences, we can complete the story by also showing you how these bars would change essentially if we focus on preferences or income risk.
Matti?
The question is that is the infinitely living households really a sensible setting here? Because I mean, it really disregards demographics and things like that. On top of that, I guess that if you think about the monetary policy or something like that, it comes to my mind the old point put forward by Helsinki, which simply says that, okay, if you think, say, age structure, okay? We know that, okay, there is a simple difference that, okay, old people have just an income effect, and while the others, so to just say, young people have just both the income and a substitution effect. And that surely affects the transmission mechanism in terms of saving, okay, and in terms of monetary policy effect. So my question is really that, okay, how to incorporate this kind of quite important things to the model? Thank you.
So the model as it is now cannot have like life cycle savings essentially. What we can do is break this out along the age distribution and see differences, but again, it would be in an infinite household setup. The reason we've done this is that as we move forward with this model, what we want to do is see not only differences between countries, but also differences when it comes to how you define subjective expectations versus rational expectations, and even perfect foresight, which is what we've done up to now in the model, in the paper. So essentially there, because you want to play within the expectation space that you live in order for it to be solvable, it has to be in an infinite horizon space.
Michael?
Very nice. I was actually wondering, I think you mentioned that you observe income once a quarter, and I guess panel households and the sample for 12 months. No, it's maybe a bit challenging, but could you actually kind of try to construct income shocks and kind of like validate that people behave rationally in response to income shocks?
Exactly. Absolutely. So we're trying to do this, and in addition, because the data set we have is between 2020 and up to currently, essentially. So there is the one concern is what you just said. The other is that we live essentially in a crisis period, right, that we have to condition over. So we want to essentially break out the shocks to income by the way they answer. So there are all these questions about whether you've had support, whether you've lost your job, etc. And an additional layer we can add to that is that we know in each country where different fiscal measures took place. So we can take out also income support in that and try to decompose that.
Gaetano?
I was wondering if you control for a different mortgage structure, so flexible rates versus fixed rate, and for ownership, of course.
So as this is a consumption savings, we have borrowing, yes, but there's no intricate modeling of the borrowing structure. The reason we've done this is that because we use this infinite horizon setup and we look at a specific period with the goal of this paper to be more decompositions rather than something else, we've kept as simple a structure in the decision that these households take in this relatively short period of time in order to try to analyze the differentiations rather than looking at the debt composition or the asset composition that they have.
Any other questions? May I also remind everybody who is following us online to post questions in the chat. I don't see any, so if there is no further questions. Thank you.
Thank you.
Okay, so let's move to the second paper, which will be by Gisle Natvik from BI Norwegian Business School.
Okay, thanks. Thanks for putting our paper on the program. Now, it's okay. Good, yeah, so this is a joint paper with some of the co-authors also on the paper that Ben presented with Andreas Fagereng and Martin Holm and Magnus Gulbrandsen. The question we're going at here is something that I actually spent a lot of time on at the central bank when I worked there 8-10 years ago, circling around household indebtedness and what drives it over time. So, as I'm sure most of you are well aware of, one of the starkest macro trends over the last 40 years across advanced countries is that household debt has increased faster than income. That applies to basically all countries that I know of at least. And that's brought household indebtedness high on policy agendas. And in particular in central banks, where a big debate has been if central banks should take household indebtedness into account when they set interest rates. Now, one thing is that debates on indebtedness, they typically center on primary deficits, as if all changes in debt-to-income ratios were driven by choices by households to borrow more or pay back more on their mortgages. But that's potentially misleading because there are also mechanical effects, and that goes back at least to Irving Fisher's work in the 30s, where he was talking about debt deflation spirals, where you sort of get low inflation and then the real value of debt goes up and so on. So one way of looking at it is to take this standard equation that we know well from sovereign debt. This is what typically we do when we teach students about sovereign debt dynamics. We think of changes in a country's debt-to-income ratio. For a household, it would be the household debt-to-income ratio. And we split it into primary deficits and these mechanical effects. And these are what we call Fisher effects after Irving Fisher here. So in principle, this means that, well, monetary policy could have, it's not obvious if monetary policy increases or decreases the debt-to-income ratio when it hikes the interest rate. And this was a big point made by Lars Svensson back in 2010, I think it was, when he left the Swedish Riksbank board, arguing that they got it all wrong when they were targeting household debt suddenly. Basically, the way to see it is that typically you'd expect behavior to lie inside here, so that if the interest rate goes up, intertemporal substitution, people will get an incentive to borrow less. But on the other hand, you have these mechanical effects through real income growth, the G here, and through inflation. So what we want to do here is just empirically look at these different channels. How important, over time, have these primary deficits and Fisher effects been for the evolution of leverage of different types of households in Norway? Of the sample which Ben presented already, we have more than 20 years of data where we can actually observe all Norwegian households. And we think it's for this idea of financial stability. Financial stability is a very blurry concept still among central banks. So there's no precise model, I think, out there. This is the one, like what they have for monetary policy. They have the new Keynesian model, and it's kind of easy to understand communication, the logic around that model. There is no such model for financial stability, as far as I know. But so it will become a bit loose. What does it mean to be financially vulnerable? But at least we can try some different definitions and look at that, because typically concerns about financial stability will be about distributions. You think there are some subsets of the population where you think, well, they might suffer a lot if there suddenly is a big macroeconomic shock. And then second, so this is a purely descriptive exercise that we're going to do. And then the second one is to look directly at monetary policy shocks and how does it affect the debt-to-income ratio among different households. Again, zooming on different parts of the distribution. And we'll do this with microdata covering the universe of all Norwegian households over this 20-year period. Our main results are going to be, so when I started this project, I was pretty convinced that we're going to find that, particularly for households with high leverage, these mechanical effects are super important. So that was kind of my agenda when I started. I wanted to convince the policymakers that these mechanical effects are much more important than you think. Turns out, at least when we look at what we've done, that's not really true. So if we do this accounting exercise, descriptively, I'm going to show you shortly exactly what we do, but we just decompose the dynamics of debt over time. We see that the debt-to-income ratio primarily has been driven by primary deficits. That's not a huge surprise, because we know that on average, total debt has increased. But we also see that across households, still primary deficits are the most important factor, even among households who are highly indebted. So these Fisher effects matter a lot for households who are highly indebted. That sort of follows as a matter of accounting because it's weighted There is no debt to deflate if you have no debt. And it definitely is important for these households, but still a lot of their debt is driven by their primary deficits. And when we turn then to monetary policy shocks, part of this actually carries over. It doesn't need to be the case. This is just a descriptive exercise. Here we're trying to look at like causal effects on behavior. But we find that on aggregate, the debt-to-income ratio goes down, meaning that this primary deficit channel dominates these mechanic effects. Moreover, and perhaps more importantly, more strikingly, is that we get similar results across the distribution of debt to income, across the distribution of housing tenure, across distributions of unemployment risk, and so on and so forth. We can sort of split the data in many different ways, and get the same type of result all the time. So the upshot is really that these behavioral responses tend to dominate these mechanical effects. Even among those groups where sort of just mechanically, the scope for these mechanical effects is the biggest. Okay, so I'm not going to say much about the literature, but there are two nice papers that are quite related. There was this paper by Mason and Jayadev back in 2014, where they did a similar type of decomposition on US aggregate data. So the difference with our paper is, of course, a different country, but we're going to do it at a micro level. And what they find is that there are periods in the US history where these Fisher effects have been important, and there are periods where these primary deficits are important, and it sort of has changed over time. There's a very recent paper on Dutch data by Bernstein and Koudijs, where they look at the importance of amortization schedules for saving. And they find that people who have recently moved, they tend to increase their saving, and they interpret that as there being the amortization schedules that they sort of have to sign on to bind. So people are forced sort of to save more when they buy a house. So that's related to our paper, because if that force is very strong also when you look at monetary policy shocks, you would expect that these mechanical effects could be super important for these households. Okay, so we use the population tax record data. So good for me. Ben did a good job in presenting them, and you did a good job of marketing them. So that was great. It's easier in this paper because we don't use so much of the data. We don't need to think about transactions. We don't need to think a lot about stocks and bonds and mutual funds and so on. Because Norway taxes wealth, we observe household balance sheets. Importantly for the notation, time notation later on, it's always end of year values on these on the stock of assets, so like your debt at the end of the year. These data, it doesn't distinguish between different types of debt. So here it's just like debt is debt, including, but it's dominated by mortgages. Our observables that we use here is we're going to use income, assets, liabilities, and household characteristics. And importantly, these data are third-party reported, so they are pretty reliable. Okay, household debt. There are some institutional details that are important for this specific paper. So first of all, household debt is primarily mortgages. 90% or more of all the mortgages are ARMs, so they have adjustable interest rates. Household credit in Norway was heavily regulated until the mid-80s, and then it was sort of liberalized in the late 80s. Home equity lines of credit were introduced in the early 2000s, and LTV requirements have been there since 2010. And for monetary policy, you need to know just that in practice, Norway has been inflation targeting since the late 90s, and with an increasing emphasis on financial stability. So some people have reacted to that, so we can split the data before and after 2009. The results don't change, but of course, we have a lot of data in the cross-section, but we don't have more than 22 years in the time series. So if we split a lot in the time dimension, we can't really say anything because it's just too uncertain. So if we look at our data, there are many numbers here. So basically here, the columns are different debt-to-income quintiles. So here are the households with the most debt-to-income. We see, as we'd expect, they are young. One thing you should notice is that they have pretty high education, and they have pretty high income. It's not that these are poor households. So the action here goes on in a lot of it goes on in the numerator. It's not like they get the high debt to income ratio because they are poor. Yeah, and this has been a period with moderate inflation, which is important when interpreting these results and trying to extrapolate to an environment like now, that this is a period with low inflation. Okay, so the accounting framework is super simple. It's like the textbook accounting framework for sovereign debt. So you have a law of motion for nominal debt. The B here is, so I'm trying to use macro notation here. So BT is my stock of debt at the beginning of the year. In the data, that means, so for say 1998, it will be the debt I held 31st of December 1997. So that's that's BT here, and then that would be by end of year debt. And that's real debt here. So this makes it nominal. And then we can manipulate it and linearize it, and we get to this linearized expression. This is an exact expression, and this is the linearized one where we can split out the contribution from this, and this term. So, and again, G here is real income growth. Okay, so just to the results. We do this accounting exercise. The dashed curve here is the change in the debt to income ratio every year in the whole population. We have years on the x-axis. The gray area here is the contribution from these Fisher variables, and the white bars are the contributions from the primary deficits. So we see that what drives debt to income over time in the total population is primary deficits. That is not a surprise. It sort of has to be the case, given that debt has increased in Norway more than income over this period, just like it has in other countries. But that's sort of the starting point. But we do see that the Fisher variables can be pretty important in some periods with high real income growth, like here. And probably, I would guess, going forward, like now with super high inflation, we're going to see big gray bars for 2022. We can decompose these Fisher effects using this approximation, like using this one here. So we can, how important has interest rates, real income growth and inflation been? That's what we do here. So we have the total effect of the Fisher variables is the gray bars that you saw on the last slide as well. And then when we split them up into interest rates, that's this dashed curve, real income growth down here, and this solid black line is contribution of inflation. So what you'll see is that this sort of cancels out against that, and then it's this inflation curve that has on average matters for these Fisher effects. But these effects are not huge on average. If we now do stuff that's more interesting, we look at the distribution of debt to income household, debt to income quintiles. Here, these households basically don't have debt, so there is no debt to deflate. So therefore, all the bars will be white. As we move up the distribution, still here, second quintile, not very important. The third quintile is not in the picture, but not very important there either. And when you get up to the most highly levered households, that's where you see that these Fisher effects can matter quite a lot. That's the gray bars here. If we put all of this together in one figure and we just sum over the years, it means that for the most highly indebted households, you see these Fisher effects, and here they are split into the contribution of income growth, the interest rate, and inflation. And we see that the importance of this, the income growth is what matters the most. And of course, that could change a lot if you had high inflation. Okay, one thing that immediately comes to mind, I guess, is that these mechanical effects, I would expect, would be important if you're in a mortgage following an installment schedule, so an amortization plan is given, like they allude to in this paper from Holm that I mentioned. And that's what we see here too. To the left, we see that these primary deficits, these Fisher effects, they come from the people who are not moving in a year. So these are what we call stayers, so households who do not move. That's where you see these Fisher effects emerge. These blue bars are very small. So these are the contributions from the people who move. And the flip side of that would be that, well, the primary deficits, where do they come from? Well, they typically come from people who move. And that's these blue bars here. Okay, so to sum up, aggregate debt to income movements, historically, primarily they've been driven by primary deficits, but these Fisher effects are important for the subset of the population who are highly indebted. And then sort of, does this carry over to monetary policy? And basically the question is, how do interest rate changes affect the debt to income ratio? And we have two countervailing forces. On the one hand, we'd expect them to reduce primary deficits. And on the other hand, mechanically, they will increase the debt to income ratio through the Fisher effects. And in particular, among the highly indebted households, which probably are the ones that are most of a concern for financial stability purposes, are these Fisher effects super important there. We answer this with using monetary policy shocks that are identified in a narrative way. And this is a paper by one of the co-authors, Martin Holm's paper, with some other co-authors, where they have a section describing how they identify these shocks narratively. So we just use the same shock series here. We use local projections, and what we're interested in is these coefficients here, the betas here. We have plug in these monetary policy shocks, and we look at outcome variables like income growth and debt to income ratios and so on. And we can then, of course, do this across different groups, so we get the different betas for different groups. So if we do that, just basically what does this monetary policy shock look like in the macro data? The interest rate goes up for a couple of years. GDP falls. Inflation doesn't move much. So that's important to carry in mind when we look at the results that follow, that with these shock series in Norway in this setting, this channel is sort of turned off. There is not much happening to inflation after a monetary policy shock. So the first result of the paper is these aggregate effects. The aggregate response of DTI to monetary policy shocks is sort of negative, like conventional wisdom suggests, much to my disappointment. I was hoping it to go up, but no, it doesn't. So it is pretty consistent with intertemporal substitution, standard behavioral responses to interest rate changes. We can decompose it to these Fisher effects and these primary deficits. Sort of follows from this that we know that this guy here has to be negative, but we see that these Fisher effects are pretty big, but this line here is the one that dominates the response up there on average. If we split by DTI quintile, so remember the decomposition showed that Fisher effects, if you just look descriptively at it, have been quite important over time for debt to income dynamics. So I would expect then to see that the response of Fisher effects to sort of be super important for the highly leveraged. So it is big, like this black line. So each line is for a different quintile along the debt to income distribution. And this black line then is our sort of the line that is perhaps most interesting, the ones who are most highly levered. We do see that these Fisher effects are important. They do tend to, in isolation, they elevate the debt to income ratio, but they tend to have big primary deficits as well. So that, or the primary deficits respond as well. So the interpretation is that these mechanical effects work to elevate their debt level, but they more than compensate for it by repaying faster their mortgages or borrowing less those who are moving. One thing here is that, is this really behavior or is it cash flow effects? So remember, primary deficits are total household expenditures, or like the inverse of that, the minus with a minus in front. The total household expenditures on debt service. So you have to, there's like repayment and then there's interest expenses. So part of this could be driven by just interest expenses and they're just repaying as much as they did before. So if households mechanically follow amortization schedules, these primary deficits will sort of mechanically also reflect kind of mechanical effects. So we want to decompose those a little bit further. So we can just stare at this expression instead of using the law of motion. We can just stare at the expression for the debt to income ratio. So here we have nominal debt at the end of the year. Here we have income over the year. And here we have interest expenditures over the year. So the convention here, this guy here, that's just a separate component we observe in our data is how much money the household has spent on interest expenses over the year. And then we can log linearize and so on, we can get something like this. If we do this, we can take this equation to the data, and we can estimate these responses separately. But they will all be weighted then by the debt to income ratio at the beginning of the year. So if we do that, then this is what the first line, this one tells us that everything that behavior is actually super important. People are actually borrowing less or repaying faster. It's not just about cash flow effects. So here we have their income, excluding interest expenses, and here we have their interest expenses. So there are cash flow effects. So these are interest expenses going up because the interest goes up and they have adjustable rate mortgages. And we have income, excluding interest expenses. You'd expect that to fall, perhaps, but it does actually increase. And that large part of that is because people have interest-bearing assets, which are included in this income concept. So those two sort of cancel out in the denominator here. And this guy drives the total effect on the debt-to-income ratio that you saw before. And again, we can split by quintiles of debt-to-income. Again, the black line, people with the most, who are the most indebted, they also tend to respond the most, like they're trying to isolate pure behavior, is that they actually do borrow less. So it's not driven by cash flow effects. Okay, the last exercise we do is like focusing on recent movers, going back to this Dutch paper. Maybe they are really constrained by their amortization schedules. So then I'd really expect to see big mechanical effects there. But still, even among those, the recent movers, so people are most likely not to move again over the next year. So you could think of this as a probability of moving being very low. And there we see that they also have it's kind of the same pattern. The debt-to-income ratio falls for these recent movers, which are on the black line, almost as much for the rest of the population. These lines are pretty much the same. And they do borrow less. And it's not just cash flow effects driving these things. Final thing we do is like just financial stability idea, like trying to identify vulnerable households. And one way of doing it is to look at people with high unemployment risk. So here's a simple model to predict unemployment. And so households will be grouped along this, which is their predicted job separation rate. And we can look at responses at different parts of this distribution. And we can sort of zoom in on households who are super highly leveraged and have a high predicted unemployment or high probability of becoming unemployed. The takeaway message here is that these results that we found on the previous slides still hold among people with very high unemployment risk. The solid black line here is people with high unemployment risk, and they do reduce their debt-to-income ratios, maybe a little bit less, but still it's pretty close to zero in the beginning, but still it's kind of similar. Yes. So the upshot is that on aggregate, when we just historically look at it, primary deficits dominate. Fisher effects are important for the highly leveraged, like in a descriptive sense. But if you zoom in on monetary policy, the main channel is primary deficits across the distribution. So it's like behavior, not mechanics, that drives the response. Implication for monetary policy, I guess as a policymaker, you're super optimistic now. The financial stability wing at Norges Bank probably loves this because it says, yeah, we should hike interest rates to reduce the debt burden, which is like the conventional logic. I still, even though I thought it would be, the results would look different there, I think it's okay to say, just remind you that the results are moderate. So even though you can reduce the debt burden according to these estimates by hiking interest rates, there's a limit to how much you can do. And also you should keep in mind that these decompositions clearly reflect that inflation matters for the evolution of debt to income over time. So in an environment where you have very high inflation, you would expect these mechanical effects to be strong. And also if you have monetary policy shocks that really affect inflation, that's not what's going on in these estimates. That could also be important. Thanks.
Okay, so Ben.
Thanks. Super interesting and great data. Also, so you had this nice result that a lot of it is due to mortgages, and I think one way of saying your results, if I understand correctly, is that basically when interest rates increase, people prepay their mortgages at a faster rate, right?
I think that's natural interpretation of, yeah.
And so I guess then I'm wondering, then it seems to be the case that it would depend a lot on how much you can basically prepay your mortgage, like whether your mortgage amortization schedule or your contract allows for that. So I know, for example, in the UK, a typical mortgage contract is like you can only prepay up to 5 or 10% of the principal balance. So I guess the question would be, So what does it look like in Norway? And then I guess, to what extent would you think this carries over to other countries?
I think yes. The institutional setting for like the mortgage contract could clearly be very important. There are several papers on the US setting, which is very different. I'm not quite sure what it's like in the UK, but certainly in Norway, it's a pretty flexible setting in the sense that you can repay your mortgage. Yes, and I think it's also this fact that it's an adjustable rate mortgage setting, so these incentive effects are come immediately, and they are pretty strong. Pretty much. We can get some institutional details on it, and honestly, what it were in the early 90s, that Norway was pretty immature, sort of financially in the early 90s. We had a big banking crash after they liberalized in the 80s. So there was a crash at the late 80s, and then sort of story of the Norwegian economy, sort of they got the regulation better the second time in the early 90s. But so we could dig up some more institutional details on exactly. It's a good idea. But I'm pretty confident that the outcome is going to be that you are, at least nowadays, people can just repay as much as they like. There is an observation here that is kind of cute. I brushed by it, but it is the introduction of home equity lines of credit. As I mentioned, it opened in 2002, and that's what you see in this graph. That's when the stayers, or people who don't move, they typically repay their debt. And suddenly there's a blip here around 2002, and that was exactly the period where they introduced these home equity lines of credit. It's like a stock flow story where suddenly then they started using that, and then back to normal, they were repaying their debt afterwards.
Matti.
Knowing nothing about the Norwegian tax system, but the question is that has there been any major changes in taxation, say tax allowances or something like that?
Good questions. You're thinking of exactly what? So there is the big dividend tax reform in the early 2000s, but that's not really relevant here. But and then there's the sort of interest. So to the extent to which you can subtract interest expenses, that's been stable over time. But I guess the rate might have changed a little bit. But that's, as far as I know, it's been pretty stable over time. And then in Norway, we also have this wealth tax, where there is a tax discount. So you have like the government estimates the market value of your house, but then there is a discount, so you don't have to pay tax on the full value of your house, only 25% of it. So there is like this incentive to own houses, but that's also been stable over time. But the wealth tax rate has fluctuated a little bit, but for most households, these are very small. These are very small effects.
Michael.
Yeah, very nice data. I was wondering actually whether you can actually add even richer data to that, because like right now you assume that inflation is homogeneous in the cross-section, yeah. And I've recently seen some of your colleagues and people at the central bank also using like this credit card data. I'm not sure how long it goes back, but it could potentially at least see for the time period for which it's available whether there's any systematic variation in the cross-section by debt to income in realized inflation.
Yeah, it's so we in this project we're not accessing this credit card data, but one of the co-authors here is at the central bank. So in principle, we could try, but it's a huge endeavor to start digging into it to construct it. So I'm a bit reluctant to saying yes, but I get your point. It's definitely here we're just ignoring heterogeneity in inflation rates. We have heterogeneity in interest rates, but not in inflation rates, and heterogeneity in income growth, but not in.
How about the nominal interest rate, or you mentioned that there's the mortgages are variable rate mortgages, so there's a potentially spread on top of the market rate, individual household specific spread. So does it fluctuate over time within one household? Can they rebargain their loans, or so is there like an individual interest rate effect?
There is an individual interest rate. It's not, the spreads are not huge, but I mean, given the amount of debt people have, it matters a bit, and you can renegotiate. So typically, when your home equity goes, if you have like more than 30% home equity, you can go and bargain with your bank and get a lower interest rate. So you can actually see it to some extent here. If you want to make that point, there are ways of making that clear, but you see there is variation here in the interest rate across different households. So you see it's very high among those people who don't have a lot of that because they typically don't have a mortgage. So these are like short-term lines of credit. And then you have, yeah, you see there is some variation, but in the empirical exercises, we have an individual interest rate per household. But we can also, which is for the purposes here, the most informative information we have is, or you can back that out from their total interest expenses over the year and sort of divide it by their debt at the beginning of the year. But for our purposes here, the most important variable is actually just total interest expenses over the year. And that's what we observe.
Any more questions? Okay, if not, then let's just thank Gisela. And let's move to the last paper of the session, which will be Michael Weber from Chicago booth.
Mic was too tall for a short sermon. So thanks a lot for the organizers for adding our paper on the program. So like, after working with Marita here and Francesco and Daniel here for a couple of years and trying to actually understand how people form inflation expectations, we wanted to pinpoint a little bit more into like the micro drivers of how people form beliefs, in particular, like whether there's an important role for memory in the recollection of individual prices people witness while shopping. And so to a bit more generally motivate our endeavor here in this paper, it's like, if you think back in the last 10, 15 years, there's been this growing body of work that is argued to make sense of aggregate dynamics, like, for example, a forward guidance puzzle. Maybe we might need some form of limited cognition, being it in form of like, kind of finite planning horizons, level case thinking, and so on. And actually, as part of this work with Marita, it's actually we started realizing, when actually going back to some older literature, that actually was a very active literature in the 50s, and we just cite here one paper by Simon. I think it's the third most cited paper ever in the QJE, which kind of, if you wouldn't see the year of publication, you could think it's actually a Woodford paper, actually writing exactly the type of like some form of imperfect cognition and for the implications for macrodynamics. Now, of course, like for quite a few decades subsequently, we've actually not really studied subjective expectations for the obvious reason, given actually once we impose rational expectations with full information, there's nothing to study for us because there's only one model consistent expectation. Of course, we know from CEPR's work also that, through learning potentially there are also interesting dynamics. Now, there's now over the last couple of years a series of papers that tend to show us that also for understanding aggregate dynamics, we might actually want to understand how people form subjective beliefs. And specifically what we want to kind of investigate today is the role of imperfect memory. So the idea is that when I actually form plans and expectations about the future, I actually kind of go to my memory and try to recall situations where I want to draw from kind of signals that might inform my expectations. And however, when I do so, actually I might not recall perfectly all different type of experience with prices I had in the past. And so I have a distinction between like short-term and long-term memory. And when I then think back about past price experience, I might have imperfect recollection about these prices, and that's what we want to bring to a field setting today, because like while over the last couple of years there have been a series of papers documenting the role of imperfect memory, all of them pretty much are purely in a lab setting, so like very controlled environment, but we don't really know whether these findings also matter in field data, and that's kind of where we come in today. So like, what we want to do is now provide a setting where we can observe what people think will happen to inflation over the next 12 months, but can link it at the individual level over like, a couple of years, observing at the daily frequency, what did people purchase, what are the prices they paid, did they use coupons, discounts, and so on. So the setting we are using is this Nielsen home scan panel on which we started fielding customized surveys in 2015. I'll tell you a little bit more in a second how we do that. And of course, obvious shortcomings. Pretty much most of the talk today, it's purely correlational evidence. We cannot hold everything fixed. You want to keep that in mind. We have one specific test where we actually have some random variation where we can possibly more credibly talk about causality. But I think, the big advantage is that we can observe signals people see in their daily lives and directly link it to their own individual expectations. And kind of motivating a little bit this line of work of trying to understand like whether exposure to prices in daily life indeed do matter for how people form expectations. I just want to briefly recap some of our previous work here with Ulrike Malmentier and Francesco. So this is like one of those long-standing puzzles going back to an AER paper by Jonung for Sweden, that women across countries, surveys and question formats always have higher inflation expectations than men. And so like our explanation for that, we ran our own survey in 2015, and so like what you see here on the left panel is for the first time, to the best of our knowledge, is like a gap in expected inflation within household, average female expectations versus average male inflation expectations within the same household, keeping constant family structure, housing choices, and so on. That's like the unconditional difference, about 0.4 percentage points. What you see in the right panel of this plot, we just simply split those households into what we call traditional households, households where the male household head declares to never do the grocery shopping. That's like the middle graph here. And the far right one is households where the male household head declares to be at least once in a while participate in grocery chores. And what you see is like, in traditional households, the gender gap opens up by about 40%, versus actually no longer statistically or economically significant when also the male household head is exposed to grocery prices, because on average also male household heads in that subsample of the data have higher expectations. And you can actually directly ask people, like, if you think about inflation, what are the type of most important sources of information you would use to form expectations? And actually predominantly, at least in this US sample of here 50,000 households, they tell us it's really my grocery shopping, and then at some point also official news releases and so on. So like trying to understand how people then, when grocery shopping, actually extract signals from what they purchase and how they store those signals and subsequently use them to form expectations. This is crucial. And just to give you like, a one slide summary of kind of a baseline association before then drilling into the details. So like what we are plotting here is like, we just simply, I'm in the finance group, do asset pricing once in a while, do portfolio sort, so to speak, portfolio one. That's a subset of households that over the last 12 months at the individual household level had the lowest realized inflation. That's what we calculate. Households in portfolio 8, those are the 8th of households with the highest realized inflation over the last 12 months. And then we simply, given that we at the individual level also observe what they think will happen to overall CPI inflation, we just simply collapse the data by bin. And you do see that, the standard pattern is on average, relative to exposed outcomes, but the upward bias is substantially higher if you have high past personally realized inflation relative to low past personally realized inflation. And again, we directly elicit overall CPI inflation. Okay, so now let me tell you a little bit about the setting we are using in this paper. So the Nielsen home scan panel, so like since early 2000s until now, you observe pretty much whenever people purchase something that has a barcode, like over here, they have an optical scanner at home. Like we know from the supermarket, they go home, scan the good, and then we know in the data set what is the good they purchased, based on the UPC, like the type of water, Novell, spring water, no gas, and so on. We know the price, where they purchased it, and the type of this type of information. We know about the individual, lots of demographics, and then we started fielding in 2015, customized surveys on that very panel where we elicit a few additional demographics, narrow college major, job, and so on, but also then crucially inflation expectations of individuals, perception about specific price changes, and so on. And then, however, also, like as we just saw, like what are the type of sources of information they would use. So in total, we have like about 90,000 households, a response rate of 43%, in line with like the distribution of grocery duties within household. You do see like we have 2/3 women in the sample, but we can wait to make it representative again in terms of like, college, it's pretty representative of the overall US. Now, what we first want to do to understand like how people associate past observed price changes in their own shopping bundle with their overall expectations for CPI inflation, we want to create two measures of realized inflation. The first is like a changeless pair price index that the BLS would do, but for a specific household level, so household-specific bundles and household-specific prices. And the second one is a frequency CPI, in which we just weigh by frequency of purchase in a base period. Like I purchase milk 100 times, I would weigh 100 times the milk price change, versus like maybe I only buy a Wagyu steak once, so only a weigh of once, and make sure that weights add up to 1 again. And so the way we do that in the base period, so the first survey was in June of 2015. We define a base year over the 12-month period that ends the year before. We then actually fix the bundle. We look at volume-weighted average prices in the year before the survey, and in the base year, we then look at log price changes, weigh for the household CPI by expenditure shares in the base period, or by frequency of purchase for the frequency CPI. And then, like, for the next survey, we just roll forward the base period, and so it's just a chained index. And now, baseline regressions we are doing, like, what do you think will happen about inflation over the next 12 months? We define inflation and say that it's typically measured by the consumer price index. At the individual level, request on household-specific inflation, which set of fixed effects, like local fixed effect, kind of survey wave fixed effects for survey question format. We have both randomized Michigan survey versus New York Fed survey question for inflation. Then we also have, in the most restrictive specification, individual fixed effect, and then a host of demographics, other expectations, and so on. So let me just briefly walk you through those baseline correlations, like what you see in the first set of 3 columns, independent of like how stringent we actually make the specification. Column 3 only exploiting variation within individual over time. We do see like, that a 1 standard deviation increase in the household CPI is associated with a 0.2 percentage point higher expected overall inflation rate. Similar kind of magnitudes for the frequency CPI in the second set of 3 columns. And now to do kind of a horse race to see like, is it that people like really weigh by expenditure shares or by frequency of purchase? You tend to see like, the economic association of the household CPI shrinks to 0, is no longer significant. Instead, the frequency CPI, is still strongly predictive of overall CPI inflation expectations. Now, what you don't see here, and this relates a little bit to Olli's earlier speech, what you also see in the paper is that people tend to actually overweigh positive price changes relative to price cuts. Now, what this would mean, like even if now, let's say the ECB would be super successful and powerful and lower realized inflation, it might still take some time until expectations come back down again. And here also by this weighing of individual prices you purchase frequently, in the US setting last summer, flight prices and prices of rental cars have skyrocketed, whereas Jay Powell said narrow price increases in a few not important categories. If those individual price impulses are in categories that are very salient to consumers, you might immediately see an overall increase in expectations, which indeed was materialized in the data last summer already. So now I actually want to bring specific predictions of this memory framework to our baseline setting. And so specifically, if I now actually want to inform my expectations for inflation, I actually draw now kind of my experience of prices of specific goods I actually had over the last 12 months, and actually then, however, I might have imperfect memory when doing so, and just to actually see whether these type of predictions are borne out in the data, I want to show you some additional kind of results. So the first one is, if you think about this memory database, there are some goods I purchase often. Milk is a good example in the data. For any household in our sample, tiny expenditure share, but huge variation in the frequency of purchase. And so therefore I have many entries of milk. And then if I actually now would draw a signal about the future overall price pressure, I might actually be more likely to inform my expectations based on milk relative to Wagyu steak, which I only purchase when I get tenure. And so I have very little kind of information about prices about Wagyu steak. So there's heterogeneity in the occurrence of signals in the memory database based on how frequently I purchase individual goods. And actually, again, so like you can just ask people, when you earlier answered, what you expect to happen for inflation, were there specific goods that came to your mind that you thought about to inform your expectations? And here you actually do see indeed like, simple things like milk, the price at the pump, bread, eggs, and so on are the most frequently mentioned goods. You also see it was a survey in the US. If it was a survey in Germany, beer would be way more important potentially. For France, we know that the price of the baguette is actually important, how people think about inflation. So like there are country-specific differences. In the US, it's milk and gas. And so therefore, we actually then, earlier this year, tried to understand whether indeed people would extrapolate what they recall happened to specific goods when they actually answer overall inflation expectations. Now, oftentimes in these surveys, you're concerned, there's a pure anchoring. You ask me a couple of times, different expectations, I always say the same, because maybe I have, low incentives to answer truthfully. So, a couple of things where I don't think this can be purely be associated with anchoring. The first thing is like, we ask, what do you think is the price of, think about the milk you purchase most frequently in the size you purchase it typically and at the store you purchase it typically, and it becomes clear why we actually ask it this way. What is the current price? And what do you think was the price 12 months ago? And then we calculate, based on those answers, realized milk price inflation, which is what you see on the x-axis. Y-axis, just simply, what do you think will be CPI inflation over the next 12 months? So purely anchoring, like the household would have to be very sophisticated. Say, well, now I want to say like 8% for overall inflation. I say milk is right now 2.49, and I should line it up now that the price 12 months. So like, I think this partially alleviates already this concern, because if I just actually answer the same number because I'm lazy, I don't think I would be so sophisticated to then quickly come up with exactly this number. And I'll show you later on another reason why I don't think it's purely consistent with anchorings. But key takeaway from here, when people answer expectations for overall CPI inflation, on average, there's actually a strong correlation with what they perceive has happened in this setting to the price of milk. So individual price changes seem to inform how people think about goods, and goods in particular, they purchase frequently. Now, some more actually predictions of this memory framework we want to bring to the data. So like, I have a grocery store in my building in Chicago. Whenever I need something, I just go down and buy it. So most of the time, I don't see any price changes. And the price changes I do observe are kind of tiny, sometimes positive, sometimes negative. But the signal I get actually is pretty small. Whereas actually now imagine someone, I think, John List, he lives like 2 hours away from campus, and then like, he might not go shopping every day, but only once a week. And so therefore, like, he has way fewer signals from shopping. But also, like, on average, the signals should be larger in either domain, positive and negative. And so now what we now want to do is first come up actually with a indeed conditional doing any shopping, whether this association with actually frequently purchased goods and overall inflation expectations is stronger, and then actually bring in a few more additional predictions. So like, idea, Francesco, before the pandemic hit, like, flew to Italy to see his nephew once a month, and he always comes back, says, well, Marco never grows. I'm, wondering whether he stays tiny until he dies, versus like now after the pandemic, he just went back recently and hadn't seen his nephew like in 2 years, and now he says, well, he's a grown-up, he's even taller than you are. So like, this idea that if you don't observe something permanent or constantly, you'll notice it way more when you actually start seeing it again. And so like, here I just want to show you, based on observed data from shopping at the individual household level, whether this is indeed plausible in the data. Here's just lots of heterogeneity, of course, fully endogenous in the number of shopping trips people engage in. Then you see here on the x-axis the number of shopping trips and the number of trips with 0 price changes on the y-axis. Indeed, the less frequently you go shopping, you typically tend to see price changes all the time, vice versa if you go shopping a lot. Here again, what you now see is that the more frequently you go shopping, the lower is the average absolute size of the price change, consistent exactly with this idea from the memory database. And finally, here we are plotting on the y-axis the ratio of price increases relative to price cuts as a function of shopping trip frequency. Due to trend inflation, it's positive or above 50% for everyone, but actually it's decreasing in the number of shopping trips. And so therefore now let's briefly talk about whether kind of these predictions are borne out in the data. So here, whether you see actually a very large increase in the frequency CPI or a decrease, there's a stronger association in column 1, 2, and 5, 6 relative to an intermediate change in the frequency CPI, which is less salient and not noticeable, barely any changes. Then indirect proxies for shopping trip frequency. Here we actually know whether people do any shopping but are not the main shopper, whether they go shopping more or less than once a week, or how far their closest shopping outlet is. And here again, conditional doing any shopping, the less often you go, the stronger is the association with realized inflation and inflation expectations. And now actually, in the last 2 minutes that I have, I want to briefly talk about 2 specific predictions also of the role of long-term memory and interference that we want to bring to the data. So now when I think about inflation, I draw signals from the past. I have imperfect long-term memory, and of course in the context of shopping, and I think about it, I might not only draw a signal from 12 months ago, but maybe also from 18 or 24 months ago. Good example, if you actually happen to be German and you talk to your parents, let's say, about what happened to you after the euro introduction as a paper currency, they tell you restaurant prices doubled, and they say, well, the schnitzel was so much cheaper than it is now. In Italy, it's the price of movie tickets. When asked actually in 2002 what was the price of a movie ticket last year, in Lira, they mentioned prices that haven't been in the data since early 90s. So people seem to actually, when asked about things or recalling things, have actually this kind of imperfect recollection. And indeed, if you actually plot it in the data, the difference between what people state the price of milk was 12 months ago relative to what we observe in the actually home scan panel data set. That's why it was crucial that we said milk you typically purchase in the size, quantity, and store you purchase. So this is how we match it. And here we are just plotting on the x-axis the difference between what people stated the price was 12 months ago minus what we match. You see a long left tail, so like there's indeed people systematically, or some people systematically underestimate what the price was 12 months ago. Now, of course, on the flip side, this should then mean that they actually have an upward bias in recalled inflation. Again, here you see a long right tail, so indeed like this idea that people have this proactive interference seems to be borne out in the data. And then remember earlier I said, so far, I don't want to actually make any causal statement. The only thing I think we can certainly be a bit stronger on causality, at the very beginning of the survey, we just randomly split the survey sample in half, and one half of the survey received a very mild form of a Q at the beginning, where we just asked, to the best of your knowledge, is there a gas station on your way to work or close to where you live? And so the idea was that when later on they would think about price increases and inflation, they would be less likely to think about grocery shopping experiences, but more likely to think about the price at the pump. So like, we didn't even ask what is the price, and we just simply asked, is there a gas station, to frame a different context or to cue a different context. That's kind of what you see is like, the baseline association we saw earlier graphically. If you actually have a higher perception of the price change in milk over the last 12 months, you expect higher overall CPI inflation going forward. That's column 1. Column 2 and 3, we simply add an interaction term with a dummy variable that is 1 when you randomly were asked at the beginning whether there's a gas station and nothing else. So a very mild form of Q. And you see actually people that were actually interfered do not use at all or make use of the milk price perceived milk price change over the last 12 months when forming inflation expectations. So like, let me conclude here. So like, aim of the paper is trying to actually pinpoint a bit more the micro mechanisms through which people form inflation expectations. And, our kind of reading of what we find is that, indeed, when thinking about overall price pressures, oftentimes people think about very peculiar goods that are salient to them, and, specifically we bring a few predictions of this memory database to the work, to the data, and seem to find actually support for it empirically. Thank you.
Thank you, Michael. So let's open the floor for questions. Isla, and then Matti.
I just the question. It was just I looked. You presented some of the categories. They seem to be a lot of the non-tradables. So, is there a reason? Was that just an arbitrary choice here? Because like in the last 30 years, a lot of the downward pressure on inflation probably has been globalization. So, I would be curious to see like information on like pure tradables, like clothes from China and stuff like that.
It's an excellent question. Unfortunately, there we are somewhat limited based on the data we have, in the sense that we only observe things that have a barcode. So pretty much it's groceries, pharmaceuticals, some small durables or storables, but unfortunately, like larger ticket items and clothes are not in the data. And it would also be a bit tricky in the sense that while I buy maybe underwear every 2 months, I don't know, I typically don't buy exactly the same brand, let's say. So like, it would even be hard to then come up with actually based on purely observational data to actually measure realized inflation based on that. And that's why like, milk and staples like are actually nice, because like you can follow them over time, but for these type of goods, it's maybe a bit tricky, and unfortunately we don't even observe it.
Matti.
Thinking about the rather big differences between the sample sizes for male and female, it comes to my mind that might they reflect more deep, differences and problems with the sample selection, okay? I mean, how easy it was to create a sample and get the answers. Could it be that, okay, like, if I imagine something very extraordinary, people who are pissed off of inflation, okay, are less hesitant to answer or something like that?
No, that's definitely an important point. So like, some of the work we've been doing here in Finland, we only have men. And then we are always asked, well, but, can you make any extrapolation on women? And, it's hard to make. Here, at least in the US setting, we do have a third of the sample that is female. And so the reason why, this specific sample selection occurs is because, like, even like if you ask who's the main grocery shopper, it's about 2/3 of the sample say that it's the female household head. And so typically the person who actually does the scanning at home is like every household member receives an invitation to participate in the survey. It's an online survey, and they are contacted by Nielsen that runs it on our behalf, but it's typically like the person who does like the entry of the goods in the shopping database that answers the survey, which explains the sample selection. The best we can do is then to make it representative based on observables, but of course, that's the best we can do. And so like, that's why certainly we have to keep that in mind.
Andrew?
Yeah, so just a question, and you may be limited by the data. You talked a lot about like the frequency of purchasing as mattering. What about the size of like the size of the cost of the purchase good, right? So like milk would be a few dollars per purchase, but gasoline would be maybe $70 and then $100 and then $80. So you'd see wider shifts. So you have that its kind of role as well.
No, totally. So like, I definitely think that the average level of the gas price is highly relevant for like the average level of expectations. But if you look, there's also lots of dispersion in the level of prices at the pump across the US. But actually, if you look at price changes, they're actually almost perfectly harmonized in the gas price change across the US. So like, given that here we mainly focus on the dispersion and expectations, making sense of that, I don't think actually there's much scope in gas prices to understand that, unless you would say like, now our different expenditure shares of gas are really important. But actually what you do see in the data that even those that actually don't even have a car, they still actually extrapolate from gas prices to overall inflation, because like it's really, it's in your face, so to speak. Even if you don't have a car, you take a bus, pass by the gas station, you really see it. And so like, an indirect way of getting at least within the goods we observe, whether like the size of the economic exposure versus the frequency matter. I think, in the last 3 columns, when we do this horse race between like a measure that uses expenditure shares versus frequency of purchase, it seems that actually the data seems to prefer the frequency relative to expenditure shares. I don't know, Francesco, did you want to add?
I mean, I didn't need to add necessarily stuff, but so we also look at like all these effects and results within each of the groups. So for instance, I mean, for men, we do have a large sample, it's about 1/3 of the sample. And directionally, and in terms of the cross-section within that group, we find exactly the same dynamics. So I wouldn't be concerned about the representatives there.
Gaetano and then Ben.
I was wondering whether in the data you see that inflation expectation have a role for shopping behavior independently of the specificity of what they are buying, or because I'm thinking, do they have a reason to pay attention to inflation as different from specific local inflation that they are exposed to?
That's actually an interesting question. I don't have exact evidence on that, but so at least during the pandemic, what you did see is that people, did change their shopping behavior, also partially due to changes in realized inflation at the household level. So, normally, oftentimes, there's lots of dispersion in realized inflation. So Keppel and Jokivuolle have a paper on that in the JME. But in normal times, it tends to be really hard to find any correlate with actually realized inflation. But you do see in the pandemic that lower income households, lower education households, and black relative to white households all have higher realized inflation, up to like 2 percentage points within that grocery bundle. And then you see subsequently, I guess what Rebello, Jajmovic, and Aline Wong call like a trading down mechanism. And, a part of this realized inflation difference is due to like, let's say Francesco goes to Whole Foods normally and doesn't use coupons when the pandemic hit. He went to Trader Joe's and purchased goods on discount, versus I always purchase things at Aldi when they're on sale. And so like I don't have this margin of adjustment. So I think that's the best evidence that relates to your question, but directly on expectations and changes in behavior, we haven't seen that.
I thought the very last result was super fascinating, that when you add this little cue about the gas station, the results change so much, or what they tell you about inflation. So I guess that made me wonder then, when people make actual decisions, which inflation expectations do you think matter? So for example, if you think back to the paper that Jane presented earlier about wage bargaining, do they use the milk expectation or the gas expectation? And maybe there then they actually think about the gas station as well, and maybe for different decisions, for some they think about the gas station, for others they don't, and so on.
No, it's the direct implication is exactly as you say. It's like people in their daily lives, they have so many different signals they're exposed to, and I think our takeaway from this line of work so far is that you can identify systematic drivers of this association, and in some of the papers we also actually use kind of what we call monetary policy communication to shift expectations. Like it really then depends in trying to if you want to understand how people make choices and like which signals they actually, as you say, at that moment come to mind. And I think there we are still at the infancy, so to say. Like it has already been tough enough, so to say, for the people in this literature over the last 10 years to show actually, even in a causal setting, that expectations matter. And I think now, given that we see that specific signals tend to even affect those expectations, I think it's maybe even like a bigger challenge than for central banks, if like even the price at the pump or like the milk price can in fact move expectations so much to kind of pierce the veil of ignorance and get through to ordinary consumers with communication and other ways to potentially manage the expectations.
Any other questions? No? Okay, so we're sort of on time. So let's close the session now and give a hand to all the speakers. Before you go, we meet 3:15 Helsinki time, so like in 17 minutes here for the second invited speech. Thanks.
Okay, welcome back. Let me remind for those participants who are online that you can write the questions on the chat box, and we will collect them after the presentation and read them loud to the speakers. In this session, we have an invited speech by Sydney Ludvigsson, and she's talking about monetary-based asset pricing, a mixed frequency structural approach. So Sydney, please, floor is yours.
Hi, everyone. I've got a huge echo here. Let's see, what can I do about that? Test, test, test. Can you hear me? Okay, seems to be good now. It's a pleasure to be here. I want to talk to you about some work today with Francesco Bianchi and Sai Ma. And the question that we have been grappling with for some time is, why do long duration asset markets, such as the stock market, respond so strongly to the Fed? Now, it's practically a truism that the stock market is highly attuned to monetary news. And there's a large and growing body of literature that offers a myriad explanations and some debate for why this is. A classic view, surprise announcements these surprise announcements by the Fed proxy for Taylor rule shocks that have short-run effects on the real economy, as in canonical new Keynesian models. But this in and of itself creates a puzzle, because it's unclear why a framework with short-run monetary non-neutrality would imply any non-negligible effect of such shocks on long-duration assets, extreme long-duration assets, such as the stock market. So other explanations have abounded, and one is that perhaps return premia fluctuate for some reason, and they fluctuate persistently enough to explain this. It could be that monetary policy shocks cause effective risk aversion to shift, or cause shifts in the wealth distribution among agents with different risk-bearing capacities, or perhaps they cause sentiment to change. Alternatively, these announcements have been hypothesized to impart information about the economic state. Maybe there's some information that the Fed had that was not known to markets. I'll call that the Fed information effect. And finally, markets are possibly surprised by the Fed's reaction to recent economic data. Now, all of these are somewhere in the literature. The empirical facts of these jumps in markets are largely established from high-frequency event studies in tight windows around Fed communications and reduced-form empirical specifications. And then the interpretations of the facts have followed largely from carefully calibrated theoretical models that are designed to show that one explanation or another from these competing explanations fits some aspects of the reduced-form evidence. And while we think those are really great starting places, as this mushrooming debate indicates, there are really a lot of questions remaining about the interplay between markets and monetary policy. And in this paper, we wanted to consider three of them. So first, we have theories focused on a single channel of transmission. They may be useful for elucidating its marginal effects, but may only reveal part of the picture. So to what extent are several competing explanations or others entirely playing a role simultaneously? Second, monetary announcements, they really cover a range of topics, from interest rate policy to forward guidance to quantitative interventions to the macroeconomic outlook. And so we'd like to understand, how do these varied communications affect investor perceptions of the primitive economic sources of risk that are hitting the economy in real time? Third, high-frequency event studies by construction can only capture the causal effects of the surprise component in monetary policy. And that represents potentially a gross underestimate of the overall causal impact. So we like to ask how much of the causal influence of shifting monetary policy occurs outside of tight windows around Fed announcements. So our contribution to addressing these questions is to integrate a high-frequency event study into a mixed-frequency structural model and estimation. And so we'll examine Fed communications alongside both higher and lower frequency data through the lens of a structural equilibrium asset pricing model with new Keynesian-style macroeconomic dynamics. And then the model and estimation will allow for jumps in investor beliefs about the latent economic state, about the perceived sources of economic risk, and about the future conduct of monetary policy. I'll sometimes abbreviate that with an MP, all in response to Fed announcements. And then this structural approach has several advantages because one is that it allows us to investigate a variety of possible explanations for why markets respond strongly to central bank actions and announcements, but not merely by delineating, for example, which expectations are revised, but also by providing granular detail on the perceived sources of risk responsible for observed forecast revisions. And the structural estimation also permits us to quantify the causal impact of monetary policy outside of tight windows around Fed news events. Okay, so let me give you some preliminary evidence. Here I'm going to call this model-free evidence. It's free of our model. What we've done is take the federal funds rate minus a measure of expected inflation. You can use different measures. We're using something like a 4-quarter average, moving average of one of the inflation measures. But if you use survey expectations, that's fine too. You get a very similar picture. And then we subtract off this measure of the neutral rate from Laubach and Williams. And so you can see that this blue line is plotting this, what we call the MPS, the monetary policy spread from the neutral rate. And then what we do is we estimate an end state non-recurrent regime switching Markov process for the mean of this MPS variable, let's call it that. And so these are really, we're estimating structural breaks. We do it in a sort of non-recurrent regime switching framework. And so we estimate the timing of these breaks, and then we also estimate the breaks in the mean. And so these are the breaks in the mean, and these are the timings. And so we have 3 regimes here. There's a great inflation regime that extends from 61 Q1 to 78 Q3, and that's in dark shade. A great moderation regime, 78 Q4 to 2001 Q3, and then this post-millennial regime where we start with 2001 Q4 to 2020 Q1. And so you see these extended accommodative, where this mean is below 0, or restrictive episodes in the data. And you might have thought that these deviations from of the MPS from 0 would be relatively short-lasting if monetary non-neutrality was short-lasting. Instead, we see they last for decades. And so this really suggests that there are these infrequent regime shifts in the way monetary policy has been conducted. The great inflation and the post-millennial regimes are extended accommodative episodes in monetary history, and the great moderation regime is an extended restrictive episode. So what are we going to do with this? Well, first of all, we'll take this to be some sort of evidence of breaks in the conduct of monetary policy over the sample. We use the structural model that I'm going to show you next to assess, did the Fed's policy rule actually change across these regime subperiods? So we're just using the breaks in this MPS to pin down the timing of the monetary regime changes in the sample and port those into the structural model. Why do we do this? It avoids us having to establish evidence on the break dates themselves that are contingent on the details of the structural model. We use Bayesian model comparison of different structural models to decide on the number of those breaks, and that's how we came up with, well, NP is the number of regimes, 3 regimes, 2 breaks. So let me quickly tell you about the model. We have 2 blocks to describe the behavior of 2 representative agents. And I should actually, I realize that I don't exactly know when I'm supposed to stop. So can someone give me the time again? I forgot how many minutes we have here for this talk. Is anyone able to tell me? I go to when? Okay, well, I'll just keep going. I think someone said 35 minutes or something, but I'm not sure if I'm remembering that correctly. But so we have 2 blocks. there's two representative agents. They're investors. Think of that as like a wealthy household. It could be a large institution. They own most of the highly concentrated wealth in the economy, but they're a small fraction of the population. All of their income is earned from the stock market. They're the only participants in the stock market and a risk-free nominal bond. They will take macro dynamics as given and form beliefs about monetary policy. They're also forward-looking and can react quickly to news from the Fed. Then there are households. These workers invest only in bonds. Their beliefs are key drivers of macro expectations. For example, expected inflation or GDP growth. They have sticky, backward-looking expectations that's consistent with survey evidence. The amount of stickiness is something we estimate. It's a result using survey data. So why do we have these two agents? Well, on the one hand, macro expectations are known to be subject to substantial inertia. On the other hand, markets react swiftly to central bank communications and actions, suggesting little inertia in the expectations of market participants. And so we reconcile these seemingly contradictory observations by considering two agents with different beliefs. Both agents have a monthly decision interval, but investors, unlike households, will intend within a month to Fed communications, and that means we'll have jumps in investor beliefs about all sorts of things. Now, monetary policy follows a time-varying nominal interest rate rule so that there are breaks in the conduct of policy. And the parameters of this policy rule are treated as latent and freely estimated across the previously shown non-recurrent regime sequence. And this denotes the random variable that shifts around that non-recurrent regime sequence that I had up on the plot a moment ago. Okay, but we'll freely estimate the parameters of the rule, and in principle, they can show no evidence of change across the previously estimated regimes or structural breaks. Okay, so I don't have much time in this talk. The main model ingredients are, again, a two-agent model with New Keynesian macrodynamics and heterogeneous beliefs. The monetary policy rule subject to infrequent structural breaks. That is, there's monetary policy regime change. There's two assets, a stock market and a risk-free nominal bond, 6 primitive Gaussian shocks in this model. There's an aggregate demand shock. There's a monetary policy shock in the monetary policy rule. There's a markup shock in the Phillips curve type equation. There's a trend growth shock that moves the supply side of the economy around, potential output. There is an earnings share shock, and these last two are a little less common in New Keynesian style models. The earnings share shock is purely redistributive. It shifts the share of rewards from production between workers and investors without affecting the size of those rewards. There's a liquidity premium shock, and this is really a time-varying preference for risk-free nominal debt over equity. Then we have a no bond trade equilibrium, so that basically what happens is the nominal rate is set by the monetary policy rule, and households and investors' consumption and preferences adjust so that they are happy to hold that, both hold that bond at that rate. We then estimate jumps in investor beliefs about the economic state. They're nowcasts within a month, right? Perceive their beliefs about the perceived sources of economic risk and about the possibility of future regime change in the conduct of monetary policy in response to Fed announcements. We do this by mapping numerous forward-looking series at mixed frequencies into their theoretical implications for beliefs, markets, and the economy into data, and we use a structural estimation using Bayesian methods to estimate all the parameters and the latent states. Now, let me just quickly show you the channels of monetary policy transmission here to the stock market. So here's the monetary policy rule. Here's the perceived equity premium. And, the monetary policy rule has regime changes. These purple parameters move around with a discrete valued random variable, Xi-PT. And, we'll estimate by how much they move. But there are, the break dates are determined, as I said, from the previous estimation. This obviously affects the short rate component of the discount rate because it's moving the nominal rate, right? So that shows up in here, right? Then there's this equation where you have the subjective equity premium shifting, possibly for two reasons due to monetary policy. First of all, the subjective risk premium changes with these breaks in the policy rule, right? And beliefs about future monetary policy. So that's going to affect these covariance terms. So this is an endogenous variation in the perceived quantity of risk that move with beliefs about monetary policy regime change, and also change anytime there is an actual regime change. Okay, so but within regimes, their beliefs about when we might switch to a new regime will also move this covariance term around. And then there's this liquidity premium term. This is the, this will be exogenous. This could change because of any number of factors, such as, think of anything else that could change the risk premium. There could be changes in the liquidity and safety attributes of bonds. This could capture shifts in effective risk aversion, flights to quality, or jumps in sentiment. So this is something we'll treat as exogenous. Of course, we'll filter data to discipline this variation, but we'll take something like the BAA 20-year bond spread with the Treasury as a noisy signal of what's going on with this piece. Investor nowcasts of this piece can shift endogenously in the model. We allow for that right around Fed announcements. So these are the ways that monetary policy can affect the stock market. Okay. All right, so what about investor beliefs about monetary policy regime change? Well, investors understand that there exists these infrequent non-recurrent regime changes in the policy rule. This requires us to think about how to model expectations in the presence of structural breaks. So we will assume that they monitor central bank communications. There's a lot of Fed watching that goes on sufficiently well that they can actually observe and estimate the current rule when there are shifts in the current rule. Okay, this is a bit of a simplification, but we think it's fairly reasonable given that the Fed also clearly telegraphs when it wants to change the stance of policy. What it's less clear about is how long that stance will remain in place. And so we will model the fact that agents are actually uncertain about how long any regime will last and what will come next. So for each realized regime, agents can contemplate an alternative regime. Okay, so we'll denote that with an A. This is something that they think of it as something that investors hold in their hands. This is what they perceive will come next. This is isomorphic to the policy rule that is actually in place, only the parameters are believed to be different. Okay, so that's how we model this. So all these purple parameters are changing, and then what investors need to do with this in mind is form beliefs about the probability of staying in the current regime versus switching to this alternative policy rule. How do we model those shifts in beliefs? Well, we're going to model it with a belief regime, sort of a Markov switching process where these Psi-B terms are a grid of perceived probabilities that the policy rule will remain in place next period. And then 1 minus that is the probability of exiting. And so we can estimate these can be parameterized, and we'll estimate these belief regimes. Investors also know they might change their beliefs next period or when there's new news, and we take that into account when forming expectations. So all of this is modeled using a non-recurrent Markov process with a belief transition matrix, and you can find the details in the paper. Okay, so economic states in this model, the solution of this model actually takes the form of a Markov switching var, and it looks like this. So here's the economic state. You see there are a bunch of macro state variables here, SM, things like the output gap, the G is the trend growth rate, inflation, today's inflation, which involves the interest rate, what is this? This is perceived trend inflation of the macro agent of the households, and these are demand shocks. So, and then you have a bunch of other state variables that come from the asset pricing block of the model. But what you can see is that here, these epsilons are the primitive shocks in the model. These are a vector of Gaussian shocks, the demand shock, the monetary policy shock, the shock to trend growth, the shock to the K is like we call it a capital share, but it's this share that moves around the rewards between workers and shareholders, the liquidity premium shock, and the markup shock. Okay. Beliefs about the future conduct of policy and actual changes in the policy affect the equilibrium in 3 ways. You can see it here in these coefficients, giant matrices. They move the level of the state of the economy with changes. This thing changes with changes in the central bank's objectives and also the subjective risk premium. There's a propagation effect, that is, these factors affect how today's state is related to tomorrow's, and there's an amplification effect. What is this? It's an endogenous heteroscedasticity of Gaussian shocks. And so investor beliefs about the future conduct of policy both amplify and propagate shocks that are entirely non-monetary in nature. And this is most important for asset pricing because this endogenous heteroscedasticity means that the perceived quantity of risk and the subjective risk premium vary only with these parameters, right? So the actual movements in the policy rule and beliefs about the policy rule shifting, even if it's not shifting presently. Okay. So I'm going to have to speed up a little bit. This is a structural estimation using Bayesian methods. We use a mixed frequency filtering algorithm. It's basically Kim's basic filter and approximation to the likelihood for Markov switching state space models. We combine the state equation that I had previously with an observation equation. And then what we're doing here is it's a mixed frequency approach. So we zoom in on revisions and estimates of S, the state, and in the regime probabilities for these belief regimes in tight windows around FOMC announcements. And then we zoom out at lower monthly frequencies or quarterly or even biannually for some of the series when more data are available, and those help us estimate all of the parameters. So we're filtering high frequency forward-looking data, and that allows us to infer around Fed announcements jumps in investor beliefs about the probability of exiting the current monetary policy regime, and that's going to endogenously give us jumps in the perceived quantity of risk in the stock market, as well as jumps in their beliefs or nowcasts of the economic state. That's going to tell us something about a Fed information effect, but we'll get granular detail that allows us to decompose the market responses into perceived sources of risk, which of those primitive shocks drive jumps in their nowcasts. Okay, so we're also estimating this alternative rule that investors have in their minds within each actual regime. That is simply a matter of estimating more parameters. The policy rule parameters are estimated under flat priors, and then we're going to use an MCMC algorithm to get at uncertainty, although I'm not going to show you that today. So we have a bunch of data. We have 220 FOMC press releases spanning February 4th, 1994 to February 2020. There's monthly, quarterly, and biannual data on a bunch of series. The obvious ones are GDP growth, inflation, various survey expectations. We discipline our expectations for the households with the University of Michigan survey of consumers. For inflation, we have those expectations. And then for investors, we have various series, forward-looking series that we use, various professional forecaster surveys. We treat those all as noisy signals about the true underlying investor expectations. Blue chip survey of professional forecasters, various horizons for inflation and GDP growth. And then we also look at the blue chip mean 12-month ahead Fed funds rate forecast to give us longer horizon information on what investors expect for the Fed funds rate. We have daily data. We use the mean of the Bloomberg consensus 12-month ahead inflation and GDP growth forecasts, and Moody's BAA 20-year bond return minus the 20-year Treasury, the BAA spread. At minutely frequency, we have the S&P 500 stock market cap. In our model, we link that to relative to lag GDP, the current contract, and the 6, 10, 20, and 35-month contracts of the Fed funds futures prices. So let me just show you some parameter estimates now. Here are, across our three regimes, some estimates of the parameters in this policy rule. This is really an implicit inflation target. If we have time in the discussion, we can talk why that's not a literal target. This thing is moving around, right? It's not necessarily equal to the central bank's long-run inflation stated objective. But you can see there's large changes in these policy rule parameters, these activism coefficients as well across regimes, right? So if you compare the Great Inflation from the Great Moderation, the Great Inflation regime has a slightly higher inflation target, well, actually a lot higher inflation target, and lower activism on inflation. The Great Moderation versus post-millennial regime has a higher implicit inflation target and virtually no activism on inflation. or economic growth. If you look at the post-millennial regime, look at the alternative rule that we are estimating agents think will come next versus the realized rule that we've had since, just around the turn of the century. We get a lower inflation target, right, than the realized rule. But investors are expecting more activism to stabilize the real economy. That's what's showing up in both of these coefficients. So the post-millennial alternative regime is both more hawkish and more active. And that's going to play a role in some of our estimates. So the high degree of inertia in household inflation expectations shows up in some of these parameter estimates. They learn very slowly about inflation from past inflation. I just want to point out this parameter here, I didn't have time to get into these parameters. It is a signal that we estimate that inflation on the implicit inflation target. And this tells us how much it gets loaded in a period into households' long-run inflation expectations. The bottom line from this is that when this parameter on the implied inflation target changes, households' expectations for long-run inflation move very slowly towards that new target. And that means that policy rule changes will require large, persistent changes in real rates to substantially alter inflation and growth. So imagine that Powell is trying to say right now that we're implicitly moving our inflation target even lower than the long-run 2% objective because we've got to bring this inflation down. These estimates say it's going to take a long period of restrictive policy to achieve that. Risk aversion's moderate. Our asset pricing moments are fit well, and let me just show you a few more results before I conclude. So here's our estimate of the perceived probability of monetary policy regime change over the sample at the end of the month. So we're showing you the estimated end-of-month perceived probability that investors assign to exiting the policy rule within a year. Okay, so this is coming from our estimates, and these are our regimes. And you can see that the perceived probability of regime change fluctuates quite a lot and increases actually before a realized change. Of course, there are some mistakes. It also increases before a non-realized change, but those beliefs tend to come down quickly. And then, this anticipation happens even though, as the previous table showed, investors cannot perfectly predict the new rule. When the new regime comes, they understand they're in the new regime and they start forming expectations again for the next one. But also what we see is that these beliefs about monetary policy regime change over the sample continuously evolve outside of tight windows around FOMC announcements, okay? And why is this happening? Well, likely because announcements contain forward guidance on the likely triggers of a change in the policy conduct. So again, Powell and the FOMC are saying, we're going to be looking closely at inflation. We're going to be data dependent. So that means that because of something Powell said at Jackson Hole, markets are still revising their expectations of where monetary policy is headed on the basis of new data in between announcements. And so data in between Fed communications can cause revisions in beliefs about future monetary policy that has consequences for markets. That also tells us that event studies underestimate the causal impact of the Fed on markets. Okay, let me just skip through here. There are large jumps in markets and expectations around FOMC announcements. Big jumps in the stock market. You see exceeding 2% in absolute terms for the negative jump, 4% in these tight 30-minute windows. Also some big jumps in professional forecast revisions the day before to the day after of inflation and GDP growth. Okay, so, and then also big jumps in futures markets and the BAA spread. Okay. So what do markets learn from these Fed announcements? Well, we're going to ask that question. I'm going to show you our estimate of the contribution of revisions in investor perceived shocks and in beliefs about future policy to jumps in high frequency variables in tight windows around the FOMC announcements. Now, what we're going to show you here are perceived shocks. The combination of the high frequency filtering plus the structural model mean we can infer investor updating not only of, ST, that is their nowcast of the entire economic state, but also of the composition of the shocks they think are hitting the economy, right? So each of ST is the shocks there are the primitive shocks, right? So these are sort of perceived shocks. Why do they change their nowcast of ST? And we can just focus on the 10 most quantitatively relevant announcements out of the 220 for a particular variable, such as the stock market. So that's what we're showing you here. We've got a decomposition of these movements and these variables into components attributable to the perceived shocks, which are listed down here. These are our primitive shocks, and to beliefs about monetary policy regime change happening in the next little while. It could be, I think it's next year here. So what you see here is that most events, like look at this panel C, are associated with a downward revision in the 6-month Fed funds futures rate, implying that policy more often than not surprised markets by being more accommodative than anticipated in our sample. That's consistent with evidence from previous authors, and that's what you're seeing here with these big downward jumps. By the way, data versus model, you know, the difference between those are observation errors in our measurement equation. We don't have any observation errors in some of the variables, such as the stock market, so those lie on top of each other. Now, the biggest jump here was, in terms of what moved the market, was the FOMC announcement of January 3rd, 2001, when the Fed lowered by an unusually large 50 basis point. The surprise movements, though, we can see from these plots are, you know, not solely the result of a perceived monetary policy shock, right? So actually what happened here is there was a downward revision in nowcast for the liquidity premium, an upward revision in nowcast for aggregate demand, and the earnings share of what the piece of the pie that shareholders were going to get. Okay, so those are key components. These things affect different variables differently. But, you know, for example, for inflation, expectations jumped up right after this announcement. Why? There was higher perceived demand. And so that's what this is showing you. The market was up 4.2% in 30 minutes around the announcement. And that was driven by higher nowcast for demand, for the earnings share, and a lower liquidity component, and that moved the risk premium down, as well as an accommodative shock. But you can see that the accommodative shock was not the biggest driver. Okay, so this does show the role of information effects stressed by these other authors, but what we're adding is granular detail on why expectations were revised. Okay, now if you want to sort things by, you know, what were the announcements that gave us the biggest jumps in beliefs about monetary policy regime change happening, these are the top 10 for those. And so these are different dates. And so in the first panel, I'm showing you what was the change in the perceived probability of a policy regime change. Just look at this big jump here. And the bottom panel, we're plotting in that same tight window, the model's estimated decomposition of the price payout fluctuation. Okay, so the price payout is decomposed into the present discounted value of subjectively expected future payout growth, excess returns, and real interest rates. And what you see here on the part of investors is that on June 24th, 2009, the Fed announced, what did it announce? They're going to maintain the federal funds rate close to zero, continued expansion of the balance sheet, and keeping rates low for long. This is a mantra of Ben Bernanke for several years after the recession even ended. So this was right as the recession was ending. And so this was the announcement. What did this do? Well, you can see that it drove down the price payout ratio. Market fell on this announcement. And why did that happen? Well, because in the post-millennial period, a decline in the perceived probability of exiting the policy rule, that's what happened here, consistent with the idea that we were already in an accommodative monetary policy regime. That announcement just reinforced the idea that we were going to stay in this previous regime. And that's what we see here. Well, that contributes to a decline in the market because the subjective perception of stock market risk rose. That's this big yellow bar. Now, why was that? Because the lower perceived probability of moving to the alternative post-millennial rule, which had a more active Federal Reserve, more actively engaged in stabilizing the economy, implied higher expected volatility for investors and greater perceived quantity of risk in the stock market. Okay, so now the dovish tone of the announcement did support the market through these. Can I just finish this slide and then go to the conclusion?
Yes.
Perfect.
Yes, please.
Thank you so much. There was the dovish tone of this announcement. It did support the market. That's this negative, downward blue bar, because lowered expected real rates in the future, but not enough to offset this increase in the subjective risk premium. Okay, so let me skip through these things and just conclude. What have we done? So we've integrated a high-frequency monetary event study into a mixed-frequency macro finance model and structural estimation. We have modeled what we think are more plausible non-recurrent regime changes. You know, when the Fed changes its stance of policy, we never go back exactly to, we shouldn't expect we're going back exactly to a regime that is going to repeat something in the past. Maybe agents today are expecting, you know, maybe there's been a regime shift and they're expecting, maybe they're expecting something more like the Volcker sort of disinflation policy rule that we saw in the Great Moderation regime, but it's probably not exactly the same. So then we use forward-looking data to infer what agents expect for the next policy regime. This methodology also gives us rich, granular detail on why markets react to news and can be used in other settings. I mean, it could be any kind of news, and to assess responses, to assess why markets are responding to monetary or non-monetary news. In this particular setting, why do markets react so strongly to central bank communications? What we find is one, well, first of all, beliefs about future policy react even if current policy, you know, on short rates, current policy is completely unchanged, and this affects the perceived quantity of risk in the market. Second is realized shifts in the policy rule do have a persistent influence on short rates in this model because of this sluggish expectations of the macro agent, right? And that affects how active the Fed is in stabilizing the economy too. They have to be very active, and so this affects valuations. And third, there are these occasional big revisions around announcements in beliefs about the economic state. There are these information effects that occasionally happen in times mostly of important economic change, as with the FOMC announcement of January 3rd, 2001, when the market surged 4.2%. Finally, we do find that much of the causal impact of monetary policy on markets occurs outside of these tight windows, and that just underscores the extent to which event studies understate the impact of policy on markets. Okay. Thank you.
Thank you very much. We have now 10 minutes for discussion and questions. Any questions, comments, please?
Very interesting, Sydney. Thanks a lot. A quick question. Can you actually also relate the shift in beliefs of market participants to you know, what the literature calls this pre-FOMC announcement drift? Like, can you rationalize that, you know, people update their beliefs about the future stance of policy or the regime, and then this can potentially rationalize that the market starts drifting up before already? And more like an understanding question, so like if I saw your estimate of like the Taylor coefficient on inflation in the kind of 70s, it was like 1.48 or so. Like, you know, previous estimates of this coefficient have kind of implied that maybe it was the Taylor principle was not satisfied, and that's why we saw bad macro outcomes during that period. So like, can you maybe discuss that a little bit? I think that would be helpful. Thank you.
Thank you. Those are great questions. So we have been focused on jumps in markets after announcements. You know, I think it's a really interesting suggestion to think about pre-FOMC announcement drift. In principle, I think you can absolutely use this type of framework to get at that. What you probably would want to do is have, so what we're basically doing is we're rerunning this filter in tight windows around the announcement. So we run it first 10 minutes before and then 20 minutes after. And then the difference in our estimated economic state is what gives us these jumps in what we infer is happening to investor beliefs, because we're using forward-looking data to infer those. So you could rerun that at every instant leading up to a market response, or, you know, for a while afterwards as well, right, to see how things are shifting around. So I think it's a really interesting suggestion. And I think it's totally possible to do. what you would just need is to keep that high frequency data, around and to start loading it in earlier. If the literature says 1 day before the drift starts, then you could do a 1 day before, or maybe it's 2 days and then 1 day, and then try to get a sense of any kind of news that might be moving that around. So I think that's a really interesting suggestion. We haven't done that. The Taylor rule coefficients, yes, indeed. The previous estimates are done in sort of more of a reduced form way. We're doing this within a structural model, so that's going to have some impact. But also remember that we have a lot more data than many of those early estimates. We're going out to 2020. We haven't tried to trace back all the reasons why we're getting different estimates. I think there's so many differences between what we're doing with our structural estimation and the structural model and what was done in the past that it's going to be hard to do that, plus all the new data. But I would just say for us, the most important aspect of that is that this activism coefficient was lower quite a bit than what we saw in the Great Moderation regime, which makes sense to us.
Thank you. Other questions? Comments? Yes.
Hi, Sydney. This is Ben Moll. Great paper. So I had a more big picture question about sort of what does your theory and your estimates say about sort of central bank communication and I guess these shifting investor beliefs. So if people behave like this, what does this mean? For example, can the central bank somehow exploit these dynamics and try to shift these beliefs? On the other hand, it seemed like these beliefs are kind of pretty sluggish in your estimate. So yeah, can you just talk about that a bit?
Sure. Yeah. So can the central bank exploit the beliefs? We haven't even gotten into trying to model I think would be interesting, but also I think tricky for us to handle in this setting, given everything that's going on, is to have the central bank reacting to these beliefs. I think in principle you could try to do something with these coefficients and why they're changing, right? Now we've avoided trying to place a structural interpretation on too much of a structural interpretation on those shifts. We are agnostic about why the policy rule changes, but I think what you're getting at, Ben, is it's possible that the policy rule is going to change for these reasons, and implicitly in our minds we do have some of that in there because this implicit inflation target picks up on some of that. So it's not the long run stated objective of the central bank. So for example, if one interpretation of why how QE, for example, or forward guidance would affect the policy rule is through that implicit target. So if Bernanke and the FOMC at that time is trying to lift inflation because we're stuck in a very sluggish recovery from the Great Recession, and then QE could show up in this higher implicit target. They're implicitly trying to set a target that's much for inflation that's much higher than 2% in order to achieve these objectives. Now, in the model, the macro agent does get a signal about the target from the central bank, and we estimate sort of the weight on that signal. That it's a result that it's very low, which can be interpreted to say that it's possible that households either ignore the central bank or don't fully understand its messaging or don't view its messaging as sufficiently credible. But there is, in the model, we do estimate that household long-run inflation expectations, even disciplined by the survey of consumers, do move slowly towards this implicit target. So I think that's a bit getting at something that you're talking about here, that just, it does seem that one of the reasons maybe these parameters change over time is that the central bank is trying to overcome the sluggishness as much as possible. So you can imagine trying to be really loud with your forward guidance, tons of QE, to really move up that implicit target and try to inch along inflation expectations slightly faster. Now, that said, because we do estimate these small weights on this implicit target, and because we also estimate that in the constant gain learning algorithm, there's just not very, it's very slow updating from past inflation. That channel is just very muted. So another way to say that is, it does seem like our results are saying it's really hard to replicate accommodative monetary policy at the lower bound with QE or forward guidance.
Thanks, perfect. Yeah, no, that's exactly what I had in mind.
Thanks. Yes, please.
Hi, thanks. Very nice paper. I have just kind of a clarifying question. I suppose that you've already talked about it, but I kind of missed it. So to what extent do these changes in investor beliefs that you identify map into actual changes in monetary policy regimes? Can you sort of ex post validate whether these changes are rational, or are they actually using a sort of a Bayesian updating, or is that just embedded in the model by assumption that they are kind of using a rational updating? And related to that, is it possible to say is it that the way this works, is it like policy regimes change and then the investors change their beliefs, or are these investor beliefs more like forward-looking and so they anticipate regime changes before they occur?
Thanks for those questions. So so to the first point, remember that we have okay, so let me just, I realize I whizzed through a lot of things. We have these structural breaks, basically. Investors in the model understand that there are structural breaks. Now, if you think about it, how is one supposed to form expectations in the presence of structural breaks? It's very clear if you have recurrent regime switching, right? You know that, okay, we form an expectation of where we're going to be based on knowing the probability of switching between regimes. With structural breaks, it's not as clear. So what we have assumed, and this also is, what does it mean to have rational expectations in such a framework with structural breaks? So what we have done is we've said, agents understand that when there is a break, they understand that the break has occurred, and they immediately update to the new policy rule. In other words, we're assuming that they can, the Fed clearly telegraphs what it's doing, and they now understand there's been a break, we're in this new rule. What they're uncertain about is how long they'll stay. So as you saw in that one picture I had, there is some sense in which agents can anticipate these regimes because the belief about regime change rises, the probability of regime change exiting the current regime rises before the actual breaks. So we do find that. Now, I don't know if that's rational or not, because it's hard to think about what rational expectations means. There's also mistakes, right? But, the way we do it is that they have to form an expectation about what's coming next. And so that's sort of forward-looking. I'll call that forward-looking. It turns out that they're not always right about what's coming next, right? So we estimate in each regime what they think the next regime is going to look like, right? That comes from our estimation as well. And they're not always right about that, but that could be an ex post mistake. But they are forward-looking, so they are forming expectations about that. And then there's their beliefs about how likely they're going to change to the new rule, like say next period. We have a monthly decision interval, so that could be as little as 2 weeks down the road is what's jumping around. Okay, so that's how we do it. So it's not exactly any kind of rational updating, because we have to think carefully about how our expectations formed in the presence of structural breaks. And there, in order to keep this estimation problem manageable and not have a proliferation of parameters, we have to put some restrictions on this. And so, like how many alternative regimes can you have in your mind? at one time. Right now, we just assume one. You could, in principle, have more than one, and then investors assign probabilities among those. So there are things you can do. It's just that, it already takes a very long time for us to do all those things. And again, it's not, none of this fits into any kind of neat rational expectations category, I think, once you start talking about structural breaks.
Okay, thank you very much. Let's thank Sydney with the usual way. Thank you very much.
Thank you. Thank you for having me.
So we will come back 1:15. Okay, welcome back and to the last contributing session of today. We have 3 papers. The first paper is on site, and the second 2 other papers are online. So let me welcome Julian Bengui to start with stagflation and topsy-turvy capital flows. Please, you have 20 minutes.
Okay, thank you very much for having the paper on the program. So this is joint work with Lufu Koulibaly. And because we're both with central banks, I have to have this disclaimer saying that these are our views and not those of the institutions we work for. So this is an open economy topic. And the motivation for the paper is very much, or has very much to do with the recent and ongoing surge in inflation, and then the aggressive policy tightening that has been caused by the surge in inflation. And so on the left figure, this surge in inflation is sort of shown for G7 economies with inflation figures for 2020, 2021, and an estimate for 2022. Sorry, there's a typo here, but the black line should be 2022, and that's based on Bloomberg consensus forecast. Actually, the numbers would be even bigger now. I think they're from July, but what we see here obviously is that inflation is rising in all of these countries. Now, this has led to a very aggressive sort of policy tightening cycle, which we see on the right picture, again for G7 economies. And from an international macro perspective, this very rapid raise in interest rates in advanced economies is really raising the specter of a new taper tantrum, which would be large and sudden capital outflows from emerging economies. Now, one question that's very present in this context is whether there are reasons to believe that such capital outflows would be excessive, or whether they would just be an efficient response to changing conditions. And in particular, given current circumstances, one thing we could be asking is whether this assessment, whether they're excessive or not, should depend on whether on the current situation in which stagflation prospects are increasing, and in which output inflation trade-offs are sort of starting to be important again after not really being a top priority or concern rather for many years. And so the context in which we sort of ask these questions is one of a fairly large literature in international and monetary macro that points to a number of imperfections in financial, goods, and labor markets as possible cause of excessive capital flows. Because I've cited just 2 papers here as examples, but this literature over the last 15 years has, for the most part, really ignored any role of output inflation trade-off and obviously of the possibility of stagflation. And so what we are doing in this paper is to document a property of the very basic standard open economy new Keynesian macro model that basically is that capital flows are typically going to be excessive in a situation in which there is an input of inflation trade-off that's of a different stringency in different regions of the world. And the way that these capital flows can be excessive is, can actually be quite extreme. The flows for reasonable parameter values can even go in the wrong direction, hence our title topsy-turvy. So what is the story behind that, or behind that result? it turns out that there is a macroeconomic externality in these models that's associated with external borrowing that operates through the economy's supply side. And the story is simply that when I'm an agent, I borrow, I'm going to be consuming more. When I consume more, I'm going to be wanting to work less. I'm going to basically be pushing up in equilibrium real wages. That's going to be increasing the labor costs and therefore marginal costs for domestic firms. And if I'm in a situation in which the central bank is already struggling to stabilize inflation and is generating a recession in order to stabilize inflation, then me pushing up marginal costs is going to make the central bank's job even harder. Okay, and I don't think about this when I decide how much to borrow and how much to consume, but this is something actually that's an implication of my choice. And so as a result, I'm going to be borrowing typically too much if I'm in an economy where the central bank is struggling to stabilize inflation because of an inflationary cost push up. That's sort of what the story is. And it's just here represented graphically in this picture. That sort of shows that the menu of available options in this inflation output variability space is going to be made worse by private agents' choices to borrow from abroad. Okay, so that's the main idea of the paper. Okay, so let me try to sketch very briefly the model that we use to make this point. So we're using essentially the most simple version of the open economy model with nominal rigidity that people use typically to study monetary policy in open economy. So we're going to have two countries, very standard preferences with this utility from labor and log utility from consumption. Also, are going to be consuming both home and foreign goods. And for the presentation today, I'm going to be focusing on a case where there is no home bias, where basically like the weight of home and foreign goods in the consumption basket are the same. It's going to simplify a bunch of things, and I'm going to be telling you a bit later what happens when we relax that. On the supply side, we're going to have standard assumptions, monopolistic competition, nominal rigidities in the form of Calvo pricing. And then for everything else, I'm going to be basically making the assumptions that are the most standard or sort of the most basic, and it's going to be to emphasize that actually the externality that we stress is going to be there even without further frictions than that. Okay, so I'm going to be assuming flexible exchange rates, so no extra constraints on monetary policy, no ZLB, no PEG. I'm going to be assuming that monetary policy is set optimally, sort of the best monetary policy we can have. We're going to have it optimally under cooperation and commitment. No further frictions on the currency pricing side, so PCP and the law of one price holding, and then complete financial markets. And so I'm not going to be introducing any frictions on financial markets yet. I'm going to argue that we will have in this very standard model excessive capital flows. Okay. Now the thing I want to have too is cost push shocks that are going to be generating an output inflation trade-off, and we think it's something that's very important to capture the current environment in which we are now, where many major central banks are ready to risk a recession in order to stabilize inflation. Okay, so I'm going to go straight to some linearized equilibrium conditions of the model. So the first one here is simply one saying, so this is a model with nominal rigidity, so output is going to be demand determined. So output, for example, in home is going to be given by, it's going to be an increasing function of domestic consumption, foreign consumption, and then a term that's going to reflect relative prices. So S is going to be the terms of trade, eta is going to be the elasticity of the substitution between the home and foreign goods. So basically, the cheaper my own good, the more people we wanna consume it. I have a risk-sharing condition here, even though I'm not going to really have any uncertainty, that absent any frictions on financial markets or absent any intervention on financial markets, is going to say that consumption is equalized across countries. Okay. Now this data that I have here in blue is going to be a device we'll use to essentially study whether there is any benefit for policymaker from deviating from this condition. So it's going to be a wedge in this Baker-Smith condition that we'll interpret as like basically a policy tool, which we can then actually, so we can think of ways to implement any paths for these variables using, for example, taxes on capital inflows. But that's basically going to be not a shock or not anything endogenous. It's going to be something that policy may choose if it's optimal to do so. Okay, so theta equal to 0 is going to be the free capital mobility benchmark that we'll have in mind, and then we'll be asking whether it makes sense for government to deviate from that benchmark by, for example, pushing capital flows, more into one country or into the other country. Okay, and then the last equations are simply the New Keynesian-Phillips curve. We'll work in continuous time for the first one, and the second one is going to be an expression for marginal cost, and this is actually where this data is going to be showing up. And so, in addition to being a function of the output gap, which is going to be y here, and the terms of trade s, marginal costs are also going to be a function of this data. And the reason here is that this data is going to be controlling essentially the relative consumption across countries. So if a country has higher consumptions, and the workers in this country are going to be requiring asking for higher wages, and that's going to drive up marginal costs. Okay, so that's going to be there in this model, and this is a model where wages are flexible, and which is sort of the standard assumption in this sticky price New Keynesian model. Okay, so what we'll do here is we'll set up an optimal policy problem and basically be asking what is the optimal path of this data. Okay, to ask, is it different from 0? If yes, what does it look like? Okay, and so I'm going to be having here an optimal policy problem. So I work with the second-order approximation of the household utility function around the efficient steady state. I write the model in terms of world variables that are essentially world aggregates, and difference variables, which are differences between home and foreign. That's a very standard way of proceeding. And then I'm leaving out the world variables because their determination is completely independent of any international variables like relative prices or this data. Okay, and so here the problem I have is essentially an optimal monetary policy and capital flow management policy problem. The optimal monetary policy part would be would be there if we didn't have the tau, but then with the data, sorry, but then with the data it's also an optimal capital flow management policy problem. Okay, so I'm minimizing this loss function, subject only to this New Keynesian-Phillips curve indifferences. And then I'm summarizing here optimal policy with two targeting rules. The first one should be fairly familiar with with any closed economy or open economy version of this model that wouldn't have any of this capital flow stuff we're trying to talk about. And it's basically showing that if you have cost push shocks, it's typically going to be impossible to stabilize at the same time inflation and output. So this is sort of where the output inflation trade-off shows up. So this together with this New Keynesian-Phillips curve with a non-zero cost push shock, that's going to be a situation where we have to open these two variables essentially, and therefore we're not going to be at the efficient allocation. And the new thing is a sort of amazing simplicity of the targeting rule for this data. Okay, so what does it say? Well, first, the first message is that if we have an inflation output trade-off, then typically the output gap is not going to be 0. So it's not going to be the output gap is not going to be the same across the two countries, and therefore, as well, the theta is not going to be 0. Okay, and so the free capital mobility regime in general in this model is not going to be constraint efficient. So it's going to be will have excessive or insufficient capital flows. Okay, now the second more kind of qualitative message is that what the intervention calls for is to redirect or reallocate demand away from the country whose output gap is the most negative. So if you think of one country being hit by a cost push shock and the other one not, or the other one sort of being hit less, then the country with the most negative output gap is essentially consuming too much. Okay, so it's going to be getting too much capital. So if we're in a situation in which this country is actually receiving capital inflows, the capital inflows are going to be excessive. If it's saving, so if it's sending capital outflows, then these capital outflows should be larger. Okay, so I'll talk about these different possibilities, but this is sort of what we can see from this targeting rule. Now, what is the intuition? Let's just think about as a starting point the free capital mobility, the equilibrium under free capital mobility. Okay, so this would be one where we have this policy problem but without the theta, or with the theta being constrained to be equal to 0. And then let's think about, just for one instant, increasing theta, which basically means increasing the amount of borrowing by the home country. Okay, and then we can ask the question, what is the effect of this perturbation on welfare? And then we can apply the envelope theorem here, which basically shows that the effect on welfare is going to be given by the product of two terms. One is how the cross-country differences in marginal cost is going to change with this higher theta, or more capital going into the home country, and the multiplier on the Newkens and Phillips curve. Okay, so if this multiplier is 0, let's say because we don't have any cost push shocks, or because, and so we're just dealing with, let's say, demand shocks, then there is no effect on welfare. Okay, if this multiplier is positive, then actually the loss is going to become higher. Okay, and so by raising marginal cost, if I were to somehow borrow more, I would make the central bank's policy trade sort of more stringent. And so I would force the central bank to either create a bigger recession in order to stabilize inflation at a given level, or I would have to let the central bank essentially stabilize inflation less for a given degree of recession or output depression. Okay, and so whenever the Newkens and Phillips curve is going to be binding here, we'll have an inefficiency. Okay, now it's not an inefficiency that is necessarily like minor or small. And to see that, let's think about the pattern or the way that capital flows behave in the two allocations that we were kind of interested in comparing. One is the free capital mobility case, and the other one is the optimal capital flow management regime. Okay, so in the free capital mobility case, what drives capital flows, or what drives intertemporal trade between the two countries? It's simply going to be two neoclassical motives that are very familiar from the work, or at least since the world of Kohl-Obstfeld. Basically, one is that when I have low output, I want to borrow more, just because my output is my income is going to be higher in the future. But then when I have low output, the value of my good is going to typically be higher, so my terms of trade will appreciate, and that's going to make me want to borrow less or save. Okay. And so these two effects are competing in some cases. Like basically, like if in some cases the first one is bigger, in some cases the second one is bigger. That depends all on elasticities. And if the intertemporal elasticity between the two goods is sufficiently large, then we're going to be in a situation in which if I have more negative output gap than the other country, then I'm going to be having a trade deficit. Okay, and so this is a case basically where elasticities are being high, terms of trade don't move too much, and so the first effect is going to be dominating. And then under Kohl-Obstfeld parametrization, where elasticities are equal to 1, and actually this is always going to be 0, so we won't have any capital flows across countries. So these are the two forces that are present under free capital mobility. Now, in the optimal CFM, capital flow management regime, what happens is that in addition to these two forces that are also there, we also have a Keynesian force, which basically says that the country where the output inflation trade-off is sort of the most stringent or the most unfavorable, that country should be consuming less. Okay, and when we add this third effect, it turns out that the expression for the trade balance becomes the one I have here. And in the one I have here, when eta is bigger than 1, so when the intratemporal elasticity between the two goods is larger than 1, I'm going to get a different sign for the trade balance. Okay, in this case, I'm going to have capital outflows from the country whose output gap is the most negative, which is typically the one that's being hit the most, the hardest by the shock. Okay, and this is the sense in which we can have topsy-turvy capital flows. So in situations where under free capital mobility, country being hit by a shock harder is going to be experiencing inflows, it will experience outflows under the efficient regime. Okay, so now I'll try to make this a bit more tangible in the last 3 minutes. Yeah, I'll skip this. I can relax the assumption of no home bias, and when we do that, we get an extra sort of channel through which externality operates, which is through terms of trade, this term here. And so we can essentially show that for most plausible parameterization, we're going to be in the case that I discussed so far anyway, even in the model without this home bias. Which is that we have excessive capital flows towards the country that is being hit the hardest, or that is sort of experiencing the biggest recession. And we also have topsy-turvy capital flows in a sense that this country is actually receiving inflows while it should be experiencing outflows. Okay. So to make sort of the message a bit more tangible, one thing we do is we look at the cost-push shock scenario in which, let's say, the home country is hit by an inflationary shock that is temporary, that's unexpected, sort of an MIT shock. And so when we do that, we can actually solve graphically for the entire equilibrium path of the variables. I'll go a bit briefly over that, but basically we can formalize everything and sort of represent everything in terms of a very nice phase diagram, where in orange here I have the dynamics of both output and inflation under free capital mobility. And then we can also sort of see how the different loci are moving under the optimal capital flow management regime, which is the green case here. And what we can show graphically is that the entire path of both inflation and output becomes more stable. Okay, so this is done for sort of very, very stylized path for the cost push shock. If we take a cost push shock path that's a bit more sort of in the mean reverting and try to do impulse responses in the sort of traditional macro modeling sense, we can see the same thing. So here I've just basically calibrated the model based on a recent JME paper by Groll and Monacelli, where they look at the effect of cost push shocks as well, but how these shocks or how the propagation of these shocks depend on the exchange rate regime. So I take their parameter values, which are fairly standard, and then I can run again these impulse responses. So here, first I have the case of free capital mobility, so no intervention. And the thing I want to point to is fairly large recession, capital inflows into the home country, which is the one experiencing the shock, or experiencing a larger shock. And then under the optimal capital flow management regime, so this constraint efficient capital flows, I do get the opposite. So I do get capital outflows out of this region to the other region, and that generates benefits in terms of milder recession, a better stabilization of home inflation, and it doesn't come at the expense of less stable inflation output gap in the foreign countries. Actually, the opposite. These two variables are more stable. Okay, so what I'll just conclude. So what I've done here, sort of tell you about the main point of our paper, which is to point to a macro externality that operates via firm's marginal cost in a standard open economy model with dominant rigidities. So typically, like larger models are going to be building on this one. So this is a feature that's going to basically be present in many more models than the one I've just shown. When a monetary policy faces output inflation trade-offs, the externality causes excessive capital flows toward countries with the most depressed output, and capital may even flow the wrong way, hence the title topsy-turvy. So we think this is casting further doubts on the classical view that free capital mobility promotes macro adjustment, especially in the current context where stagflation concerns are high. And then I just want to point to one more thing, which is that we think this externality that we talk about has probably some wider applicability. So after all, this model I just showed is nothing more but a two-agent model with an inflation output trade-off. And so that's going to be a mechanism that's going to be present as well in any closed economy model with a bit of heterogeneity, and typically where we'll have multiple sectors, such as in Henk models, for example. Okay, and so we're trying to think now about some application in a closed economy context of this externality that we've talked about here.
Okay. Thank you very much, Julien.
Thank you.
We have a little bit of time for questions, comments. Yes, Matti, please.
I just wonder what might be the optimal policies in this kind of context, except for some structural policies which go in the root causes of the problem.
I am not sure I understood it. Could you repeat the question?
Repetito. So the question is really that in terms of this kind of setting, okay.
Mm-hmm.
So what should we think about optimal policies?
Okay, so
are they only something like structural policies which go in deep, the reasons of this competitiveness and something like that?
Okay, so you're, if I get the question correctly, is what I've done is solve an optimal policy problem where we're not getting to the first best. Okay, so we wouldn't be getting to the first best with monetary policy alone. We don't get to the first best with monetary policy plus capital for management policy. Are you asking about whether there are some other policies that could actually dominate what we're doing here? It's possible. So. I mean, for example, like a policy that would sort of directly offset the cost push shock, I think might be a policy that could work. I'm not sure how we could map that into sort of fiscal policy, but yes. So we're I mean, the broader point is we're trying to think about a situation in which there is such a trade-off, and the trade-off could be just because we only have monetary policy, or because we have other tools as well, but these other tools are not sort of good enough to take us to the first best. I think if as long as that's true, then our point is going to be valid. But if we can eliminate inflation without creating a recession right now, then my point won't really apply. Yeah.
Thank you. Any other questions? Benjamin, please.
I just had two, I think mostly understanding questions. So the first one is, can you just explain again why you want capital to flow away from the country with the depressed output? And I guess I just have the intuition that you want to have insurance across the two countries where you equalize the marginal utilities, which I think was sort of your C equals C star, but then you want to break that. And I guess related, which I think is the reason for this, can you just say again in plain English what exactly the externality is?
Sure.
If that works through the marginal cost.
Yeah, okay, that's great. Okay, so basically what's happening is that, so the externality is the following. Let's say I'm in an economy where the central bank has engineered a recession because of an inflationary cost push. Okay, now I decide about how much I want to borrow. So I'll just think about my utility today and tomorrow. Okay, now but when I borrow more, I consume more. In equilibrium, that's going to make me want to work less. Okay, so my labor supply curve is going to be shifting up. Okay, that's going to lead to higher wages in the country where I live. I mean, I'm small, but if everybody does the same, it's going to lead to higher wages. Okay, now higher wages is going to mean that firms want to set higher prices. But then the thing that monetary policy was trying to achieve was precisely that firms would set lower prices, and it was engineering a recession for that purpose. So I'm kind of undoing what monetary policy is trying to achieve. And the way my decision transmits through everybody else's welfare is actually through a market price. So it's similar to a pecuniary externality, but it's not a pecuniary externality that is creating inefficiency because of market incompleteness distortions. It's creating externalities because of sticky price distortions or sort of wedges caused by sticky price distortions. But that's the reason.
Okay, perfect. But so then I have a follow-up question. So thanks, that was super helpful. Which is, it seems to me then from what you just said that it relies quite heavily on the income effect on labor supply.
Absolutely.
So if you had, say, GHH preferences, would the whole thing kind of go away?
Yeah. So it would. Short answer is it would. So in the version of the model without home bias, then me consuming more, in addition to potentially having an effect on wages, is also going to have an effect on international relative prices, and that's going to, in itself, also lead to movements in marginal cost. So independently from what happens to the wage. But in this version of the model where everything was going through the wage, if you kill that by either having completely rigid wages or by having GHH, then there is no more inefficiency, and then capital flows are sort of flowing perfectly fine. Yeah.
Perfect, thanks.
Okay, thank you very much.
Thank you.
Julian, then we have to move forward. And I think the next speaker should be online, if I understood correctly. Yes, okay. The next speaker is Vadim Elenev from Johns Hopkins. Vadim, can you hear us?
Yes, I can hear you. Can you see and hear me?
We don't yet see you in the screen. Can you press button for the next slide? Yes, okay. Now we can see you. Let me remind you that you have 20 minutes. It's very technically very hard for me to discipline you, so you have to be very self-disciplined. So you have 20 minutes.
Okay. I'll set my phone timer and discipline myself. So sounds good. Well, thank you so much for having this paper on the program. It's really wonderful to be there, although virtually instead of in person. This is joint work with Tim Landvoigt at Wharton, Patrick Schultz, his student, also at Wharton, and Steen van Nieuwenburg. So what motivates this paper is the phenomenon we've observed over the past two crises, the Great Financial Crisis and the COVID crisis, where there's been a ton of government debt issuance to finance large and persistent primary deficits. Now, to some extent, this fiscal expansion has been supported by conventional monetary policy. Not only have interest rates gone down over a low frequency trend, they've also stayed low for long periods after both crises. And in addition to conventional monetary policy, the fiscal expansion has also been supported by unconventional policy. With a substantial expansion in the Federal Reserve balance sheet, Fed bought a good chunk of these treasuries. Particularly, if you focus on the recent episode, right, on the post-crisis period, the Fed purchased the entirety of new issuance of long-term debt. So you see in blue a big increase in long-term debt. All of that was effectively absorbed by the Fed and therefore backed by reserves. So it was really short-term debt in the end. All of this leads us to pretty natural questions. How will this debt be repaid? Will it be through faster growth? Will we inflate it away? Or will tax rates have to go up at some point? And in this paper, we're going to ask a question, can monetary policy, or to what extent can monetary policy reduce the fiscal burden? By fiscal burden, we mean reduce debt to GDP that then necessitates these three possible ways to pay it off in the future. And let's just think of different ways that this could happen, starting with partial equilibrium. Well, monetary policy has direct effects on debt service. Conventional monetary policy can lower short-term bond yields by keeping rates low. It can lower debt expense by condoning higher inflation, inflating away the amount of debt. On the unconventional side, it could lower long-term bond yields. And lastly, of course, to the extent the yield curve is upward sloping, unconventional monetary policy that effectively shortens maturity lowers debt expense by shifting expense down the yield curve. Now, on top of that, there could be a lot of general equilibrium effects on primary surplus, GDP, the future path of GDP, and all these phenomena. So it really demands a holistic quantitative understanding. So what we're going to do in this paper is we're going to study fiscal and monetary interaction during and after an economic crisis in the following setting. So because we are interested in monetary non-neutrality, we're going to start out with a New Keynesian model. Because we're interested in non-neutral effective QE, we're going to have an intermediation sector. We're going to have fiscal and monetary authority. And it's going to be important for us to have realistic asset pricing because we're interested about the path of interest expenses and therefore the path of the interest rate. and how it responds to various risks in the economy. So once we've calibrated this model, we're going to hit it with a crisis, which is going to be a negative aggregate supply and aggregate demand shock that push the economy into a zero lower bound and cause a large contraction. And in that setting, we're going to analyze macro, financial, and fiscal impacts of the various policies. So to give you a preview of the results, the answer to the title of the paper is a qualified yes. Unconventional monetary policy can in fact create fiscal capacity. And the way we arrive at this answer is as follows. We're going to feed in a data generating process into this model that's going to be kind of the policy that we believe was followed in the data, which is a combination of additional transfer spending beyond kind of what agents expect and unconventional monetary policy lasting into the recovery. And then we're going to turn off these policies and find that a counterfactual is a much deeper recession. But more specifically to the point of this paper, it also means higher debt to GDP after a crisis. So these policies lower debt to GDP kind of in the medium term. Another way to think about this is that unconventional monetary policy reduces the risk of necessary future tax increases by about 20% if you start out at a fairly high debt level of 85% debt to GDP. Another experiment we're going to do is more motivated by, say, the 2021-2022 monetary experience. So we're going to start the economy in kind of a recovery path, but with a high stock of government debt. And we're going to consider what happens if there's a surprise increase in transfer spending without kind of taking a stand on why it happens. You could think of this as the ARPA or the discussed BBB program or maybe student loan forgiveness, something like that. And then we're going to see if in that economy, temporarily adding debt stabilization to the Taylor rule, basically the Fed assuming a third mandate, if that could lower debt to GDP. And we find that in fact it can, but of course that has to be kind of an unanticipated short-term phenomenon. Permanently switching to this Taylor rule, in fact, will have the opposite effect. Now, let me briefly kind of talk you through the model, just highlight a few key features. This diagram represents the basic building blocks of the model. We're going to have a production block over here. The production sector is going to be getting capital from intermediaries and households. Intermediaries are going to be another type of firm that on the asset side will hold capital and short-term government debt, and will back these holdings with equity and deposits. And household is going to be the residual claimant of all the assets. They're going to hold long-term debt issued by the government, the claims issued by the intermediary, and of course they're going to also be the residual claimant to equity, so to the economic rents produced by the monopolistic New Keynesian producers. To highlight a few kind of key features of the model in a bit more detail, the exogenous risk here is going to consist of a mean reverting and a permanent component of TFP. The household that we saw, the balance sheet we saw on the previous slide, is going to have recursive preferences and receive utility from consumption, disutility of labor, kind of standard in New Keynesian models, and they're going to have utility from bank deposits. You could think of this as inside money in the utility, so a preference for liquidity. There's going to be two important frictions in the household problem. First, the household is going to face a capital holding cost, and the idea there is that the household is worse at intermediating than the intermediary is. So it's better for intermediary to hold capital. When the household does it, it has to pay a cost of doing that. The other cost is a bond holding cost that's increasing in the supply of long-term bonds. Now, this kind of is a reduced form way to capture something that's we really want to make sure we get empirically right in this model. And that's not just a term spread, but also the elasticity of bond yields to supply changes. And we kind of measure that in the data, and we really want to get this, this channel right. Moving on to the intermediary, as I mentioned, it's a firm that's beneficially owned by households. It's going to have the balance sheet we saw on the previous slide. And the thing that, one of the things that breaks Modigliani Miller here is an equity issuance cost. So that, the intermediary can't flexibly adjust dividends all the time, and a couple of other frictions. So like intermediaries in most models, there's going to be a regulatory capital requirement. The intermediary can't issue deposits more than a certain fraction of their assets. Now you see that there's two components to this capital requirement. One is a capital requirement that binds regardless of what types of assets the intermediary holds. So even if it's a narrow bank that only holds reserves, it still needs to hold some equity against that. But of course, the other component of the capital requirement is a relatively higher risk weight on the more risky asset. So to the extent that New K is below 1, That means the intermediary has to hold more capital when it equity capital when it holds more physical capital on its asset side. And the other friction is going to be a liquidity coverage cost. This cost is going to increase in the amount of deposits and decrease in the amount of short-term debt. It's kind of a smooth version of a liquidity coverage ratio. The reason we don't model it explicitly as a constraint is because we really have more things than just regulation in mind here. There's kind of unmodeled preferences for liquidity coming from possibility of bank runs, things like this that we just wanted to capture with this cost. Moving on to the policy side, right, from the private to the public side of the model. On the monetary side, there's going to be two monetary policy tools, a standard Taylor rule and the ability to do QE. So QE here is on the government debt side. So the intermediary or the central bank has the possibility of adjusting through purchases and sales of government debt, the maturity composition of debt held by the public. And because intermediaries hold short-term debt and households hold long-term debt, that adjustment also effectively changes the allocation of assets across intermediaries and households. On the fiscal side, there's going to be a standard government budget constraint. Short-term and long-term debt that are needed to finance deficits are going to be issued in fixed proportions over time. That's pretty consistent with the data. The government is going to spend money on purchases of goods, so think national defense, and transfers to households, think unemployment insurance, social security, things like that. And the government is going to raise taxes from firms and bank profits and also from labor income. And labor income taxes are going to be distortionary through the elastic labor supply choice of households. Now, the cyclicality of these policies is pretty important to generate kind of realistic paths of interest expense. So spending rules are going to be counter-cyclical. We think of these as automatic stabilizers, that the government spends a larger share of output in bad times and in good times. For taxes, we're going to have a couple of different regimes. So the first thing we're going to do in this regime one is a pro-cyclical tax regime. So kind of the opposite of what I just said about spending. Tax rates are going to be higher in good times, lower in bad times. Now, if that was the only tax regime we had, we'd basically have a model where the central bank is responding to the business cycle, the fiscal authority is responding to the business cycle, and nobody would be in charge of keeping debt stationary, so the government debt would not be risk-free here. So something has to give. And what gives is a second regime. In the tails of the debt-to-GDP distribution, so debt-to-GDP, for instance, gets really high, the government adopts a passive fiscal policy, where tax rates now depend strongly on debt-to-GDP to keep debt-to-GDP stationary. Effectively, in that region, and it's best to see in kind of a first result of the model, in that region, the government switches from insuring taxpayers through its tax policy to insuring bondholders. As you can imagine, with kind of this type of rule, you have a bimodal distribution of government debt, and we see kind of in between these two dotted line thresholds, the tax rate is what the tax rate would be just driven by the business cycle. But necessarily that tax rate has to increase as we get above this threshold, and these increases could get, in the calibration pretty substantial up to, in the extreme, to twice what the baseline tax rate is. And kind of more importantly, as debt to GDP fluctuates, taxes now fluctuate too, creating this additional source of risk for households. Now, ultimately, that's what happens kind of in the tail, but it's fairly infrequent in the model. And debt to GDP is really persistent, just like in the data. So agents are likely to observe long samples without fiscal adjustment. If you kind of think of the US post-war era, the way you would draw this path is you would start somewhere kind of about over here around 1 after World War II. You would kind of decrease for a while, and then you would increase back up to get kind of back over here. And that's just kind of one path. This is a histogram of thousands and thousands of years. Now, having built this model, we're going to, as I mentioned, hit it with a crisis. And let me kind of explain what we have in mind in this crisis. So a crisis is going to be a bad TFP shock, so a bad supply shock, and an aggregate demand shock, which models an increase in the discount factor. The demand shock, the supply shock is going to come from kind of the standard set of exogenous shocks anticipated by agents, but the demand shock is going to be unanticipated, and on average is going to last 2 quarters. For the duration that the shock is present, we're going to impose a zero lower bound, which is binding because the shadow rate is very negative. And then we're going to consider several policy experiments. The first thing is nothing new. The first thing is just the government following the policies that everyone expects, conventional monetary and fiscal policy rules with the automatic stabilizers. On top of that, we're going to add, in the second experiment, unconventional monetary policy, which consists of QE, where the central bank swaps 24% of the supply of long-term bonds for reserves, and a relaxation of the supplementary leverage ratio. So that basically allows banks to hold zero equity capital against reserves. So a narrow bank would not need to hold any equity capital at all. That's in fact what the Fed did in March 2020. The third policy we'll consider is additional fiscal policy, so additional transfer spending of 7% of pre-crisis GDP. Then we'll consider 2 plus 3 together. And lastly, we're going to consider a combination of transfers and unconventional monetary policy, but the monetary policy is going to last into recovery. So even though the crisis ends, monetary policy will continue. And agents will understand that this is going to be the policy at the start. Now, we're going to feed in, even though agents expect this shock to dissipate with probability 0.5, once it occurs, we're going to feed in 4 consecutive quarters to get a year worth of this shock. And we're going to calibrate the negative demand shock to generate a deflation of 1.5%, which is about what we saw in the Great Financial Crisis. Particularly, we're going to do this under the transfers plus long UMP policy. So it generates this deflation if all of these policies are followed. In that sense, we think that this green policy, the transfers plus long UMP, is the data generating policy. So let's look at some results. First, even though we pursue this transfers plus long UMP, there's a lot of fiscal and monetary support. The monetary policy rate is still at 0 as the lower bound, and you have a pretty significant deep recession of about 2.5% relative to trend while the shock is in place. However, the counterfactual, right, if you turn off all these policies and just go to automatic stabilizers, is a significantly worse GDP, worse consumption, cratering of inflation, and severe deflation. This is a severe demand-driven crisis. So let's kind of see, there's a lot of policies in play in this green line, so let's do some decomposition. So if you just do the transfers, you get about half the way there in terms of the output risk. Right? You boost GDP by 2% relative to what it would be otherwise. But of course, keep in mind that these transfers have a substantial fiscal cost, and we'll talk about the fiscal side next. If you then do unconventional monetary policy for the duration of the crisis, you get most of the way there in terms of output effect. And the remaining part, this remaining kind of difference between the purple and the top green line, that comes from additional expectations of this unconventional monetary policy persisting into recovery. Now, this is kind of the macro side, but really what we, the paper starts out trying to explain is the fiscal side. So let's look at what these different policies do for the fiscal side of the economy. So even with just just automatic stabilizers, there's substantial rise in debt to GDP, as you can see over here, driven by large deficits. Right? There's just more automatic stabilizer spending, less tax collection. Once we've introduced these additional transfers and unconventional monetary policy, which we do to match the deficit we saw in 2009, we get a substantially bigger deficit. Of course, all of that comes from the additional transfers. Relative to those transfers, unconventional monetary policy actually lowers the deficit by 1%. And that comes from the less automatic stabilization that needs to get done when the economy is not in such a bad situation. But what's really interesting what happens afterwards.
You have 3 minutes.
Okay. Afterwards, relative to just transfers, unconventional monetary policy depresses long-term yields going forward because there's specific intervention on the long-term debt side. There's lower supply of them, higher supply of short-term debt. These depressed yields lead to lower debt service costs and ultimately leads to lower debt to GDP. So debt to GDP is lower by 5%. In that sense, there's a creation of fiscal capacity. So we saw kind of the direct effects. We saw the GE effects. I want to spend just a little bit of time walking through the intuition for why QE works here. What's the GE effects of QE? Essentially, unconventional monetary policy acts as a positive aggregate demand shock by stimulating consumption and discouraging savings. So why does it have this effect? Well, think about this swap that the Fed does. It buys long-term debt from households and turns it into bank reserves, which banks are the ones who need to hold. These reserves are better collateral for banks than firm capital. So effectively, banks shed firm capital in response. This is a crowding out channel of QE. Now, wait a second. Normally, crowding out sounds like a bad thing. But here, what's happening through this crowding out is it's causing households to absorb more capital, but households are worse at intermediation, and thus this lowers households' expected return on wealth. And in a model with some heterogeneity, some frictions, the return on wealth effectively plays the same role that in a standard representative agent New Keynesian model is played by the interest rate. So that's what stimulates the IS, the intertemporal substitution channel. So households expect lower return on wealth, therefore they consume more, save less, and that sets off kind of the standard aggregate demand spiral, right? There's a New Keynesian substitution effect, firm hiring and investment increases, leads to higher wages, prices, macroeconomic stabilization. Now, we could also, if QE is so great, why don't we just do QE kind of in normal times as well? And in normal times, it does in fact look like a positive demand shock. Just the magnitudes are much smaller because we're already away from the zero lower bound, so the interest rate can adjust. Again, if QE is so great, why don't we do it all the time, right? I've given you all these reasons why long-term debt seems to be bad and short-term debt is good. Maybe we should just permanently shorten the government debt maturity. Well, that ends up looking like a negative supply shock because this crowding out is now persistent, and that reduces kind of investment in the long run. So really, for this to work, you need it to happen in bad times and not for too long. The other sense in which the state of the economy matters for the effectiveness of QE is the size of government debt stock to begin with. QE introduced in, or this policy conducted in low debt times has a much bigger effect on output than QE conducted in high debt times. Now that happens for two reasons. First, the QE is less effective when the interest rate is already not at zero. And the other channel, if you just kind of compare, compare the difference between the red line and the blue line, you see that they reverse, is that transfers actually become counterproductive at high times. Why? Because households expect this to cause tax increases in the future. Let me just show you one kind of last picture that I think summarizes this paper nicely. So the last experiment we're going to do is we're going to start debt to GDP at an 85% level, and we're going to show you these paths of debt to GDP. But of course, these paths are average, just summarizing a lot of risk, right? These paths could take different directions depending on the realization of shocks. And occasionally, these paths will enter that region where taxes will have to go up. So a substantial effect of unconventional monetary policy comes from reducing the probability of entering that region, especially if it coincides with transfers. So if you pursue transfers to do this macroeconomic stabilization, that comes as a substantial fiscal cost. It increases the probability of this austerity region. But of course, doing unconventional monetary policy on top of that decreases it back down, effectively creating the fiscal capacity to do this kind of fiscal stabilization. There's a few other things we do in the paper that I don't have time to because I ran out of time already. But the main messages I wanted to kind of show is that conventional monetary policy and fiscal policy by itself can be insufficient to fight these crises. And given that, unconventional policy not only helps stabilize the economy, but also lowers debt burden and reduces this risk of future tax hikes. If you're interested in the paper, there's some cool technical stuff we also did that I'd be happy to talk at a later point. Thank you very much.
Okay, thank you, Vadim. We have time for a couple of questions. Michael, please.
Very nice, Vadim. A quick question. So, could you comment on whether, let's say, we do see in bad times there's a flight to safety and, foreign demand for, U.S. safe assets increasing. Could that partially substitute for, the mechanism you have in mind? If I understood the mechanism correctly, you wouldn't actually get really this boost in intertemporal substitution to lower returns on wealth, but maybe you can comment on that. And then also I was trying to actually relate this to some of Stein's other work in which he argues treasuries might be mispriced to some extent because of the temporal allocation of G and taxes, and whether this would play a role in your setup.
Sure. So those are both great questions. So I think the first question about flight to safety, the model has, substantial kind of risk aversion has substantial risk premia. So to the extent this flight to safety happens for kind of precautionary reasons by households in the model, it already captures that. But you're right that there's a lot of foreign demand for US treasuries, and that flight could be coming from those. This is a closed economy, so we don't model that foreign demand. I think to an extent it could substitute, I guess in a reduced form, well, to some extent. I don't think it would make, a kind of a difference of the same magnitude as what we have here. But the way you could kind of capture that is by through that the portfolio cost of holding long-term debt term that we have in the household. You could imagine that maybe that cost falls in bad times, so the cost is itself correlated with the shock. That would moderate, I think, the results to some extent. But again, without having solved the model, my gut feeling is it would be kind of smaller order of magnitude than what we have. The second question was about relating this to Stein's other work. So yeah, I think Stein also gets this question a lot. So in some sense, he has this line of papers which propose a puzzle in government debt pricing. This paper, to an extent, resolves that puzzle. So I think the key kind of innovation and the component to this is this. You can think of this sort of a peso problem, right, with this fiscal adjustment. So if you believe that this fiscal adjustment can happen, or tax rates can really go up when debt to GDP crosses a certain threshold, and we calibrate that threshold, by the way, to be the highest it possibly can be, such that you could still ever raise taxes large enough to pay down the debt in kind of all possible shocks in the model. So if that could happen, then debt will be risk-free, even despite this fiscal risk present. And we kind of imagine the fiscal risk that Stein's paper estimates from the data. Now, there's a difference in that. I think in their first paper, they say that this, at some point, taxes would need to go up to something like 45% of GDP, right, to even come close to doing this. And, it's kind of not, there's a feasibility issue there. For us, that's a little bit less, because what they do is a partial equilibrium exercise, and we do a general equilibrium exercise. So here, as tax rates increase, to the extent that's a negative supply shock, that's also inflationary. So you have kind of an endogenous force that helps you pay off the debt a little bit that you wouldn't just get if you're looking at a kind of a more empirically based partial equilibrium setting.
Okay, thank you very much. We will thank you very much, Vadim. Let's thank you again. Hope to see you in person. So we move to the
Absolutely,
next.
thank you.
We move to the next speaker. Next speaker is Sebastian Graves from Federal Reserve Board. And I hope you can hear us. Sebastian, can you hear us?
Can you see my slides?
I think if you press a button, so can you? Okay, now we can see you, not the slides yet. Okay, thank you very much. So, Sebastian, you have 20 minutes. Please be very self-disciplined because of this online technique. You will otherwise hear a lot of echo and noise in your loudspeaker. So, please, floor is yours.
Great. Well, thank you very much for including our paper in the conference. It's called The Inflationary Effects of Sectoral Reallocation, and it's joint work with Francesco Ferrante and Matthieu Jokivuolle. All of us are at the board, so the standard Fed disclaimer applies. So I'm going to start the presentation by just running over a few facts about the post-COVID macro landscape in the US. These are facts which I'm sure many of you are aware of, but they're facts that we're going to use to set the stage for our modeling exercise. So the first fact is that there's been a sudden shift in consumption expenditures in the US away from services and towards goods. So you can see that on this slide in two different ways. On the left, we're plotting real consumption expenditures. These are all based to the end of 2019, so the last quarter before COVID. And you can see that consumption of services in the US by the end of 2021, that's the red line, was still below the pre-COVID level. Whereas on the other hand, consumption of goods was around 15% below the pre-COVID level. So that's the blue line. So that gives you some idea of the magnitude of this switch in consumption expenditures away from services towards goods. We're also showing that on the right in a slightly different way, which is just plotting the goods share of nominal PCE consumption expenditures. So you can see that that was around 31% before the onset of COVID. It spiked up by around 4.5 percentage points, reaching a high of around 35.5% in the middle of 2021. And it's basically stayed at that level. The second fact is that there's been a large rise in inflation, obviously something that you're all aware of. If we look at the breakdown in inflation in the US, we see that PCE inflation rose from around 2% at the end of 2019 to just under 6% by the end of 2021. This was largely driven by goods inflation, which rose from close to 0 before COVID to 8% by the end of 2021. Services inflation has obviously risen and did rise in the year up to 2021, but only from around 2% to around 4%. The third fact that we want to think about is the persistent decline in employment that we've seen in the US. So, when COVID occurred and lockdowns occurred, there was a large decline in employment. In the quarters after that, we saw rapid employment gains as a lot of people went back to work. However, the employment growth that we've seen post-lockdowns has been much weaker and hasn't recovered to the levels that we saw before COVID. So if we think about the pre-COVID trend, employment in the US at the end of 2021 was still around between 3 and 4% below the pre-COVID trend. And given that the US unemployment rate had basically fallen to the pre-COVID level by the end of last year, you can think that, in an accounting sense, this decline in employment is entirely explained by a decline in labour force participation. The final fact that motivates this paper is the increase in dispersion of macro variables at the industry level. So you can do this a number of ways. Here we're just plotting real gross output for 66 different industries using BEA data. We've grouped those industries into whether they produce goods or whether they produce services. But what I want you to take away from this chart is that the dispersion of real output across industries exploded at the onset of the COVID pandemic and has stayed very large up to the end of 2021. Okay, so motivated by those facts, the main question that we want to think about in this paper is how this shift in demand from services towards goods might have affected the level of inflation that we've seen in the US. In order to do that, we're going to study demand reallocation in a new Keynesian model, and that model is going to have 3 key features. The first is that it's going to be a multi-sector model with an input-output structure linking these sectors. The second is that we're going to have costly input adjustment, and in particular, we're going to assume that firms face hiring costs. So it's going to be costly to increase employment in goods producing sectors, for example, in response to this shift in demand. The third feature that we have in this model is heterogeneous price rigidity across sectors. And I'll show you that we find that it's quantitatively important to take that into account when thinking about this type of shock. So armed with this model with these features, we're going to estimate the model, allowing for 3 broad shocks. The first is the shift in preferences from services towards goods. So we're going to call that the COVID demand shock or the demand reallocation shock. The second is we're going to allow for sector-specific TFP shocks. So that's obviously motivated by this big increase in dispersion that we see at the industry level. And then the third shock that we're going to allow for, again, motivated by those facts I showed at the beginning, is we're going to allow for an aggregate labour supply shock. So you can think of that as the Great Resignation to take into account this big decline in labour force participation that we've seen in the US. So I'll briefly recap the main results of the paper at this point. So the single main result, if you remember one thing from this paper, I want it to be this, is that we find that the shift in demand from services towards goods can explain a large portion of the rise in inflation that we've seen in the US, at least up until the end of 2021. Now, why does this model generate inflation in response to this shock? There's basically 2 reasons. The first is the asymmetry in adjustment costs provided by these hiring frictions. So if you think about a shock that increases demand for goods and decreases demand for services, in our model, goods sectors are going to struggle to expand their capacity because of the costs of increasing employment. So when you see an increase in demand for goods, that's going to translate into both prices and quantities. On the other hand, services sectors are able to freely cut their capacity. They're able to freely cut their employment. So when you see a decline in demand in services, that's going to translate more into quantities than prices. So that's going to be the first main reason why we see inflation going up. Having said that, there is another reason why in our quantitative model, this demand reallocation from services to goods is inflationary. And that's because goods prices tend to be more flexible than those of services. So all else equal, a shock that increases demand for goods and lowers demand for services is going to raise goods prices more than it lowers services prices. And that's going to be a second source of inflation. The second main result is that we find this demand reallocation shock can actually explain a lot of the cross-sectional data, so a lot of industry level data on prices and quantities. So, and we find that both the input-output structure and the heterogeneity in price rigidity that we have across sectors are going to be important for that result. Our third main result is that we find that these other two shocks, the sectoral productivity shocks and the aggregate labour supply shock, both are inflationary, but less so, significantly less so than the demand reallocation shock. So if we're at least among these three shocks, if we're thinking about which can explain the rise in inflation seen in the US, it seems the demand reallocation shock is the most important. Finally, I'm probably not going to have time to go over a number of experiments that we can undertake with the model, but I'll summarize briefly what we find. So with this model, we're able to think about what might happen going forward. For example, we can think what would happen in our model if there was a sharp shift in demand back away from goods towards services that was unexpected. And what we find is that such a shift in demand would actually be inflationary. And the reason that would be inflationary is because in such a scenario, services sectors would have cut their employment too much. So they need to then start increasing their capacity, and they run into hiring costs in order to build their capacity back up to this unexpected reversal. Okay, so given that summary, I'm now going to briefly go over the key features of the model before showing you the results that we have. So on the household side, households in this model are going to consume goods and services. Goods and services are each going to be a bundle of the output of the n different sectors of our economy. And the demand reallocation shock is going to come in through a time-varying preference for goods relative to services. So this first equation I'm showing you here shows that the overall consumption aggregate is a bundle of goods consumption and services consumption. And in red, this variable omega t is going to be the relative weight on goods in the consumption bundle. And we're going to allow that to vary to model this shift in demand from services towards goods. Households are also going to supply labour to firms. They're going to have relatively standard preferences. And here, this is where we're going to introduce the aggregate labour supply shock. So simply this disutility of labour supply, this chi parameter here, we're going to allow that to vary to model an aggregate labour supply shock. On the firm side of the model, in each sector, there are three different types of firms. There's a very standard representative competitive producer. There are then monopolistically competitive firms. These firms are going to produce output. So output in sector I at time t, YIT, is going to be a function of productivity in that sector. So this variable AIT, shown in red, that's going to be the third source of shocks in our model, so sectoral productivity shocks. The production function is a CES function over intermediate inputs, shown by M, and labour inputs, shown by L. And then those intermediate inputs are then going to be their own CES bundle of the outputs of the n different sectors of the economy. So that the input-output structure of the economy is encoded through the parameters gamma, I, j. We're going to allow the elasticities in these two different functions to vary, so epsilon y and epsilon m, and these are going to be two of the key parameters in the model which we're going to estimate. The third type of firms in our model are labour agencies, and these labour agencies hire labour from the representative household, and they're going to supply labour to these monopolistically competitive firms. These labour agencies are going to face hiring costs, and in particular, we're going to assume convex hiring costs for these labour agencies. So I'm just showing you what the per period profits are going to look like for these labour agencies. They're going to receive a price of labour PL from the monopolistically competitive firms. They're going to pay a price of labour W to the household, but they're also going to have to hire extra workers, shown, this is the shown in red, if they're trying to expand their employment. And so the parameter C here is going to be the size of the hiring costs. That's going to be another key parameter in our model and another one that we estimate. Okay, so that's all I'm going to say about the structure of the model. There's obviously a lot more details that I haven't been able to go over, but you can find them in the paper. So we're then going to take the model to the data in two ways, in two steps. We're first going to calibrate a number of parameters and two of the shocks, and then we're going to estimate some of the key parameters and the remaining shock. So thinking about starting off with the parameters that we calibrate, a lot of the sort of standard parameters we're going to set to standard values. We're going to have 66 different industries in this model. We're going to calibrate the factor shares and the consumption shares using data from the BEA, so the input-output tables, and also the PCE bridge. And then Michael very generously shared his data on price stickiness or the frequency of price adjustment across industries. So we're using that in order to calibrate sectoral price stickiness in the model. And as I've said already, but I'm going to keep on highlighting, a key feature of that model is that goods prices tend to be more flexible than those of services. Turning to the shocks, two of the three shocks that we have in this model we're going to calibrate. So the demand reallocation shock, which is this increase in omega, this increase in demand for goods relative to services, we're going to calibrate the size of that shock to match the increase in the goods expenditure share that I showed you on the first slide. And then the sectoral productivity shocks that we have in the model, we're going to calibrate to sectoral TFP data that we've measured using the BEA's data. The remaining parameters and shocks we're going to estimate. So the three key parameters that we're going to estimate are the two production function elasticities and the size of the hiring costs. And then the remaining shock, the size of which that we're going to estimate is the labor supply shock. We're going to estimate those three parameters and one shock in order to minimize the distance between the model and the data for a number of different moments. I'm not going to show in detail what we do, but we use a number of moments relating to the cross-section of prices, output, and labor. And then we have two aggregate moments. The first is the aggregate decline in employment, which I showed you already. And the second is the difference in inflation between goods and services. So it's important to note here that we're not asking the model to match the rise in overall inflation that we saw in the US, but we are asking the model to match the difference in inflation rates between goods and services. And the main outcomes of this estimation exercise are that we find significant hiring costs, and I'm going to show you the importance of them when we look at the impulse responses. We also find that these production function elasticities are generally low, and in particular very low for the production function elasticity among intermediates. So that epsilon m is very close to 0, epsilon y is around 0.5. Okay, so that's set up the model and described how we're calibrating and estimating it. Obviously, this estimation happens with all three shocks simultaneously, but I'm now going to show the COVID demand shock, what happens if we simulate the model with the COVID demand shock on its own in order to understand the role that that plays. So here's what the impulse responses look like for this COVID demand shock on its own. In the top left panel, I'm showing this, what happens to the relative preference for goods. So that's the omega T variable. So it rises by around 4.5 percentage points, and then it declines slowly. The middle top panel and the top right panel are going to be sectoral variables. And here, the dotted lines are showing you what happens in the model with no hiring costs. So this is what would happen in response to this COVID demand shock if we turned off the hiring costs. What you see is there would be no change in sectoral price levels. There would be instant movements in employment across sectors. And the extent to which different sectors are hit by the shock depends on their position in the production networks of goods and services. If we look at the aggregates along the bottom three panels, you would see, if we start with the bottom right panel, employment in goods, if we aggregate employment in goods industries, that's the blue line, that would jump up instantly. Employment in services would decline instantly, but overall employment would stay unchanged. Overall consumption would stay unchanged, and overall inflation would stay unchanged. So if there was no adjustment costs to moving labor across industries, this demand reallocation shock would have no aggregate effects. If I now add in the solid lines, which is the ones that we're interested in, this is our baseline model, you see that we see very different results. And I think it's most informative to start with the bottom right panel and look at what happens to employment if we aggregate broad goods producing industries and broad services producing industries. What you see is that starting with services employment does decline instantly and almost as much as it would in a model with no hiring costs. On the other hand, employment in goods producing industries rises only slowly and takes about 2 years before it reaches its peak. So this is the key asymmetry in the model, which means that when we see this relative demand shock, if we look at services, this demand shock is going to translate largely into a fall in quantities and less into there's going to be less movements in relative prices. If we look at goods producing industries, this is going to be split both between increasing prices and increasing quantities. And if we look at the aggregates, we see that the asymmetry means that overall employment is going to decline by around 1%. Overall consumption is going to decline by around 1%. If we move to the bottom left panel, which is the one that we're most interested in, this is showing inflation in goods inflation, services inflation, and overall inflation in response to this shock. So what we find is that overall inflation rises by almost 4% in response to this demand reallocation shock, which is most of the increase that we saw in the US. So I realize that I'm low on time, so I'm going to skip the slide showing the importance of heterogeneous price rigidity. I'm going to show you this scatter plot, which on the x-axis has industry prices in the data, on the y-axis has industry prices in the model. So this is just in response to this demand reallocation shock. There's a relatively good fit between inflation in the cross-section of inflation rates. And importantly, this is not just when we compare industries that produce goods with industries that produce services, but it's also within the goods producing industries in blue or within the group of services producing industries in red. And we find both the input-output structure and the heterogeneity and price rigidity are important for that result. Okay. I'm going to very briefly run through what we do when we add all the shocks together, and then I'll conclude. So the main motivation for including the other two shocks in this model is that for some industries, the price and quantity dynamics that we see in the data are very hard to explain with what we would see just with a demand reallocation shock. So here I'm showing outputs in the data on the x-axis and prices in the data on the y-axis. And you see that there were some industries like motor vehicle dealers, for example, in the top left, where we saw big declines in output and big declines in prices. And those movements are very hard to understand if you're only thinking about a demand reallocation shock. They point to supply side disturbances. So we measure TFP at the industry level. We estimate the size of the other supply side shock, which is the aggregate labor supply shock. If I show you the impulse responses with all of those, with all three shocks together, if we just focus on the bottom left panel, you see that inflation rises by between 4 and 5% with all of those shocks. And given that inflation was rising by just less than 4% only with the demand reallocation shock, you can think that the demand reallocation shock is the most important one here for explaining the rise in inflation that we see in the model. Finally, when we include all of those three shocks and then we look at the cross-section of prices in the data on the x-axis and in the model on the y-axis, we see that when you include those three shocks, we have what we think is a sort of remarkably strong correlation between industry outcomes in the data and the model. So I'm going to skip the extensions now because I know I've run out of time, and I'm going to conclude by simply saying that we find the main result of this paper is that we find the demand reallocation shock can explain a large portion of the rise in US inflation. It can also explain a decent amount of cross-sectional developments. Adding TFP shocks and an aggregate labour supply shock, they're both inflationary, but less so than the demand reallocation shock. And when we include all three shocks together, we think we can explain a lot of both the aggregate and cross-sectional dynamics of what's occurred in the US in the 2 years up to the end of 2021. Thank you very much.
Thank you very much. Now we have time for questions. Matti, please.
Might it make some difference if you incorporated some open economy elements to the model? Because I mean, in terms of goods, you know, they typically are tradables and services are non-tradables.
No, for sure. I think it's a good point. There are some other papers doing similar stuff to us where they've included less sort of we've focused on the input-output structure and the detail on the domestic side. Those other papers have focused on maybe having fewer sectors but introducing an external side of the economy. So that it's, I think, a complementary way of looking at it. I would say, I think the other thing I would say is that some aspects of these, some of these sort of supply chain bottlenecks that you might be thinking of in goods production are going to show up in our model in the sense that they show up in those sectoral TFP measurements. So if we think about that one industry which has the starkest developments, the motor vehicle dealers, obviously we know that this is an industry which has been strongly affected by supply chain bottlenecks. And in our model, that's showing up as a big decline in measured TFP in that industry. So to some extent, we have a little bit of that which is entering through there, but I agree, you know, we sort of, it's an interesting thing to think about.
Thank you. Gisle?
Hi, so Gisle Natvik here. So, is there a very nice? It was a very nice paper. I was a bit curious about the monetary policy implication in that type of model, because as far as I understand, this is there is something going on in the background here with monetary policy. I guess this was a general equilibrium, or is there nothing? Is there nothing going on with monetary policy? And following up, that was more of a clarifying question. And then the second question was just if there were. So is this like? What is the policy implication here? Is this a model where COVID comes and the output gap becomes positive or negative? I used to think of like COVID was just like a purest possible negative productivity shock, and obviously the output gap became massively positive, and the right policy response was to increase the interest rates, and all central banks did the opposite. So this would lead to high inflation according to like the simplest possible model. Does that logic hold in your model, or is it like substantially different?
Okay, so I'll sort of proceed in two steps, I guess. First, what we do in terms of monetary policy, we have in the main exercises that we have in the paper, we have a really simple monetary policy rule where monetary policy is just responding to inflation with a standard, 1.5 coefficient. So we're doing the very most basic thing possible. We're not thinking about the ZLB. We're not thinking about anything else. We've got extensions where we've thought about maybe slightly more realistic monetary policy rules that have inertial components that respond to output. The basic results of our paper are basically unchanged with those other things, so which is why we've kept it the most simple one. So I think that's the easy part of your question to answer. The more difficult part is the sort of what should central banks have done part. I mean, we don't do an optimal policy exercise. If the central banks had followed, all I would say, I guess, is that I didn't show you the path of nominal interest rates, but obviously, given that inflation rises and we have a Taylor rule which only responds to inflation, central banks should have raised interest rates in response to this combination of shocks. Now, the only other thing I think I would point out is that we're not modeling that sort of lockdown period of COVID where a lot of other things were going on, which we think are a bit harder to model. So our model can't explain why the Fed, or all central banks cut interest rates in March 2020. But then again, I don't think we're really thinking about the key features that you might want to think about for explaining that.
Okay, thank you. We have a question from online audience. It says, could the model explain the very modest fall in inflation during the Great Recession and its slow rise in the aftermath of the recession?
So that is an interesting question. It's something that we've thought about a little bit. The sense in which it might be interesting to think about is that during the Great Recession, you see, in terms of the demand for goods and services, you see sort of the opposite dynamic. So if we think about auto purchases, for example, collapsed during the Great Recession. So the Great Recession was a time when the expenditure share on goods actually fell quite significantly. It didn't fall anywhere near as much as it's risen in the COVID period. So sort of quantifying that, I think the role of this demand reallocation was lower then than now. But I guess our model would suggest that that channel does point in the direction of a sort of missing deflation thing. The other, I mean, also I didn't really get time to explain the importance of the heterogeneity in price rigidity, but it's important to point out that if you think of a shock that shifts demand away from goods towards services, the fact that goods prices are more flexible than services prices is going to operate in the other direction. So a demand reallocation shock in that direction in our model is going to be less inflationary than a demand reallocation shock that goes away from services towards goods.
Okay, then I have a question myself. It's a bit related to the previous question. In the Europe, we of course would like to see what happens in your model when you have a huge negative TFP shock in the energy producing sectors. So significant price increases, tenfold price increases in the energy producing sector.
Yeah, no, I mean, obviously there's people at the conference that have done a lot more work specifically on this than we have. Honestly, it's something that we haven't thought about in the context of our model, but we have a number of the key features, and at least the only thing I would say is that I think the estimation of the production function elasticities that we do is a kind of nice feature of the paper, and we find very low production function elasticities among intermediate inputs. So to the extent that that's important, I mean, I think you would find large effects, but I don't want to speculate any more than that.
Okay, let me thank you again. And on the behalf of everybody, thank you for your presentation. And I think we are ready to close the session and cut the lines. And I think, yes, our organizers have something to say about the dinner.